Usually, when we look at a massive gleaming skyscraper, there's this underlying expectation of just like absolute structural perfection.
Right.
You stand on the sidewalk, you're looking up at the glass facade and the steel beams stretching up into the clouds, and you just assume someone somewhere has calculated every single stress point.
Yeah, you trust the engineering.
Exactly. You trust the math.
It feels solid,
Yeah. Yeah.
prominent. You don't walk into a 70-story building worrying about the math that keeps the elevators running or like the foundation from sinking.
Right. But then you think about a massive global corporation.
Oh, totally different story.
Yeah. We see the sleek logos, the polished commercials, the products on the shelves, and we tend to assume there is this exact same flawless engineering happening behind the scenes.
Right. We imagine a clean binary system.
Mm.
Money flows in, money flows out, and a computer somewhere perfectly balances the scales.
It's very comforting to think of business that way.
It really is. I mean, the human brain likes things to be categorized and neat and predictable. We want to believe that the multinational conglomerate producing our phones, or even just the local government paving our roads, operates with the precision of a squirrel watch.
But the reality, though, is that if you step into the actual engine room of a business, into the raw financial data, that sleek skyscraper suddenly looks a lot more like a chaotic, sprawling construction site.
Oh, completely. It's a mess.
We are talking about a landscape of thousands, maybe millions of daily activities. Someone is buying paper clips. Someone else is securing a $10 million loan.
A truck breaks down.
Right. A customer pays an invoice late. It is a blizzard of human and economic interaction that is honestly completely overwhelming if you don't have the right tools to decode it.
That blizzard is the absolute definition of informational chaos.
Informational chaos. I like that.
Yeah, because without a structural framework to capture it, categorize it, and make sense of it, it's literally just noise.
Right.
A business operating without that framework isn't a skyscraper. It's a pile of steel and glass waiting to collapse. And well, that brings us to the very discipline designed to prevent that collapse.
Which is accounting.
Exactly.
And before you, the listener, zone out or start thinking of, boring spreadsheets, stick with us because accounting isn't just about math.
No, not at all.
It is quite literally the invisible physics engine of the global economy.
I love that description.
Thanks. I mean, it's a language that has been evolving since 4000 BC, designed for one specific purpose, which is to measure human trust.
Trust, yeah.
So today on this deep dive, our mission is to completely demystify this language. We are going to unpack not just what the rules are, but the underlying logic, the history, and the why behind every single concept.
Because if you don't know the why, you're just memorizing rules.
Exactly. Whether you are prepping for a massive professional exam or trying to understand your own small business, or you're just curious about how the world actually functions, you need to understand how this language works.
And, to understand any language, you have to start with the alphabet.
Right.
You need building blocks. In the language of business, before you can even have accounting, you have to have something to account for. You need action.
Okay, action.
And that begins with what we call economic activities.
Which sounds like a very formal textbook term.
It does, yeah. But it really just means people doing things that involve resources. Every individual, every organization is constantly performing economic activities.
Every single day.
Literally every day. When a salaried person gets a paycheck and goes to the grocery store to buy dinner, that is an economic activity.
Right.
When they pay their child's school tuition, that's an economic activity. But it scales up infinitely,
So like a local amateur sports club charging membership dues to buy new uniforms, that's an economic activity too.
Exactly. Or a massive telecom giant laying thousands of miles of fiber optic cable across the ocean. They're doing the exact same thing, just on a larger scale.
And it isn't just limited to profit-seeking businesses, right? Because I feel like that is a crucial distinction, especially for anyone studying this formally.
Oh, it's a huge distinction.
The motivation behind the activity doesn't actually define whether it's economic or not.
That is a fundamental concept to grasp. Economic activities are not always run for individual financial benefit. Often, they are designed to create a social benefit.
Okay, give me an example.
Think about a local municipality. They collect taxes and use that money to run, say, a free public health clinic or a literacy program.
Right.
The end goal isn't to make a profit for a shareholder. The benefit is for the public at large. But resources are still flowing in and out.
Nurses are being paid.
Yes.
Medical supplies are being purchased, electricity bills are being settled.
Exactly. It is still an economic activity, and therefore it absolutely requires accounting.
Okay, so we have this constant churn of economic activities happening at every level of society. But how do these activities actually manifest? How do we pinpoint them in time and space so we can remember them? Because you can't just write down, the company did stuff today,
No, you definitely cannot do that. The tax authorities would not love that.
right?
You need specific markers. And this is where we have to define two very specific terms that act as the absolute bedrock of the entire accounting framework.
Okay, let's hear them.
We have transactions and we have events. Getting the distinction between these two crystal clear is the first major hurdle for anyone learning this discipline.
Okay, let's pull those apart. Because a transaction is essentially the performance of an act, right?
Yes.
It is an agreement or a business deal. It is the moment when value literally changes hands between two parties.
The key word there is act. It is active. You go to a landlord and you pay your monthly rent.
Yeah.
You performed an act.
Money has left my account and gone to theirs.
Exactly.
Yeah.
You purchase raw materials from a supplier. You pay a salary to your employee. These are all discrete, observable actions. You are transacting.
Okay, so if the transaction is the action, what is the event?
An event is a happening.
The happening.
Yeah, it is the consequence or the ultimate result of a transaction or a series of transactions.
So, action versus consequence.
Precisely.
To make this really concrete, let's look at a very specific real-world scenario, because I think that helps lock it in.
Always a good idea.
Let's imagine someone decides to set up a small local business, a stationery shop.
Okay, love it.
They have some savings and they are ready to get started. Let's walk through their first month of operations and identify the transactions versus the events.
A perfect way to visualize it. So, day one, our entrepreneur takes 2 lakh rupees of their personal savings and invests it into the business bank account to get things rolling.
Okay, so that is a clear performance of an act.
Right.
Money moved from personal to business. That is a transaction.
Correct. Now they have capital. Next, they need inventory.
Mm.
So they go to a wholesaler and purchase goods, boxes of pens, stacks of notebooks, printer paper, and they pay 1,15,000 rupees for all of it.
Another act. Goods for money. That's a transaction.
Yep. Then the first of the month rolls around, and they have to pay the shop rent to their landlord. That costs them 5,000 rupees.
Money out the door for the use of the space. Transaction.
Now, throughout the month, customers come into the shop, they buy pens, they buy notebooks.
Hopefully.
Right, hopefully. By the end of the month, our entrepreneur has sold a large portion of those goods, collecting 1,47,000 rupees in revenue from those customers.
Which is a series of many small acts, but collectively making those sales is a transaction. Or a set of transactions.
Exactly.
So far, everything has been an act of exchange. We've invested capital, bought goods, paid rent, and sold goods, all transactions.
Now the month is over, and it is time to look at the consequences of all those actions. This is where the math kicks in to reveal the events.
Okay, let's run the numbers on this. So they generated sales revenue of 1,47,000 rupees. But they also still have some unsold goods sitting on the shelves. They do a physical count and determine that the remaining inventory is valued at 15,000 rupees.
Okay, keep going.
So the total value they're holding between cash from sales and unsold physical goods is 1,62,000 rupees.
Perfect. Then we have to subtract the costs incurred to generate that value.
Right, so they spent 1,15,000 on purchasing the initial goods, and they paid 5,000 in rent. So total costs are 1,20,000.
Which leaves us with
Total value of 1,62,000 minus total costs of 1,20,000 leaves us with a surplus, a profit of 42,000 rupees for the month.
beautiful. Now, earning that 42,000 rupee surplus is classified as an event.
And conceptually, that makes total sense to me. The profit isn't something you went out and did. You didn't shake hands with the profit.
No, you didn't.
The profit is the natural mathematical result of all the buying and selling and renting you did over the last 30 days. It is a consequence.
Exactly. It is the ultimate happening resulting from the business cycle.
But here is where I want to push back. And I know this is a concept that trips up a lot of students and professionals early on.
Let's hear it.
It's about that leftover inventory.
Ah, yes.
The framework states that simply having that 15,000 rupees worth of unsold pens and notebooks sitting on a shelf at the end of the month is also an event.
It is.
I struggle with that. I understand paying rent as a transaction. I understand making a profit as a consequence. But how is just having a box of pens sitting quietly in a stock room An event.
Because it's not moving.
Right. Nothing is happening to them. They are just sitting there.
It is a brilliant point of confusion, and it is entirely counterintuitive until you shift your perspective on what a result can actually be.
Okay, shift my perspective.
To understand why inventory is an event, we need to step out of the stationery shop entirely. Let's go into a kitchen. Think about baking a cake.
Okay, I can follow a baking analogy.
You decide you want a cake. You can't just magically manifest one. You have to take action.
Right.
You go to the grocery store. You buy flour, sugar, eggs, and butter. You come home. You crack the eggs. You measure the flour. You mix it all together in a bowl. And you physically put that pan into a hot oven.
All of those are actions.
Exactly. Buying the ingredients, mixing the batter, turning on the oven, those are your transactions. You're actively combining resources and labor.
Okay.
Now, 45 minutes later, the timer goes off. You open the oven door and you pull out a fully baked, beautiful chocolate cake. The cake itself is the event.
Wait, because I didn't transact a cake.
Exactly. You transacted the ingredients and the heat. The cake is the physical consequence of those inputs. It is the end state.
Oh, wow. I see where this is going.
Let's take it back to the stationery shop.
Right.
You went out and transacted to buy 1,15,000 rupees worth of pens and paper. That was the raw flour and sugar of your business.
Right.
Then you transacted to sell a large portion of them. That was the mixing and baking.
Right.
The fact that you have exactly 15,000 rupees worth of pens left over on the last day of the month is not an action you took that day.
No.
It is the physical, mathematical consequence of what you chose to buy minus what you managed to sell.
Right.
It is the leftover cake batter.
That reframes it completely.
Right.
The transaction is the input. The action, the event is the output, the resulting state of affairs at a specific moment in time.
Yes.
Having inventory isn't an action, it is the physical evidence of past action.
Exactly. Just like the 42,000 rupee surplus is the financial event, the 15,000 in closing inventory is the physical event. Both are consequences of the exact same set of transactions.
Wow. Let's lock this in with a totally different scale. We talked about social benefits earlier. Imagine a local municipal corporation.
Okay.
They receive a massive grant from the central government, let's say 500 lakhs, specifically earmarked for adult education programs.
The receipt of that grant is a transaction. An agreement was made, funds were transferred.
Then the municipality gets to work. They spend 250 lakhs purchasing literacy kits and books.
A transaction. They are exchanging money for goods.
They hire teachers and pay them 200 lakhs in salaries over the year.
Another transaction. Exchanging money for labor.
So the year ends. They received 500, they spent 250 on kits and 200 on salaries. That's 450 total spent.
Right.
They look at their bank account and they have a balance of 50 lakhs remaining.
And that remaining balance of 50 lakhs is the event.
Because they didn't do a 50 lakh balance.
Exactly. The balance is the consequence of the grant coming in and the expenses going out.
And if we scale this up to the absolute highest level, like a national economy,
Oh, it still applies perfectly.
the central government raises billions in revenue through various taxes. They pay out salaries to millions of civil servants. They fund massive infrastructure projects. They buy military equipment.
All of those are millions of individual transactions.
Right. And at the end of the fiscal year, if their tax receipts were higher than their total spending, they declare a national budget surplus.
Yes.
If they spent more than they took in, they declare a budget deficit.
And that surplus or deficit is the ultimate macroeconomic event. It is the final happening of a nation's financial year.
Which brings us to the sheer scale of the problem here. We have 8 billion people on Earth.
A lot of people.
We have millions of companies, from local stationery shops to telecom giants dealing with billions of microtransactions every time a phone connects to a cell tower.
Right.
We have local and national governments. All of them are performing transactions resulting in millions of events every single second of every single day. The volume of data is just unfathomable.
It really is.
If we just let all those transactions pile up in a giant metaphorical room, it would be impossible to ever know if a business made a profit or if a government was bankrupt.
It would be pure informational anarchy. You couldn't make a single rational decision because you wouldn't know the reality of your own resources.
Right.
And that overwhelming existential need for order brings us to the very definition of accounting.
Okay, let's hear it.
Accounting is the discipline developed specifically to measure these economic activities. Its entire architectural purpose is to capture the inflow and outflow of resources, organize that data, and meet the information needs of rational decision makers.
But the way we define that discipline hasn't always been the same, has it?
No, not at all.
The concept of what an accountant actually is and what their primary job is has shifted radically over the last few decades. The history of how the profession defines itself is actually a perfect mirror for how global business has evolved.
It is a fascinating evolution. If we look at the historical definitions provided by major professional bodies, we can trace a clear trajectory from a mindset of, well, basic record keeping to a mindset of complex communication.
Let's go back to 1961.
Okay.
The Committee on Terminology from the American Institute of Certified Public Accountants, the AICPA, they sat down and codified a definition. They stated, and I'll just quote this, "Accounting is the art of recording, classifying, and summarizing in a significant manner, and in terms of money, transactions, and events, which are, in part at least, of a financial character, and interpreting the result thereof."
The crucial word in that 1961 definition is art.
Art.
Yeah. They conceptualized accounting primarily as the art of record keeping. It was viewed as a highly internal, almost artisanal skill.
Interesting.
The focus was heavily on the mechanics of the job, right? Identifying which events actually had a financial character and ensuring they were meticulously written down in the ledgers.
It feels very insular, like the accountant is a monk in a back room focused solely on keeping the house in order.
That's exactly how it was viewed.
But society doesn't stay still. Just 5 years later, in 1966, the American Accounting Association, the AAA, published a new definition that feels completely different.
Yes, it does.
They defined it as, quote, "the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by the users of accounts."
Notice the massive paradigm shift in the language there.
Yeah.
It is no longer described as an art of recording. It is now a process. And more importantly, the primary verb has shifted toward communicating.
Communicating, right.
For the first time, the definition explicitly centers on the end goal, which is permitting informed judgments and decisions by the users.
So it went from being about the ledger to being about the reader of the ledger.
Exactly.
And then by 1970, the Accounting Principles Board refined this trajectory even further, stating, "The function of accounting is to provide quantitative information, primarily of financial nature, about economic entities that is needed to be useful in making economic decisions."
So in less than a decade, from 1961 to 1970, the profession's self-image just totally transformed.
It moved from a narrow mechanical focus on keeping books to a broad, outward-facing responsibility of providing useful data for economic decision-making.
It had to.
Right, but what was happening in the real world to force that change? Why did the art of recording suddenly become inadequate in the 1960s?
Well, it was driven by the massive expansion and increasing complexity of the post-World War II corporate world.
Okay.
We were seeing the rapid globalization of business and the rise of massive multinational corporations. But the most critical factor was the increasing separation of ownership from management.
Meaning the people who owned the shares in the company were no longer the people sitting in the C-suite running it day to day.
Precisely. Because if you are the sole proprietor of a small stationery shop, you are the owner and the manager.
Right.
The 1961 definition works perfectly for you. You just need the art of recording to know if you can pay your rent.
Right, it's just for me.
But if you are a pension fund holding shares in a global manufacturing conglomerate, you have no idea what is happening on the factory floor.
Not at all.
You are entirely separated from the operations. You rely completely on the financial reports to know if your investment is secure.
And it wasn't just shareholders either.
No?
Governments needed to assess massive corporate tax liabilities. Labor unions needed to understand corporate profits to negotiate wages. Banks needed to assess the risk of lending millions of dollars.
Exactly. Society at large developed a vested interest in the financial reality of these massive enterprises.
So the accountant could no longer just be a bookkeeper in the back room.
No, they had to become a translator. They had to take the raw, chaotic data of millions of transactions and translate it into a structured, communicative language that external stakeholders could actually use to make high-stakes decisions.
That context makes the shift in definitions make perfect sense.
It does.
Now, for any listeners out there who might be facing a professional exam on this foundational material, there is a very common trap regarding these historical definitions.
Oh, yes. Examiners love to test your understanding of this exact evolution.
What's the trick to getting it right?
The trick is to associate specific keywords with their respective eras. If a multiple-choice question asks you to identify the definition that describes accounting as an art of recording and classifying, your brain should immediately link art to the older, more mechanical era.
So the 1961 AICPA definition.
Exactly. Art equals 1961.
Got it.
Conversely, if the question emphasizes phrases like communicating economic information or permitting informed judgments, well, that is the hallmark of the outward-facing shift.
So that key phrase links directly to the 1966 AAA definition.
Memorizing those keyword associations will literally save you time and point you right to the correct answer.
Okay, so we understand that modern accounting is a grand outward-facing process of communication and decision support.
Right.
But that is very theoretical. Let's get our hands dirty here. What is the actual procedure? How does an accountant take a shoebox full of messy receipts and turn it into a polished, communicative financial statement?
To understand the mechanics, we have to walk through what is known as the six-step accounting cycle.
The six-step cycle.
This is the conceptual engine of the entire profession. It is how you move from raw chaos to refined clarity.
Let's trace a transaction all the way through this cycle. So, step one is recording.
Recording is the absolute starting point. It is the basic function of capturing a transaction the exact moment it happens and writing it down in what we call primary books or subsidiary books.
Okay.
Historically, this was a physical journal. Today, it's digital, obviously, but the concept is exactly the same. It is a chronological log.
So if we go back to our massive telecom company, every single time a customer uses data, a record must be generated.
Right.
When they buy a fleet of repair trucks, it must be recorded.
It is the raw data capture, just getting it into the system.
But a chronological list of 10 million transactions isn't very helpful if you want to know how much you spent on vehicle maintenance last year.
It's useless for that.
Which leads to step two.
Classifying.
Right, because a journal is just a diary of what happened in order of time. Classifying is the process of grouping similar items together.
Okay, how does that work? You take all that raw chronological data from the journal and sort it into secondary books, primarily known as the ledger. You are creating distinct categories or accounts.
So you're basically opening different files.
Exactly.
You take every single rent payment made throughout the year, pull them out of the journal, and put them all into one specific ledger account called rent expense.
Yes.
You take every sale and put it into sales revenue.
You are sorting the chaos into organized piles. Income, expenses, assets, liabilities.
Okay.
But even a ledger can have hundreds of accounts with thousands of entries. It's still way too granular for an executive or an investor to read easily.
Nobody wants to read that. That necessitates step three, summarizing.
Summarizing is the art of condensing. You take the final balances of all those classified ledger accounts and present them in a way that is highly digestible.
Like a cheat sheet.
Exactly. This involves preparing a document called a trial balance to ensure the mathematical accuracy of your sorting.
Just checking the math.
Right. And then ultimately generating the final financial statements, the profit and loss account, which shows your performance, and the balance sheet, which shows your financial position.
Wow. So you take an entire year of complex operations, millions of data points, and distill them down to literally just a few pages of summary numbers.
That's the magic of it?
That completes the generation phase, right? We've captured the data, sorted it, and summarized it.
Yep.
Now we transition into actually using that data. Step four is analyzing.
Analysis is where we begin to look at the structure of the summarized data. It is the methodical classification of the numbers within the financial statements to establish relationships.
Give me an example of that.
So, for example, you look at the balance sheet and you group all the things you own that can be quickly turned into cash, like inventory and bank balances, and you categorize them as current assets.
Okay.
Then you group all the debts you have to pay within the next year and categorize them as current liabilities. You're establishing the mathematical relationship between different parts of the business.
And that leads directly to step five, interpreting.
It does. This is where you explain the meaning and significance of the relationships you just established during the analysis phase.
So you're finding the why.
Exactly. You're answering not just what the numbers are, but why they are what they are and what is likely to happen next.
Now, I have to admit, when I first studied this, analyzing and interpreting felt like a distinction without a difference.
Really?
Yeah. They both just sound like sitting in a room looking at a spreadsheet and thinking about it for a long time. How do you clearly separate the two in your mind?
It is a very subtle conceptual boundary, but distinguishing them is vital. They are two halves of a cognitive process.
Okay.
Let me use an analogy that usually clears this up immediately. Imagine I hand you a giant, chaotic cardboard box filled with thousands of loose Lego bricks.
Okay, I am staring at a mountain of plastic chaos.
Exactly. First, you decide to organize them. You spend hours putting all the small 2x4 bricks in one pile, the long structural pieces in another, the tiny decorative pieces in a third.
That physical act of sorting is classifying.
Perfect.
Okay, I have my neat piles.
Now, you step back and look at your piles. You count them, and you notice a stark numerical reality. You realize you have 500 bright red bricks, 50 blue bricks, and only 10 yellow bricks.
Okay.
You have established a factual, structural relationship about your resources. The red bricks make up roughly 90% of your total mass.
Right.
Identifying that numerical relationship that is analyzing, you have established the facts of your situation.
So analysis is purely about identifying proportions, ratios, and structural realities. It's totally objective.
Yes, completely objective.
Yeah.
But knowing you have 90% red bricks doesn't actually tell you what to do with them.
No.
That is where interpreting comes in. Interpreting is the cognitive leap from the numerical fact to the real-world implication.
Okay, how so?
It is looking at that analysis and realizing, well, because our analysis proves we have a massive surplus of red bricks and almost no yellow or blue, the only logical thing we can build is a fire truck. We do not have the structural capacity to build a spaceship.
Oh, that clicks perfectly.
Right.
Analysis is seeing the relationships in the data. Interpretation is extracting the business reality from those relationships.
Exactly.
So, like, analysis says, fact, our short-term debt obligations are currently twice as high as our available cash on hand.
Yes.
But interpretation says, implication, because of that severe liquidity ratio, if our sales dip even slightly next month, we will likely default on our rent and face eviction.
You got it. A computer can do the analysis. I can calculate the ratios instantly. But it takes a human mind understanding the context of the business environment to do the interpretation.
Which makes the final step absolutely crucial. Step 6, communicating.
Because if you do all that brilliant interpretation but keep it in your head,
Right.
the system fails. You have to transmit that interpreted information to the end users, management, investors, lenders, so they can actually make those rational economic decisions.
How do you do that?
You do this through narrative reports, graphs, accounting ratios, and formal presentations.
So the cycle is complete. We've gone from a raw receipt to a boardroom presentation.
Yes.
Recording, classifying, summarizing, analyzing, interpreting, and communicating.
That's the cycle.
And for anyone needing to commit the specific sequence to memory for a test, there is a fantastic mnemonic device to lock it in.
Yes, under the stress of an exam, having a mental hook is absolutely essential. To remember the 6-step cycle in order, just memorize this simple phrase. Really cool students always impart clarity.
Really cool students always impart clarity. R for recording, C for classifying, S for summarizing, A for analyzing, I for interpreting, C for communicating.
Exactly.
That is a brilliant anchor. RCSAIC.
It ensures you never mix up the generation phase with the usage phase.
Now, in talking about this massive cycle, there is a term that gets thrown around constantly, often by people using it as a synonym for accounting.
Oh, I know what you're going to say.
Bookkeeping.
Yep.
You hear people say, I need to do the accounting or I need to do the bookkeeping, completely interchangeably. But technically, professionally, they're not the same thing at all, are they?
They're absolutely not synonyms, and treating them as such is a major conceptual error that will cost you points on any exam and, honestly, just cause confusion in the real world.
Okay, so we need to draw a hard line.
Drawing a hard line between them is essential.
Let's draw that line. The easiest way to think about it, to me, is architecture. Bookkeeping is laying the concrete foundation. Accounting is designing and building the entire skyscraper on top of it.
That's a great way to visualize it. If we break this down into scope, nature, and outputs, the differences become very stark.
Let's start with scope.
The scope of bookkeeping is relatively narrow and mechanical. It is primarily concerned with only the first 2 steps of our cycle.
So, recording the raw transactions in the journal and classifying them into the ledger?
Exactly. It is the routine, often clerical task of accurately logging history as it happens. It involves a tiny bit of summarizing, usually just preparing the trial balance to check the math, but that's where it stops.
So the bookkeeper handles the R and the C and hands off the data.
Right. The scope of accounting, on the other hand, is vastly wider. Accounting takes that raw classified data and handles the heavy lifting of summarizing it into four full financial statements, and then analyzing, interpreting, and communicating the meaning of those statements.
Which brings us to the nature of the two roles.
Yes, bookkeeping is foundational. It provides the necessary raw material. You literally cannot do accounting without good bookkeeping.
Right.
But accounting is analytical. It is considered the language of the business itself, tasked with extracting insight from the data.
But the most definitive dividing line seems to be the outputs, right?
It is absolutely the clearest way to separate them. A bookkeeper does not produce a profit and loss account. They do not produce a balance sheet.
Really?
Nope. Financial statements do not form part of the bookkeeping process. Those high-level analytical documents are the core defining outputs of the accounting process.
So the phrase that always gets highlighted in introductory courses is, accounting starts where bookkeeping ends.
It is a perfect summary. The bookkeeper meticulously logs the bricks as they are delivered to the site. The accountant takes those logs, builds the house, and then explains the architectural integrity of the house to the bank.
It is an incredibly sophisticated, multi-layered system.
It really is.
But it's vital to realize that this wasn't just invented in a boardroom in the 1960s.
Yeah.
This framework of transactions, events, recording, and summarizing is a fundamental human technology.
Oh, absolutely.
To really appreciate how deeply embedded this is in our society, we have to look at the history.
The historical timeline of accounting is essentially the timeline of human civilization.
Really?
Yeah. The moment human beings began organizing resources on a scale larger than a single family, they realized human memory was insufficient. They had to invent accounting.
We can trace this back to 4000 BC in ancient Egypt, right?
Yes. The Egyptians ran a massive, complex empire, and their wealth was heavily centralized in royal treasuries.
Okay.
The officials in charge of managing vast quantities of grain, gold, and labor couldn't just guess what they had. They implemented a strict system of control where local treasurers had to send daily detailed reports to their superiors, who were high officials known as wazirs.
Wazirs.
These wazirs would then compile monthly summaries for the pharaohs. It was an early form of management accounting designed to prevent theft and inefficiency.
That makes total sense. Around the same time, we see Babylonia emerging as the ancient city of commerce.
Yes.
They were a massive trading hub, and they developed accounting methods specifically to identify fraud in business partnerships.
Which is very modern if you think about it.
It is. Then you move to Greece and Rome, from roughly 700 BC to 400 AD.
The Romans were meticulous administrators. They used accounting to manage complex government finances across a sprawling empire, dividing revenues, tracking military spending, and maintaining highly detailed memorandums and daybooks of receipts and payments.
And this wasn't just a Western or Mediterranean phenomenon either.
Not at all.
By 2000 BC, China had developed a highly sophisticated form of government accounting. And in India, you have one of the most remarkable examples of early financial administration in the figure of Kautilya.
Yes. Kautilya was a brilliant minister and strategist in Chandragupta's kingdom. He authored a famous treatise called the Arthashastra.
The Arthashastra.
Right. It wasn't just a book on politics, it was a comprehensive guide to statecraft. And it explicitly detailed the strict procedures for how accounting records had to be maintained for the state, how audits should be conducted, and how financial corruption should be punished.
So for thousands of years, civilizations were using various forms of single-entry bookkeeping, which was basically just making lists of what they owned and what they owed.
Right.
But the true paradigm shift, the singular moment that birthed the modern financial world we live in today, happened in 1494 in Venice, Italy.
Venice in the 15th century was the bustling epicenter of global trade. Merchants were dealing with unprecedented volumes of goods, complex currency exchanges, and sprawling partnerships.
So making lists just wasn't cutting it anymore.
Exactly. The old methods were breaking down. They needed a more robust mathematical model, and it was provided by a man named Luca Pacioli.
Luca Pacioli, often called the father of accounting.
That's him.
And the fascinating thing is, he wasn't a banker or a merchant. He was a Franciscan friar and a brilliant mathematician. He actually shared an apartment with Leonardo da Vinci at one point.
Which is wild to think about.
I know. He published a massive book covering all the mathematical knowledge of the time, and buried within that book on algebra and geometry was a section that introduced the concept of double-entry bookkeeping to the wider world.
Now, he didn't necessarily invent it from scratch. Venetian merchants had been experimenting with it, but he codified it. He formalized the rules and published it so it could spread across Europe. He gave us the dual aspect concept that completely revolutionized how we track wealth.
He introduced the actual terminology we still use today, right?
Yeah.
Debit, which
Yeah.
is abbreviated as doctor, and credit, abbreviated as CR.
Yes.
And if we pull the thread on the etymology of these words, it reveals something incredibly profound about what accounting actually is.
The linguistic roots are deeply revealing.
Walk us through it.
Well, the word debit originates from the Italian word debito, which is derived from the Latin debita or debio. In its historical context, it literally translates to owed to the proprietor.
Owed to the proprietor. Someone owes me something. Okay. And credit.
Credit. Credit comes from the Italian credito, which is rooted in the Latin word credo, and credo translates directly to trust or belief.
Wow.
It implies a state of trust in the proprietor or something owed by the proprietor based on that trust.
Credo. Trust. That changes everything. At its very linguistic root, a credit is a mathematical measure of trust in an economic relationship.
Yes. When a bank gives you a loan, they are extending you credit. They are extending you trust.
That is so cool.
And Pacioli established the foundational, inescapable rule of this double-entry system based on this exact dynamic. He wrote a principle that sounds simple, but is the gravity of the financial universe. If you make one creditor, you must make some debtor.
Meaning, every single economic event has a dual aspect. It is a mirror.
Exactly.
If money comes into the business, a corresponding obligation or equity must be recorded. If an asset goes out, a corresponding reduction in liability or equity must happen. The scales must always balance.
It creates a completely self-checking mathematical ecosystem.
Yeah.
And based on that elegant system, the profession has evolved through 3 distinct historical phases.
Let's trace those phases. Phase 1 is stewardship accounting.
This is the oldest operational model. Think back to the wealthy landowners of the Middle Ages or the merchant princes of Venice. They possessed vast estates and multiple businesses.
Right.
They couldn't manage everything themselves, obviously, so they employed stewards, trusted managers, to run the day-to-day operations.
So the steward is out there handling the money and the crops.
Right, and periodically, the steward was required to render an account to the wealthy owner, proving they hadn't stolen anything and showing how they were managing the wealth.
So it was purely about accountability to a single identifiable owner.
Exactly. And this model was sufficient for centuries, as long as businesses were mostly privately held by individuals or small partnerships.
But then the Industrial Revolution happens, capital requirements absolutely explode, and we enter phase 2, financial accounting.
Yes, and this is born out of the invention of the joint stock company.
How does that change things?
The joint stock company fundamentally altered the dynamic. To build a massive railroad, you need way more capital than one family possesses. You need thousands of investors to pool their money.
Right.
Suddenly, you have a massive fracture between ownership and management. The thousands of shareholders who own the company have absolutely no involvement in running it.
They are completely vulnerable to the managers, then.
Exactly. To safeguard the interests of these absent investors, the legal system stepped in and mandated the disclosure of standardized financial statements.
So financial accounting became a rigorous, legally required information system designed specifically to communicate the reality of the business to a broad group of external users.
The focus shifted entirely outward.
But running a massive industrial corporation is incredibly complex, and just looking at an annual balance sheet isn't enough to help a factory manager decide how to price a product on a Tuesday.
No, it's totally useless for daily operations.
Which necessitates phase 3, management accounting.
Management accounting is a much more recent development, gaining prominence in the 20th century. While financial accounting looks backward and faces outward to investors, management accounting looks forward and faces inward.
Ah, okay.
It was created to generate highly specific real-time data to aid internal executives in making daily decisions, controlling operations, and formulating future strategy.
So stewardship was for the feudal lord, financial is for the modern stock market, and management is for the modern CEO.
But that's a great summary.
This historical splintering sets up the reality of the profession today, because modern accounting isn't one monolithic block. It is highly specialized.
Very specialized. But before we break down those specific modern subfields, we should explicitly state the 4 overarching objectives of accounting. Why do we actually go through all this effort today?
Okay, let's listen out. Objective 1 is the most basic, systematic recording. Just maintaining a permanent, organized, chronological, and classified record of all transactions. Objective 2 is the ascertainment of results. At the end of a given period, we need to know the ultimate event. Did we make a profit or did we suffer a loss?
Right. Objective 3 is critical for survival. knowing solvency and liquidity.
Solvency and liquidity.
You need to know your financial position. Liquidity refers to the immediate term. Do you have enough cash on hand to pay your rent and payroll this week? Solvency is long-term. Can the enterprise survive and pay its massive debts over the next 5 to 10 years?
Because a company can be profitable on paper but still go bankrupt because they lack short-term liquidity, right?
Happens all the time.
Wow. And Objective 4 is the grand conclusion we discussed earlier, providing information to users for rational decision-making.
Exactly. Now, to meet these intense and diverse objectives, the accounting profession has divided into 5 specific subfields.
Let's categorize them. The first 2 we've already touched on. First is financial accounting. This is the historical recording of transactions to prepare the official profit and loss account and the balance sheet for external consumption.
Right. Second is management accounting, which is the internal reporting system for executives to help them control operations and plan for the future.
Third is cost accounting. This is a highly specialized, granular field. Its primary purpose is to ascertain the exact cost of producing a specific product or providing a specific service.
Yes, and this is so important.
For example, if you are an automaker, financial accounting tells you if the company made money overall.
Right.
But cost accounting tells you exactly how much steel, rubber, electricity, and union labor went into producing one specific model of sedan, literally down to the penny.
You absolutely need that data to know what price to stick on the windshield. If your cost accounting is wrong, you might sell 1 million cars and lose money on every single one of them.
That would be a disaster.
Cost accounting is about operational survival.
Okay, so those first 3 fields are the traditional pillars. But the source identifies 2 newer subfields that represent how society's expectations of business are actually expanding.
Yes.
Fourth is social responsibility accounting.
This one is fascinating.
It is. The definition states it attempts to measure the social costs and social benefits of a business to society at large.
Traditionally, accounting only looks at the impact on the business itself.
Right.
So if a factory dumps toxic waste into a local river instead of paying to treat it, traditional financial accounting records that as a savings. It lowers costs and increases profit.
Because the river isn't on their balance sheet.
Precisely. But society pays the cost of that pollution and health issues and cleanup. Social responsibility accounting is an emerging attempt to quantify those externalized costs.
Or conversely, to quantify the benefits a company provides, like community development or green energy investments.
Exactly. It's trying to present a holistic view of the company's net impact on the world.
It is trying to put a price tag on corporate karma.
That's a good way to put it.
That leads to the 5th subfield, which I really want to pull apart here, human resource accounting.
Oh, this is a complex one.
The text defines this as an attempt to identify, quantify, and report investments made in the human resources of an organization. This concept is incredibly challenging. How can you possibly put a dollar value on an employee's brain or their creativity or their institutional knowledge?
It is exceptionally difficult to quantify reliably, which is exactly why it remains largely theoretical and is not included in standard financial statements.
Okay.
But your pushback highlights the exact reason the subfield exists in the first place. Conventional accounting completely ignores the value of human beings.
Right. Under traditional rules, a skilled, motivated, brilliant workforce does not appear anywhere on a balance sheet as an asset.
Yep.
In fact, human beings only appear on the income statement as an expense salary.
Which is a massive conceptual flaw in the modern economy.
Explain that.
Well, in 1920, the most valuable assets a company had were its steel mills and rail cars. Traditional accounting captures that perfectly. But today, think of a massive tech conglomerate or a high-end consulting firm. They have almost no physical assets, no factories, minimal inventory. Their entire multi-billion-dollar valuation is based on the intellectual property generated by the brains of their software engineers and strategists.
Oh, wow. Their people are literally their only real asset.
Yes. If the top 500 engineers left a major tech company tomorrow, the company would be effectively worthless.
But the balance sheet wouldn't reflect that loss until profits dropped a year later.
Exactly. Modern executives realize that human capital is their greatest competitive advantage. Human resource accounting is the profession's attempt to fix this historical blind spot.
So it tries to track and capitalize the massive investments a company makes in recruiting, training, and retaining top talent so management can measure the return on their human capital.
It is an attempt to measure the unmeasurable because the unmeasurable has become just too important to ignore.
That is a profound evolution of the profession. So we have financial, management, cost, social, and HR accounting. They exist because different people need wildly different types of information.
Yes.
Which pivots us directly to the most important question. Who is actually looking at all this data? Who is the audience?
Understanding the users of accounting information is paramount. The overarching principle that governs how information is presented to these users is that it must stress economic substance over technical form, and it must be relevant, material, and completely free of bias.
Okay, so the framework divides these users into two broad categories, internal users and external users.
Right.
Internal users are obvious, the owners and the management team. They use the data to navigate the ship. But the external users category is sprawling. To really understand why accounting is a public good, we need to dive into the specific psychology and needs of each external group.
Let's start with the most prominent external group, investors. Why are they dissecting the financial statements?
Because they are the ones putting their own money into the machine. They provide the risk capital. They need to analyze the data to make a ternary decision. Do I buy more stock? Do I hold what I have? Or do I sell and run for the hills?
Exactly.
They are looking at profitability, of course, but they also want to know the company's ability to survive in the long term and its capacity to pay out dividends.
Their relationship with the entity is defined entirely by financial risk and reward. Next, consider a group that is deeply invested, but often completely overlooked in this context. The employees.
Employees. Why do workers care about the corporate balance sheet?
Well, their livelihood is tied to it. The growth of the employees is intrinsically linked to the growth of the organization. They aren't just looking at profits, they're looking for stability and continuity. They want job security.
Oh, that makes sense.
They want to know if the company is solvent enough to guarantee their retirement benefits or pension plans. They're looking to see if the enterprise is expanding, which means enhanced employment opportunities and promotions.
And on a very basic level, if the union is entering wage negotiations, or if an individual is hoping for a year-end bonus, they need to see the profit margins to know what the company can actually afford to pay out.
Absolutely.
The third major external group is lenders. Think of commercial banks or bondholders. Their psychology is entirely different from an investor.
Completely different. An equity investor wants infinite growth. A bank doesn't care if you conquer the world. They just want to know one binary thing. Will you pay back the loan principal and the interest on the exact day it is due?
Right.
They are laser focused on liquidity and solvency ratios. They want predictability and security.
The fourth group is suppliers and creditors. These are the businesses that sell raw materials or services to the company on credit terms.
They need to assess the short-term ability of the enterprise to pay its dues. It completely dictates their credit policy.
So if a supplier analyzes a company's accounts and sees strong cash flow, they might offer them 60 days to pay for an order. But if the accounts show the company is struggling with liquidity, the supplier might demand cash on delivery to protect themselves.
In some cases, suppliers care deeply about the long-term survival of the enterprise, especially if the supplier's own business model is heavily dependent on selling to this one major client. If the client dies, the supplier dies.
Which brings us to the fifth external group. This is the one that initially confused me, and it is a classic trap for students, customers.
Yes.
When I read that, I thought, why would I, as a guy buying a cup of coffee, care about the cafe's balance sheet? I just want my coffee.
As a retail consumer making an instant transaction, you generally don't care at all.
Right.
But the vast majority of the global economy is B2B, business to business.
Yeah.
In that environment, customers care intensely about the financial stability of their suppliers.
Let's expand on the scenario to make this visceral. Imagine you run a massive pharmaceutical company. You manufacture a critical, life-saving drug that generates 80% of your revenue. To manufacture that drug, you require a highly specific, complex chemical compound that you can only source from one specialized supplier in another country. And you buy it on a massive scale, using 3 months' credit.
A very common, highly integrated supply chain scenario. Now, as the customer in this scenario, what happens if you ignore that supplier's financial health and suddenly, due to poor cash management, they go bankrupt and lock their factory doors?
The impact is catastrophic.
Yeah.
They stop producing the chemical, my shipments stop arriving. Within weeks, my entire pharmaceutical production line grinds to a halt. I can't fulfill orders to hospitals. I lose millions in revenue. My reputation is destroyed, and people might literally not get their medicine. My entire enterprise is brought to its knees because my supplier ran out of cash.
Exactly.
Yeah.
And that is why, as a major B2B customer, You will rigorously analyze the accounting information of your key suppliers before you ever sign a contract.
Yeah.
You are not looking for their profit margin, you are looking for their operational longevity. You need mathematical proof that they will survive long enough to keep supplying you.
It fundamentally flips the perspective on what accounting is for. It isn't just about protecting the people who give you money. It is about providing reassurance to the people who rely on your output.
It is an ecosystem built on trust, and the financial statement is the verification of that trust.
And because accounting touches every node of society, investors, employees, lenders, suppliers, customers, and government regulators, it cannot exist in a vacuum. It is deeply intertwined with several other academic and practical disciplines.
Oh, heavily intertwined.
Let's look at those interdisciplinary connections. First and foremost, obviously, is mathematics.
As we discussed with Luca Pacioli, the fundamental principle of double-entry bookkeeping was introduced to the world inside a textbook on algebra. The accounting equation itself, assets equal liabilities plus equity, is algebraic.
But practically, an accountant needs robust arithmetic skills daily. Computing compound interest for loans, calculating annuities, determining the complex depreciation of machinery over 10 years, calculating lease rentals. You cannot function in accounting without a strong grasp of math.
It also connects heavily to economics and statistics. Economic principles guide the understanding of market forces, while statistical knowledge is essential for the communicating phase, using data to build ratios, trend graphs, and probability charts.
But the connection that I think is most critical and often most surprising to people outside the field is law. Accounting and law are completely inseparable.
Completely. A business is not a natural phenomenon, it is a legal construct.
Yeah.
An economic entity operates entirely within a complex, binding legal environment.
Every single transaction we talked about earlier is governed by law. When you buy goods from a supplier, that transaction is governed by the Sale of Goods Act and contract law. When you hire an employee, labor laws apply. When you borrow money, the Negotiable Instruments Act applies. And the very existence of a corporation is governed by the Companies Act.
An accountant cannot accurately record a transaction if they do not deeply understand the legal reality of what just happened.
Right.
If a contract has a hidden liability clause, the accountant must know the law to recognize that liability and record it properly. Furthermore, the financial statements themselves are legally mandated documents that must comply with strict statutory requirements.
Okay, so we have established that accounting is this incredibly robust interdisciplinary framework that acts as the central nervous system of the modern world.
Yes.
But it is vital to acknowledge that it is not perfect. It has limitations. And there is one massive conceptual limitation that everyone must understand: the elephant in the room.
It is the primary blind spot of the entire profession. Accounting, in its traditional financial form, only measures what can be reliably expressed in terms of money.
If a factor cannot be quantified in a stable monetary unit, traditional accounting simply pretends it does not exist.
It is excluded from the accounts entirely, regardless of how important it might be to the actual survival or success of the business.
And this creates massive distortions in how we perceive the value of a company.
Oh, huge distortions.
Let's invent a scenario to highlight how dangerous this blind spot is. Imagine two competing companies. Company A has $10 million in the bank, strong physical assets, and solid historical profits. Their balance sheet looks fantastic.
A traditional accountant and a traditional investor would say Company A is highly valuable.
But let's look at the non-monetary reality. Company A has a toxic, abusive CEO. Their employee turnover rate is 50% a year because everyone hates working there.
That's a nightmare.
They have a terrible reputation in their community for dishonest dealings, and their customers are actively looking for alternatives.
But here's the thing. None of that toxicity, the bad morale, the horrible leadership, the crumbling reputation, is measurable in immediate dollars, so it does not appear on the balance sheet.
Now look at Company B. They are a younger startup. They only have $2 million in the bank. Their balance sheet looks weak compared to A.
Right.
But Company B has a visionary CEO who inspires everyone. They have fiercely loyal employees who work late because they believe in the mission. They have incredible unpatented internal processes, and their customers absolutely love them.
Under traditional financial accounting, Company B is deemed less valuable and perhaps a higher risk because all of those massive advantages, leadership, loyalty, reputation, internal synergy, cannot be quantified in dollars. They are invisible.
Even though any logical human being looking at the real world knows that Company B is poised to crush Company A in the long run.
Exactly.
The factors that are most relevant in assessing the true holistic worth and future survival of the enterprise do not find a place in the accounts.
It is a critical conceptual limitation for students to remember. Accounting is a powerful, necessary lens, but it acts like a pair of glasses that filters out everything except money.
Right.
It provides a financial picture, but it never provides the complete picture, which, again, is why subfields like HR and social responsibility accounting are desperately trying to evolve the framework.
It's a fascinating discipline because it is constantly striving to catch up with the complexity of human behavior.
It really is.
We have covered an immense amount of ground today. We have essentially rebuilt the entire theoretical foundation of accounting from scratch. Before we wrap up, let's do a comprehensive recap to solidify these concepts.
A quick synthesis is the best way to ensure long-term retention.
We started by looking at economic activities, noting that they apply to everyone from individuals to governments and can be for profit or for social benefit.
Right.
We then tackled the crucial distinction between actions and consequences. A transaction is the performance of an act, buying, selling, paying. An event is the consequence of those transactions making a profit or, crucially, having leftover inventory on the shelf.
Remember the baking analogy. Transactions are buying the ingredients and mixing the batter. The event is the baked cake.
We traced the evolution of the profession's definition. The 1961 era viewed it internally as an art of recording.
Yes.
But by 1966 and 1970, driven by complex corporate structures, it shifted outward, becoming a process focused on communicating data to help users make informed economic decisions.
Then we walk step by step through the 6-step accounting cycle, moving from chaos to clarity.
And we have our memory trick for that. Really cool students always impart clarity.
Recording the journal, classifying in the ledger, summarizing in the financial statements.
Then the analytical phase. Analyzing to find mathematical relationships, interpreting to extract the real-world business, meaning remember the Lego bricks, and finally, communicating those insights to the world.
We drew a hard boundary between bookkeeping and accounting. Bookkeeping is the foundational mechanical scope of recording and classifying.
Accounting is the broader analytical language that starts exactly where bookkeeping ends, culminating in the financial statements.
We took a massive historical journey, from the wazirs of 4000 BC Egypt to the Arthashastra in India, all leading to Luca Pacioli in 1494 Venice.
He codified double-entry bookkeeping, giving us the dual aspect rule that balancing requires both a creditor and a debtor.
We saw the discipline evolve from stewardship for feudal lords to financial for external shareholders to management for internal executives.
We explored the 5 modern branches: financial management, cost, social responsibility, and human resource accounting, each serving a unique informational need.
And we looked at exactly who needs that information. The internal managers, yes, but primarily the vast external ecosystem.
Investors managing risk, employees seeking security, lenders ensuring liquidity, and B2B customers desperate to know their supply chain won't collapse.
Finally, we acknowledged that while accounting integrates deeply with math, economics, and law, it has a fatal flaw. It is completely blind to non-monetary value.
An excellent comprehensive overview. Now, for anyone facing an examination on this material, I want to highlight a few specific traps that examiners rely on to test your true conceptual clarity.
Break them down for us.
Well, trap number 1 involves the stationary shop scenario. Examiners will give you a list of activities and ask you to classify them as transactions or events.
Students almost always get paying rent correct as a transaction and net profit correct as an event. But they consistently fail on closing inventory.
They assume because inventory is a physical thing, it must have been transacted.
They forget the cake.
Exactly. Burn this into your memory. Having closing inventory left on hand at the end of the accounting period is always an event.
It is the mathematical and physical result of the goods you purchased minus the goods you sold. Do not label it a transaction.
Leftover inventory is an event. What is the second trap?
Trap number 2 is a misunderstanding of the target audience for the different subfields. Because financial statements are generated internally, students often assume financial accounting is primarily for internal management use.
That is false.
Financial accounting is the primary, legally mandated vehicle for a company to communicate with external users, the investors, the banks, the government.
Management accounting, on the other hand, is the highly detailed, unregulated data generated strictly for internal executives. Do not mix up their primary audiences.
Financial faces the outside world. Management faces the inside boardroom. That is incredibly helpful.
This has been an intense, illuminating journey into the mechanics of the business world. But before we sign off, I want to leave you, the listener, with a final thought to mull over. Something that strips away the math and the rules and goes back to the very soul of what we've talked about today.
Let's hear it.
We spent time looking at Luca Pacioli, the friar who formalized the system during the Renaissance. He established the immutable law that for every creditor, there must be a debtor. The system demands perfect, unyielding balance.
Right.
But more profoundly, we looked at the etymology of the words he used. We learned that the word credit is built entirely on the Latin root credo, and credo means trust, belief, faith.
Yes.
We spend so much time looking at accounting as a cold, mechanical, boring system of rules, regulations, and legal compliance. We view it as a necessary evil of running a business. But if you look at its linguistic and historical core, it is something much more human and much more beautiful.
Yeah, it's a really powerful perspective.
So the next time you look at a dry corporate balance sheet or you are grinding through endless journal entries trying to study for a difficult exam, don't just see dead numbers on a page. Don't just see compliance.
Yep.
Realize that you are looking at a 6,000-year-old language refined over millennia by empires and mathematicians, designed entirely to measure and communicate human trust.
Trust is everything.
When a bank decides to give a small business a loan, when a talented employee decides to dedicate their career to a company, when a hospital relies on a pharmaceutical supplier, it all comes down to trust. And accounting is the only language we have that makes that invisible web of trust visible and measurable.
Well said.
So the ultimate question to ask yourself, whether you're trying to manage your own personal finances, studying for your final exams, or looking to build a global corporation one day, is this. When the accountants finally tally up all the transactions and events of your life's endeavors, well, how much trust does your future business actually hold?
That is a profound and entirely accurate way to view the language of business.
Thank you so much for joining us on this deep dive. We hope this has given you true conceptual clarity. Best of luck on your exams and in your continued exploration of the economic world. We will catch you on the next one.
If you, take the exact same box of financial receipts and hand them to 5 different accountants, there is a very real chance you will get 5 wildly different profit numbers back.
It sounds like a joke, honestly. Maybe the setup to a terrible corporate prank.
Yeah.
But it is actually the reality of how flexible financial data can be if you don't, establish a baseline.
I used to think accounting was just absolute unyielding math. 2 plus 2 is 4, right?
That is the common assumption, yeah.
But if one accountant says you made a massive profit, and the second says you broke even, and the third says you are on the verge of bankruptcy, and they're all using the exact same bank statements, then we aren't just dealing with math.
No, absolutely not. We are dealing with interpretation.
And without a unified rule book to govern that interpretation, accounting is basically just corporate fiction.
That is a great way to put it, corporate fiction.
Which is exactly why we are here today. Welcome to this deep dive into the source material. We have a highly specific, fundamentally crucial mission for you today.
Yes, we do.
We are taking a comprehensive textbook, Chapter Unit 2, theoretical framework, focusing on accounting concepts, principles, and conventions, and we are going to extract the absolute core of how the business world actually works.
I think that is the perfect way to frame it. Whether you are a complete beginner staring at a spreadsheet for the very first time, or, a founder trying to understand your own company's books, or even a student cramming for a make-or-break accounting exam, this deep dive is engineered to give you total conceptual clarity.
We want to make it stick.
Exactly. We are not here to memorize flashcards. We are here to understand the underlying logic, the actual why behind all these rigid rules.
So here's the dynamic for our session. Think of this as the most interactive, practical masterclass you could possibly attend. I am going to be the active learner and your guide.
Sounds good.
I will be raising the realistic doubts, the points of confusion, and trying to poke holes in the logic, just like you probably are in your head right now as you listen.
Yeah.
And you, my friend, will be our resident professor.
I am ready.
You will walk us through the mechanics, the pitfalls, and the practical applications of these rules. So let's unpack this. Let's start with that initial problem. We have 5 accountants coming up with 5 different numbers.
Right.
The business world clearly didn't collapse into total anarchy, so someone, somewhere, must have stepped in to create a universal language.
They did, and the intervention came in the form of a conceptual framework. You have to remember that accounting is fundamentally a communication tool.
Like a language.
Exactly like a language. The entire purpose of a financial statement is to communicate the economic reality of a business to outside stakeholders.
So we are talking about, like, investors risking their life savings, banks deciding whether to issue a huge loan, governments calculating taxes.
Precisely. And if every company speaks a different financial dialect, that communication completely breaks down. A bank wouldn't be able to compare a loan application from company A with company B.
That would be a nightmare.
Total nightmare. To prevent that chaos, the profession developed JEP's generally accepted accounting principles.
Okay, stop right there. The phrase generally accepted is what always trips me up.
How so?
Well, it doesn't say the universally mandated scientific laws of accounting. It says generally accepted. It sounds almost, I don't know, casual, like a dress code rather than a law of physics.
You have actually hit on the most important philosophical distinction in the entire field. Accounting is not physics.
It's not.
No. I mean, gravity exists whether human beings agree on it or not. If you drop an apple, it falls. But an accounting rule only exists because human beings sat in a room and reached a broad consensus that a specific method is the most useful way to measure economic activity.
Oh, wow. So they are totally constructed.
Entirely constructed. GAPs are the backbone of the accounting information system, but they are a human invention. Globally, there is a massive push to standardize this even further using frameworks like the International Financial Reporting Standards or IFRS.
Right, I've heard of IFRS.
But locally, countries still maintain their own distinct flavors.
The source material specifically notes that in India, companies use AS or NDS frameworks depending on their size and structure.
Yeah.
I imagine those local flavors exist because different countries have different tax codes, different economic priorities, different legal structures. You can't just ignore the laws of the country.
That is the absolute core of the issue. You can't just copy-paste a global rule book without adjusting for the legal reality of the country you are operating in.
Makes sense.
But underneath all those acronyms, whether it's JEEP, IFRS, or INDAS, the entire theoretical framework rests on three distinct pillars: concepts, principles, and conventions.
I am so glad we are stopping here because reading through the material, those three terms feel completely interchangeable.
They do bleed together if you aren't careful.
It is incredibly frustrating for a beginner. It all just sounds like rules. Can we carve out the actual defined boundaries between a concept, a principle, and a convention?
Let's build it from the ground up. The bedrock is the concepts. Accounting concepts are the most basic, universally applied assumptions.
Okay, assumption.
They provide the unifying structure and the internal logic for everything else. Think of them as the fundamental realities we have to agree on before we can even record a single transaction. They are the concrete foundation of the house.
So if the concepts are the concrete foundation of the house, where do the principles fit in?
Principles are the load-bearing walls built directly on that foundation. They're the specific doctrines and rules that guide current practices. But to graduate to the level of a true accounting principle, a rule has to pass a very strict 5-part test.
Okay, what is the test?
First, it must be based on real, observable assumptions. Second, it has to be simple, understandable, and explanatory.
Real and simple. Got it.
Third, it must be followed consistently. Fourth, it should help users make future predictions. And fifth, it must provide meaningful information.
Wow, okay. Real, simple, consistent, predictive, and informational. That is a high bar to clear.
It is designed to keep garbage rules out of the system.
So we have concepts as the foundation, principles as the strict structural walls, but then the source material introduces conventions.
Ah, yes. Conventions.
And it defines them as traditions that emerge out of accounting practices over a period of time.
Right. Conventions are the fascinating part of the framework because they are derived entirely from usage and habit. They aren't necessarily universal, and accountancy bodies actually have the power to change a convention if they find a better way to present information.
Let me challenge that structure for a second.
Go for it.
As someone trying to learn a rigid mathematical system, this feels like a massive loophole.
A loophole.
Yeah. I mean, we have these foundational concepts, we have principles that have to pass a rigorous 5-part test, and then we have conventions, which are just things accountants do out of habit. Isn't that just a fancy way of saying, we do it this way because we have always done it this way?
It totally looks like a loophole from the outside. Until you consider the reality of how business actually operates, business is not a static environment.
Right.
It is a highly aggressive, constantly mutating ecosystem. Human beings are inventing new ways to transact every single day. Just think about the last 20 years.
Yeah.
We saw the invention of software as a service, cryptocurrency, carbon credit trading, digital real estate.
Right. Things that literally didn't exist before.
Exactly. When a completely new type of economic event happens, there isn't a textbook principle ready to handle it. The rule book is always lagging behind the real world.
Oh, I see. So the accountants on the ground have to figure out a practical way to deal with the new reality immediately. Otherwise, they can't close their books for the month.
Precisely. They develop a practical workaround on the fly. And over time, as more companies face the exact same issue, they adopt that same workaround. It becomes a tradition, a
It's
convention.
an organic adaptation.
Yes. It allows the accounting profession to organically adapt to rapid changes. Eventually, regulatory bodies study that convention, they refine it, and then they formalize it into a strict principle.
You know, it's like an urban planning concept I read about called desire path.
Desire.
Yeah. When a city builds a park, they might lay down paved sidewalks in a nice, neat grid. But the pedestrians naturally realize that cutting diagonally across the grass is faster.
Right, human nature.
So they walk on the grass. Eventually, they wear a literal dirt path into the lawn. The city planners see this dirt path, realize it's what the people actually need, and they finally come in and pave it.
That is a phenomenal analogy. The convention is the dirt path. It is the
Right.
practical, habitual route. The principle is the paved sidewalk, formalized after the fact.
Okay, that clears up the structural hierarchy perfectly. Concepts, principles, conventions. Let's move from the structure to the actual content of the rulebook.
Let's do it.
Before we can even start doing the math on a business, we have to define what the business actually is. And that leads us to the very first major concept, the entity concept.
The boundary line.
Right. So let's say I decide to open a specialized coffee shop. I use my own personal savings. I sign the lease in my own name. I physically paint the walls myself, and I brew the coffee. Me and the coffee shop are fundamentally the same thing.
In a spiritual or emotional sense, perhaps, I'm sure you poured your heart into it.
I do.
And in a legal sense, if you are a sole proprietor, you and the business are indeed tied together for things like liability and taxes. But in the eyes of accounting, you're absolutely not the same thing.
Not at all.
Not at all. The entity concept is the ultimate boundary line. It states that a business enterprise has a separate, distinct, independent identity from its owner, period.
It feels incredibly counterintuitive. I birthed the coffee shop. I fund it. How can accounting just sever us?
Because if we don't sever you, the financial data becomes utterly useless. The entire goal is to evaluate the performance of the business. We need to keep the business affairs completely insulated from your personal financial chaos.
Okay, fair enough. My personal finances can be chaotic.
Exactly. Imagine we don't use the entity concept. At the end of the year, your combined bank account is up by $50,000. You might look at that and think, wow, the coffee shop is incredibly profitable.
Right, I'd be thrilled.
But what if you actually sold your personal car for $30,000 and inherited $25,000 from an aunt while the coffee shop itself actually lost $5,000?
Oh.
If the funds are commingled, you have zero visibility into the true operational health of the enterprise. You think you're succeeding, but the business is actually bleeding money.
I like to visualize this as the two wallets rule. Imagine you are wearing a pair of jeans. In your left pocket, you have your personal wallet.
Yeah,
In your right pocket, you have the business's wallet.
I like that.
The entity concept dictates that the moment money moves from the left pocket to the right pocket, a formal arm's-length transaction has occurred. The business treats you, the owner, as if you were a total stranger making an investment.
Yes. And take that logic one step further. If the business treats you like a stranger making an investment, how does the business view the money you just put into its wallet?
Well, it's my capital. It's the money I'm using to start the company.
Yes, it is capital. But here's the concept that usually flips a beginner's worldview totally upside down. From the perspective of the business, because the business is its own artificial person, that capital is a liability.
Wait, a liability?
A liability.
I have always associated the word liability with something negative, like a massive credit card debt or a mortgage. Why on earth is my own investment considered a liability to my own company?
Because you have to stay strictly within the perspective of the business entity. The business didn't generate that money on its own. You handed it to the business.
Right.
Therefore, the business owes you that money back. It is classified as risk capital. You took a risk, and in return, you hold a claim against the assets and future profits of the enterprise.
So the business owes me.
Exactly. The business entity's balance sheet is effectively saying, I currently hold $50,000 in cash, but I owe all $50,000 of it back to the owner.
That is wild.
This is the foundational philosophical premise of double-entry bookkeeping. The business always owes somebody, either an outside creditor or the owner.
That completely reorganizes how I think about a balance sheet. The business is just an empty vessel, and it has to account for every single drop of water poured into it, acknowledging who poured it.
Perfectly stated.
Let's ground this with a specific scenario provided in the textbook. We have Mr. X. Let's say you, the listener, are Mr. X. You decide to start a manufacturing business.
A big step.
You take 7 lakh rupees from your personal savings and put it into the business bank account. The business then buys machinery for 5 lakh rupees. The remaining 2 lakh rupees sits in the business cash register.
Okay, let's pause and look at the books. The business has 5 lakhs machinery, 2 lakhs in cash, and it acknowledges a 7 lakh rupee liability to Mr. X in the form of capital. Everything balances perfectly.
Right. But then, Mr. X realizes he forgot to pay his son's school tuition. It's 5,000 rupees, and it is due today.
A classic problem.
He happens to be standing next to the business cash register. He opens it, takes out 5,000 rupees, and goes to pay the school. How does the accountant handle this without calling the police on Mr. X?
Well, the accountant doesn't call the police because ultimately Mr. X is just withdrawing his own risk capital. He's taking his own money back. But the accountant must aggressively enforce the entity concept here.
How so?
The primary question the accountant asks is, was the son's tuition an expense incurred to generate revenue for the manufacturing business?
Obviously not, unless the son is secretly running the factory on his lunch break.
Exactly. It has zero economic benefit to the business. Therefore, it absolutely cannot be recorded as a business expense.
What happens if they do record it as an expense?
If the accountant recorded it as an expense, it would artificially lower the business's profit for the year. That distorts reality for anyone reading the statements, and it actually creates massive tax fraud issues because you are reducing your taxable income with personal expenses.
Yikes. So what do they call it instead?
The accountant records this as a withdrawal or drawings.
So walk me through the mechanical change on the books.
Sure. The business's cash balance drops from 2 lakhs down to 1,95,000. And simultaneously, the business reduces its liability to Mr. X.
Ah.
His capital account drops from 7 lakhs down to 6 lakhs 95,000. The boundary is maintained perfectly. The business's true operating expenses remain pristine and completely untouched by Mr. X's personal family obligations.
It's an elegant defense mechanism for the data.
Very elegant.
So now we have our boundaries drawn, we know who the business is, but that naturally leads to the next major question. We know who it is, but how long is this artificial person going to live?
The time continuum.
Exactly, which is governed by the going concern concept and the periodicity concept.
Going concern is arguably the most vital assumption we make about the future. The concept states that the enterprise has neither the intention nor the urgent need to liquidate or materially scale back its operations in the foreseeable future.
So we just assume it's immortal.
We act under the assumption that the business will essentially continue to operate indefinitely.
Okay, I have to play devil's advocate here.
I expected nothing less.
Statistically, a massive percentage of new businesses fail within the first 2 to 3 years. Why does accounting force us to build our entire financial framework on an assumption that is statistically very likely to be false?
It's a fair question. We make the assumption because the alternative makes day-to-day accounting impossible. To understand why, you have to look at how we value long-term assets.
Okay.
Let's say your manufacturing business buys a heavy-duty hydraulic press. It costs you $1 million. The manufacturer says it has a useful lifespan of 10 years. Because of the going concern assumption, we believe your business will be alive for the next 10 years to use it.
Right.
Therefore, we're allowed to take that $1 million cost and chop it up, recognizing a portion of the expense in each of the 10 years. We call that depreciation.
Oh, so we don't take the $1 million hit all in year 1.
Exactly. It accurately reflects the gradual consumption of the asset over time. It matches the cost to the years it is actually helping you build products.
I see. Let me try to break the assumption to see what happens.
Go ahead.
What if my business is severely struggling, and I know for a fact I'm going to have to shut down the factory and declare bankruptcy next month?
The moment you know you are shutting down, the going concern assumption completely evaporates. You are no longer a going concern, and the impact on your accounting is catastrophic.
Catastrophic how?
Well, you can no longer depreciate that hydraulic press over 10 years because you won't exist in 10 years.
That's true.
You are forced to abandon historical cost entirely, and you must immediately write down the value of that machine to whatever you could get for it in a desperate 30-day liquidation fire sale.
Which is probably pennies on the dollar compared to what I paid for it.
Exactly. Without going concern, every single balance sheet would just be a pessimistic list of pawn shop liquidation prices. It would completely mask the true operational value of the assets to a healthy, functioning company.
That is fascinating. The going concern rule is what allows a business to maintain stability in its reporting, rather than living in a state of constant, panicked liquidation anxiety.
It gives the business room to breathe.
But it does create a massive logistical headache. If we assume the business lives forever, and I want to know exactly how much profit my business generated over its lifetime, do I have to wait until the business eventually dies 100 years from now to do the final math?
That is the exact problem that the periodicity concept solves. Investors, banks, and management simply cannot wait for the ultimate liquidation of the company to find out if it was a good idea. They need feedback now.
Right. You need to know if you should invest more or pull out.
Exactly. So we artificially slice the continuous, immortal life of the business into periodic intervals. Usually this is a 12-month financial year, though public companies also slice it into quarters.
Got it.
We draw a hard line in the sand on December 31st or March 31st, depending on the country, and we say, stop the clock. Let's measure our performance within this specific arbitrary window of time.
It reminds me of running a marathon.
How so?
Well, the going concern concept is the belief that we are going to finish the 26.2 miles.
Oh.
We aren't planning on quitting. We are a going concern.
Okay, I track with that.
But the periodicity concept is checking our smartwatch at every single mile marker. We don't wait until we cross the finish line 3 hours later to realize our pace was too slow in mile 4. We need that periodic data to adjust our strategy in real time.
That is a perfect way to visualize it. And slicing time into these periods is what creates the necessity for the most complex and arguably the most important mechanics in accounting.
Which is the perfect transition. We know the entity. We have sliced its timeline into one-year periods. Now, how do we actually calculate the profit during that specific year?
This is where it gets real.
This is the core engine of accounting, driven by 3 heavyweight concepts: accrual, realization, and matching. If a listener only remembers one section of this deep dive, it should probably be this one.
I agree completely.
The textbook describes accrual as the absolute heart of modern accounting. Why is it so revered?
Accrual is revered because it breaks our dangerous psychological reliance on cash. Yes, because human beings are conditioned to think that an economic event only happens when cash changes hands. We think cash is truth.
Right, if I pay for something, it happened.
The accrual concept throws that out the window. It states that we must recognize the financial effects of transactions and events when they occur, regardless of when the actual cash is received or paid.
That is deeply uncomfortable for a beginner.
Yeah.
If I don't have the cash in my hand, did the event actually happen? Let's test this.
Let's do it.
Let's say I run a business-to-business software consulting firm. I spend all of November and December building a custom software architecture for a massive corporate client.
Okay, lots of work.
Lots of work. I finish the project on December 28th, and I email them the final files and the invoice for $100,000. But corporate payment cycles are slow. They don't actually wire the money into my bank account until February 15th of the next year.
Very typical scenario.
In which year did I make that $100,000?
If you are using cash basis accounting, which is how you run your personal checking account and how some very small micro businesses operate, you wouldn't recognize that revenue until February, when the cash actually cleared the bank.
Okay, but what under accrual?
Under the accrual concept, which is mandatory for virtually all meaningful corporate accounting, you earned that revenue in December.
Even though my bank account balance hasn't changed by a single penny.
Yes, because you fulfilled your economic obligation, you did the work, the transaction occurred. You have established a legally enforceable right to receive that money.
The economic event is the work, not the payment.
Exactly. Therefore, you record the $100,000 as revenue in December, and on your balance sheet, you create an asset called accounts receivable. It represents the economic value you generated, which is currently sitting in the form of an IOU from your client.
So accrual forces us to separate the economic reality of the event from the delayed logistical movement of the cash.
That's a great summary.
And I imagine this works in reverse for expenses, right?
Absolutely. If your employees spend December working on that software project, but your payroll cycle doesn't actually issue their paychecks until January 5th, you cannot pretend you had no labor costs in December.
Right. They did the work. I owe them.
You consume their labor in December, the economic event occurred. You must record the wage expense in December, creating a liability called wages payable until the cash actually goes out in January.
This makes so much sense. If we only tracked cash, a business could look wildly unprofitable one month and insanely profitable the next month, just based on the random timing of when clients decide to mail their checks.
It would look like a roller coaster.
Accrual smooths all of that out and matches the activity to the actual timeline of the work. But I can instantly see a huge risk here.
What's the risk?
If I can record revenue before I actually get the cash, what stops a desperate CEO from just projecting revenue? Like, oh, we had a great meeting with the client. I'm sure they will sign the $5 million contract next year. Let's just accrue $1 million of that revenue right now to hit our quarterly targets.
That exact vulnerability is why the accrual concept never operates alone. It is heavily guarded by the realization concept.
Realization.
Realization is the brake pedal. It dictates that no change in value should be recognized unless it has truly legally materialized. You absolutely cannot anticipate revenue.
So realization is like the bouncer at the club checking IDs. Accrual says, let's record it when it happens, and realization says, whoa, hold on, did it actually happen yet?
Exactly. Realization requires a critical event to take place. Usually this means the goods have been physically transferred to the buyer or the service has been fully rendered, and the legal transfer of risk and reward has officially occurred.
So a good meeting is not a critical event.
An optimistic sales meeting is not a critical event. Even producing 1,000 widgets and putting them in your own warehouse is not a critical event because you haven't sold them yet. Only when the sale is legally executed is the revenue realized.
Okay, so we have accrual capturing the timing of the event, and realization ensuring the event is legally valid. That brings us to the final piece of the profit engine, the matching concept.
The matching concept is where it all comes together.
The source text has this incredible brain-bending exam question about a businessman named Mohan that perfectly illustrates this. I want to try and solve Mohan's problem using only my layman's logic first, and you show me where I go wrong.
Let's hear the scenario. Let's see your logic.
All right, the year is 2022. Mohan decides to become a trader. He purchases a massive shipment of goods to sell. He pays 15 lakh rupees for these goods.
Okay, 15 lakhs out.
Throughout the year, he hustles and manages to sell 4/5 of that total shipment. He sells those goods for 18 lakh rupees.
Good for him.
During the year, he also has to pay for his warehouse rent, electricity, and basic operating expenses, which total 2.5 lakh rupees.
Yeah.
At the end of the year, Mohan does his accounting, and he proudly declares a net profit of 3.5 lakh rupees.
Okay, so net profit of 3.5 lakhs.
Now, if I am just a guy looking at the cash flowing in and out of Mohan's bank account, I think his math is totally delusional.
Walk me through your cash logic.
Let's look at the cash out. He spent 15 lakhs on the goods, plus 2.5 lakhs on expenses. That is 17.5 lakhs out the door. The cash in. He brought in 18 lakhs from the sales.
Right.
18 lakhs minus 17.5 lakhs is 50,000. By my logic, Mohan's profit is a measly 50,000 rupees. How on earth is he legally claiming a profit of 3.5 lakhs?
Yeah.
Is he committing fraud?
He is not committing fraud. He is applying the matching concept flawlessly.
Really?
Your logic is based entirely on cash flow, which, as we just discussed with accrual, distorts the economic reality of the specific period.
Okay, so how does matching fix it?
The matching concept states that the expenses incurred to earn a specific chunk of revenue must be recognized in the exact same period as that specific revenue. You must match the effort to the cost directly to the accomplishment, the sale.
So my mistake was dumping the entire cost of the shipment into the calculation at once.
Yes, that was the error. Let's do Mohan's math step by step using the matching concept. We always start with the accomplishment. What was the total realized revenue for the year?
He sold the goods for 18 lakh rupees.
Correct. Now, we have to find the specific effort, the cost that generated that 18 lakhs. Did he have to sell all 15 lakhs worth of goods to get that 18 lakhs?
No, the problem specifies he only sold 4/5 of his total stock.
That is the key. You cannot deduct the cost of the entire shipment because he didn't sell the entire shipment. You must match the cost of what was actually sold. So what is 4/5 of his original 15 lakh purchase cost?
4/5 of 15 is 12. So 12 lakh rupees.
That 12 lakhs is his cost of goods sold. It is the exact cost perfectly matched to the 18 lakhs of revenue. So 18 lakhs in revenue minus 12 lakhs in matched costs leaves a gross profit of 6 lakhs.
Wait, I have a glaring problem here.
What's the problem?
He paid 15 lakhs in cash to a supplier. We're only deducting 12 lakhs. What happens to the remaining 1/5 of the goods that cost him 3 lakhs? Do we just pretend that cash never left his bank account?
We don't pretend it didn't leave, but we recognize what that cash transformed into.
Transformed.
Yes, that 3 lakhs didn't vanish into thin air as an expense. It transformed into a physical asset. It is his closing inventory. It is sitting on a shelf in his warehouse, holding its value, waiting to be sold next year. It is not an expense this year because it did not generate any revenue this year.
Oh, wow. I see it now. If we allowed Mohan to expense the entire 15 lakhs this year, we would be severely artificially tanking this year's profits.
Precisely.
And worse, when he eventually sells that remaining 1/5 next year, it would look like pure 100% profit because we already expensed the cost the year before. The matching concept prevents a business from manipulating their profit just by stockpiling inventory at the end of the year.
That is the exact mechanism of prevention. So, returning to Mohan's math, we have the 6 lakh gross profit. Now we subtract his operating expenses for the rent and electricity, which were 2.5 lakhs.
6 lakhs minus 2.5 lakhs equals exactly 3.5 lakhs. Mohan was right.
Mohan was right.
The economic reality is that his trading operation generated a solid 3.5 lakh profit, even though his actual cash flow for the year felt tight because he chose to invest heavily in extra inventory. That is brilliant. Accrual, realization, and matching working together completely shift how you measure success.
They really are the trinity of the income statement.
So Mohan finishes the year. He has his 3.5 lakh profit. But we know he also has that leftover 1/5 of his inventory worth 3 lakhs sitting in his warehouse as an asset.
Right, his closing inventory.
That raises a massive new problem. As time goes on, how does Mohan prove what that inventory or any asset is actually worth on his balance sheet? How do we prevent management from just making up numbers to look good?
This brings us to valuation and caution, governed by the cost concept and conservatism. Let's tackle the cost concept first.
Okay, the cost concept.
The cost concept is designed specifically to prevent the kind of manipulation you just mentioned. It states that an asset is ordinarily recorded in the accounting records at the price paid to acquire it at the time of its acquisition. We call this the historical cost.
Historical costs.
We record the asset based on objective, verifiable, documentary evidence like a signed contract or a cleared invoice.
But historical cost feels incredibly archaic.
How so?
Well, if I bought a piece of commercial real estate in 1995 for $100,000, and today the market value of that prime real estate is $4 million, telling an investor my asset is only worth $100,000 feels like I'm hiding my true strength. Why can't I just update the value to match reality?
To understand why, look at the textbook's example of the Alpha Ltd trap.
Okay, the Alpha Ltd trap.
Alpha Ltd buys a heavy machine on April 1st for 10 lakh rupees. They pay another 1 lakh in installation charges. So the total historical cost to get the asset ready for use is 11 lakhs.
Got it. 11 lakhs historical cost.
Fast forward 1 year to March 31st. Management does some research and finds out that due to inflation and supply chain issues, the current market value of that exact machine is now 12 lakhs.
It went up.
The CEO wants to secure a bigger bank loan, so he tells the accountant, cross out the 11 lakhs and write down 12 lakhs on the balance sheet. We just made a 1 lakh profit by doing nothing.
And the accountant says no, because that violates the cost concept. But again, why? Isn't the CEO technically right about the market value?
He might be right today, but market values are notoriously subjective and incredibly volatile. Who determines that market value? An internal estimate? A random appraiser? What if market crashes next month?
That's true. Markets fluctuate.
If accounting allowed companies to constantly revalue their assets upwards based on subjective market estimates, the balance sheet would cease to be a document of record and would turn into a document of optimistic fiction. We use historical costs because it is the only anchor of absolute, verifiable truth we have.
It prevents the Enron scenario.
Wow.
I remember reading that one of the ways Enron committed massive fraud was through mark-to-market accounting.
Yes, exactly.
They would build a power plant, project how much money it might make over the next 20 years, and then immediately record all that future anticipated value on their balance sheet today. They completely abandon historical cost in favor of aggressive subjective valuation.
Precisely. The cost concept acts as a firewall against that exact type of hubris. And it's worth noting that while they hold the historical cost, they do systematically reduce it over time via depreciation, so the book value actually goes down, not up.
Okay, so the rule is stick to the hard cost. Do not recognize phantom gains just because the market went up. But what if the market goes down? What if disaster strikes? This introduces the counterbalance to the cost concept, which is conservatism, also known as prudence. The textbook calls this the accountant's golden shield. What is the doctrine of conservatism?
Conservatism is the psychological and ethical anchor of the accounting profession. It operates on a very simple, slightly gloomy maxim. Do not anticipate any future income, but provide for all possible losses.
Provide for all possible losses.
Mm-mm.
That sounds paranoid. Why is the rulebook designed to be so pessimistic?
It's not paranoia, it's an engineered counterweight. Think about the natural incentives of business management. A CEO wants to look successful to keep their job, attract investors, secure bonuses. Their natural instinct is to be overly optimistic to maximize asset values and minimize liabilities.
Right, they want to paint a pretty picture.
If the accounting rules were perfectly neutral, that inherent management bias would eventually drift the financial statements into dangerous overstatement. Conservatism exists to protect the end user, the investor, or the creditor.
It protects the people trusting the data.
Exactly. If there is uncertainty, and there are two equally valid ways to value something, conservatism legally requires you to choose the method that results in the lesser asset value or the lesser profit. We want to guarantee that a bank or an investor is never unpleasantly surprised by a hidden, unrecorded risk.
It's better to be pleasantly surprised that the company is richer than you thought, rather than being devastated to find out they're bankrupt.
Precisely. And this leads to what the textbook calls the golden rule of current assets.
How does conservatism dictate how we value inventory?
The golden rule for valuing inventory is cost or market price, whichever is lower. It is the direct practical application of the conservatism concept.
Let's put this to the test with the closing inventory trap example.
Go for it.
Imagine another trader buys a massive shipment of goods for 25 lakh rupees. He sells 80% of them. So the remaining 20%, his closing inventory, has a verifiable historical cost of 5 lakh rupees.
Okay, historical cost of 5 lakhs.
But then a massive technological shift happens in his industry. A competitor releases a vastly superior product, and the market demand for our trader's older goods just evaporates. The actual market value of his remaining inventory crashes to 4 lakh rupees.
Painful situation.
Now, the trader remembers his lessons. He points to the cost concept and says, hey, I have the invoice right here. I paid 5 lakhs. The cost concept says I recorded at historical cost. I'm keeping it at 5 lakhs on my balance sheet. Is he right?
He is dead wrong, and he is violating conservatism. This is where you see the fascinating tension between different concepts. The cost concept says stick to historical cost, but conservatism holds a trump card when it comes to anticipated losses.
Oh, trump card.
If the market value 4 lakhs drops definitively below the historical cost 5 lakhs, conservatism kicks in and overrides the cost concept. You must immediately recognize that 1 lakh loss in the current period, even though you haven't sold the goods yet. You must write the inventory down to 4 lakhs.
So it's essentially a one-way street. If the market value of your asset skyrockets, you ignore it. The cost concept wins, and you stay at the lower historical cost. But if the market value crashes, conservatism wins, and you must immediately record the loss to reflect the new, lower reality, whichever is lower.
It's brutally cautious.
Brutally cautious, yes.
Yes.
But it ensures that a balance sheet never, ever overstates the true economic utility of the assets a company holds.
Exactly.
Okay, let's take a mental breath.
It's a lot of information.
It is. We have covered incredible ground. We've separated the owner from the entity. We assumed the business lives forever, but sliced it into years. We built the profit engine with accrual, realization, and matching. And we established the cautious valuation rules of cost and conservatism.
The foundation is set.
Now, we are diving into the mathematical absolute of accounting, the dual aspect concept. What is the fundamental premise here?
The dual aspect concept is the underlying mathematical physics of double entry bookkeeping, which was formalized over 500 years ago by Luca Pacioli.
500 years ago.
Yes, it stood the test of time. It states a universal truth. Every single financial transaction, no matter how complex, has two distinct effects: a give and a take, a yield and a receipt. And because every transaction has two equal and opposite effects, there is a fundamental equation that must always remain in perfect balance.
What is the equation?
That equation is assets equals equity plus liabilities.
Assets equals equity plus liabilities.
Yeah.
Let's make sure we have the definitions locked in.
Okay.
Assets are the economic resources the business owns, cash in the bank, machinery, inventory, buildings.
Yes.
Equity, as we learned in the entity concept, is the claim the owner has against the business. It's the risk capital the business owes back to the founder.
Correct.
And liabilities are the claims that outsiders have against the business: bank loans, unpaid supplier invoices, taxes owed.
Spot on.
So mathematically, the equation is stating that everything the business owns, assets, was funded either by the owner equity or by borrowing from outsiders' liabilities.
Exactly. The total value of the resources must always equal the total claims against those resources. It is an immutable law.
Let's try to break the equation to see how it self-corrects.
Let's do it.
Let's say our coffee shop is doing well and we decide to buy a delivery van. The van costs 5 lakh rupees. But we don't want to drain our cash reserves, so we only pay 1 lakh in cash as a down payment, and we go to the bank and take out an auto loan for the remaining 4 lakhs.
Okay, a very standard transaction.
How does the dual aspect equation process this complex 3-part transaction?
We simply break it down side by side. Let's look at the left side of the equation first. The assets. What happened to our resources?
Well, first, we gain a brand new van worth 5 lakhs. So our total assets increase by 5 lakhs.
Right.
But to get it, we paid out 1 lakh in cash. Cash is also an asset. So our total assets decrease by 1 lakh.
What is the net effect on the left side?
Up 5, down 1. So the net change is the positive increase of 4 lakhs to our total assets.
Correct. Now let's jump across the equal sign to the right side. Equity plus liabilities. Did the owner inject any new personal money to buy this van?
No.
So equity remains unchanged. Did we borrow money from outsiders?
Yes, we took a 4 lakh auto loan from the bank. That is a new liability.
So the liability side goes up by 4 lakhs.
And there it is. The asset side increased by a net of 4 lakhs. The liability side increased by 4 lakhs. The equation remains in perfect, undisturbed balance. Every single transaction filters through this logic. It's like a self-healing mathematical organism.
Which is precisely why the core financial document of any business is literally called a balance sheet.
Amazing. Now, while we are on the topic of foundational rules, the textbook pulls out 3 specific concepts and elevates them to a very special category called fundamental accounting assumptions. Why do these 3 get special treatment?
They get special treatment because they are the default operating system of the accounting world. If a company publishes a set of financial statements, and the footnotes say absolutely nothing about the underlying rules they used, the reader, the auditor, and the government are legally allowed to assume that these 3 fundamental assumptions were followed.
You don't have to announce that you are using them. They are automatically implied.
Exactly. However, if a company decides for some reason not to follow one of these 3, they are legally required to explicitly disclose that deviation in bold print so everyone is warned.
Wow, okay. So what are the big 3 default settings?
We have already explored 2 of them deeply. Going concern, which is the assumption the business will not liquidate, and accrual, recording events when they occur, not when cash moves. The third assumption is consistency.
Consistency. I imagine this means using the same accounting methods year after year.
Yes. Accounting often offers choices. For example, there are a few different legally acceptable ways to calculate depreciation on a machine or to value your inventory. Consistency demands that once you choose a specific method in year 1, you must continue to use that exact same method in year 2, year 3, and beyond.
Why is that so strict?
If a company constantly changes its accounting methods every year, investors lose the ability to compare performance over time. A massive spike in profit this year might just be a sleight of hand trick caused by changing how they count inventory rather than an actual improvement in the underlying business.
That makes total sense, but a curious student might push back here.
Let's hear it.
If consistency is a strict fundamental rule, does that mean a company is locked into a bad decision forever? What if an industry evolves and a brand new, vastly superior accounting method is developed? Is the company trapped using an outdated, less accurate method just for the sake of being consistent?
That is a very common, very dangerous misconception. Consistency does not mean rigid, permanent inflexibility. You are absolutely allowed to change an accounting method, but the hurdle to do so is high.
Okay, so you can change.
You can generally only change a method under 3 circumstances. First, if a new statute or law requires it. Second, if a new accounting standard is issued by a regulatory body. Or third, if management can definitively prove that the new method will result in a significantly more accurate and transparent presentation of the financial reality.
So it has to be a clear upgrade.
Exactly. But, and this is the critical safeguard, if you do change methods, you cannot do it quietly.
Yeah.
You must fully disclose the change, explain exactly why it is better, and most importantly, quantify the financial impact that the change had on the current year's numbers. Consistency is about preventing sneaky manipulation, not halting the progress of better reporting.
Preventing sneaky manipulation, not halting progress. That is a great distinction. Now, for the students listening who need to lock these fundamental accounting assumptions into their brain for an exam, I came up with a simple mnemonic.
Let's hear it. Mnemonics are great.
To remember the big three, just think of the acronym GCA. Going concern, consistency, accrual. And the phrase to remember is, great CPAs agree. Great CPAs agree on GCA.
That is genuinely helpful. Great CPAs agree, going concern, consistency, accrual. I highly recommend listeners write that one down.
All right, let's pivot to the final major section of the framework, making data useful.
This is where theory meets reality.
We have established all these intricate rules. We know the math balances, we applied the cost concept, but here is the harsh reality. A company can have perfectly balanced math, follow every single JIC rule to the letter, and still produce a 200-page financial statement that is completely, utterly useless to a human being trying to read it.
It happens all the time.
The textbook lists a set of qualitative characteristics. Think of these as the ultimate filter for good information. The data isn't just about being mathematically correct, it has to be useful. Let's walk through these characteristics. First is understandability.
Understandability dictates that financial information must be presented in a way that is readily comprehensible to users. But there is a crucial caveat here.
What's caveat?
The accounting profession assumes that the user reading the statement has a reasonable knowledge of business and economic activities and is willing to study the information with reasonable diligence.
So they don't have to dumb it down to a third-grade reading level.
Exactly. Business is complex, and sometimes the accounting for it must be complex. But the rule means you cannot deliberately obscure important information in dense, convoluted jargon.
Right.
And crucially, you cannot leave out highly relevant, complex information simply by arguing, oh, we thought it would be too hard for the average investor to understand. If it is relevant, it must be included, and it must be presented as clearly as humanly possible.
Right. No hiding behind complexity.
Yeah.
The next characteristic is a paired concept, relevance and predictive value.
Information is relevant if it actually helps users evaluate past, present, or future events. The predictive value is the most important part of this. Why do investors read past financial statements? Not just for history, but to try and predict what the company will do next year. To help them, accountants must clearly separate normal, recurring operations from freak occurrences.
Give me an example of a freak occurrence.
Let's say a retail company makes a steady $1 million in profit every year from selling clothes. But this year, they decide to sell off their massive downtown headquarters building, generating a one-time gain of $20 million. Their total profit for the year is $21 million.
Wow. Huge jump.
If the accountant just slaps $21 million net profit on the front page without breaking it down, an investor might assume the company is suddenly experiencing explosive retail growth and project that forward. By separately disclosing the $20 million as an unusual or infrequent item, the accountant preserves the predictive value of the core $1 million retail profit.
That is vital context. Next is comparability. We touched on this with consistency. Investors need to compare a company against its own past, but also against its competitors in the same industry, which is why everyone needs to be using the same gaps.
Right, apples to apples.
But let's get into the mechanics of the next one. Materiality. The concept of materiality is basically the does it matter test. What determines the materiality threshold?
Materiality is a fascinating area because it requires immense professional judgment. The formal definition is that information is material if its omission or misstatement could influence the economic decision of a user. But how do auditors actually determine that threshold in the real world? It's not just a flat dollar amount. It depends on two intercepting factors: the size of the item and the nature of the item.
Break down the size aspect first.
The size aspect is relative to the specific company. For a small local bakery, a $5,000 accounting error might represent 20% of their annual profit. That is massively material. But for a multi-billion-dollar, multinational tech giant, A $5,000 error is a rounding error. It wouldn't change a single investor's mind. So auditors often use rules of thumb, like setting materiality at 5% of pre-tax profit or 0.5% of total assets, to determine what size errors they actually care about finding.
Okay, so a $10,000 mistake at a giant corporation might be deemed immaterial based on size. But what about the nature of the item?
This is where it gets serious. Let's say that same multi-billion-dollar corporation doesn't just make a $10,000 math error. Let's say that $10,000 was secretly paid as an illegal cash bribe to a foreign government official to secure a contract.
Oh, wow.
From a pure size perspective, $10,000 is still a rounding error. But the nature of that transaction, the fact that management is engaging in illegal, fraudulent behavior that could trigger massive federal investigations and destroy the company's reputation, makes that $10,000 incredibly material. The context supersedes the math.
That is a phenomenal distinction. It's not just about the size of the number, it is about the story the number tells. The next characteristic is one of my absolute favorites: facial representation and substance over form.
What's fascinating here is that this principle represents the philosophical soul of accounting. It dictates that accounting must record and present the underlying economic substance of a transaction, not merely its legal form. We care about the reality of the economics, not the cleverness of the paperwork.
How does that play out in the real world? I imagine lawyers can draft some pretty tricky contracts.
They absolutely do. Let's look at a classic example. A sale and leaseback agreement. Let's say a logistics company owns a massive fleet of delivery trucks. They need a huge injection of cash, but they can't get a traditional bank loan. So their lawyers draw up a contract to sell the entire fleet of trucks to a finance company for $10 million.
Okay, so they sold them.
But in the exact same meeting, they sign a second contract to immediately lease those exact same trucks back from the finance company for the next 10 years, which happens to be the remaining useful life of the trucks.
Tricky.
If we just look at the legal form, the logistics company sold their assets and are now just renting them. They don't own trucks anymore.
But logically, nothing changed.
Yeah.
They're still driving the same trucks, maintaining the same trucks, using them to deliver packages every single day, and they are locked into paying for them for their entire lifespan.
Exactly. The economic reality, the substance, is that the logistics company never truly gave up control or the risks of the trucks. They simply used the trucks as collateral to get a $10 million loan from the finance company.
So what does the accountant do?
Substance over form demands that the accountant ignores the legal illusion of the sale. The accountant keeps the trucks on the company's balance sheet as assets and records the $10 million not as sales revenue, but as a long-term debt liability. The reality trumps the paperwork.
That is profound. It's almost investigative. Next, we have neutrality. We talked about conservatism prudence earlier, which forces us to be cautious and provide for losses. But how does that square with neutrality, which says the information must be free from bias? Doesn't conservatism introduce a pessimistic bias?
It is a very delicate tightrope. Prudence dictates that you must be cautious when making uncertain estimates. However, that caution absolutely does not give management the license to deliberately understate assets or artificially inflate liabilities just to build up secret, hidden reserves of profit for a rainy day.
So you can't go too far in the other direction.
Right. That would violate neutrality. You cannot skew the numbers to achieve a predetermined result, even if that result is safety. The data must be honest.
Cautious when estimating, but strictly honest about the facts. And finally, full, fair, and adequate disclosure, also known as completeness, which essentially means tell the whole truth. If there is a massive pending lawsuit against the company that hasn't been resolved yet but could bankrupt them if they lose, you can't just leave it out of the financials because the judge hasn't ruled yet. You must fully describe the risk in the footnotes.
Completeness is the safety net that ties all the other characteristics together. It guarantees transparency.
So what does this all mean? When you step back and look at all these qualitative characteristics, understandability, materiality, substance over form, neutrality, you realize that accounting is significantly less about cold, robotic calculations and entirely about honest, transparent human communication. It's about painting a true portrait of the business.
And that portrait is what allows the entire global economy to function with trust.
All right, we have covered the entire theoretical framework. For everyone listening who is prepping for a test or just wants to lock this into their long-term memory, we are going to close out with an exam masterclass.
I love this part.
I'm going to throw some tricky true, false, and multiple choice scenarios straight from the source text at you, Professor. And I'm going to try and reason through them before you give the final verdict. Ready?
Bring them on. Let's see what you've learned.
Scenario 1. True or false? Accrual basis of accounting is the method of recording transactions by which revenues and costs are reflected in the accounts in the period in which actual cash is received or paid.
Okay, what's your reasoning?
Okay, my reasoning. The definition literally hinges on the phrase in which actual cash is received or paid. We spent a lot of time discussing how accrual specifically ignores the timing of the cash. So this statement has to be false. It is describing the cash basis, not the accrual basis.
Your reasoning is flawless. It is false. Accrual basis recognizes revenues and costs when the economic event occurs, completely independent of the cash movement. Examiners love to use this exact trick to see if you are paying attention to the word cash.
Got it. Scenario 2. This is a multiple choice about the dual aspect concept. If my business purchases a piece of machinery entirely for cash, what happens to my total assets? Does it A, decrease total assets, B, increase total assets, or C, retain total assets unchanged? Talk me through the math on this one. Let me think through the math. Dual aspect is assets equals equity plus liabilities. I am buying machinery, so my machinery asset goes up, but I am paying for it with cash, so my cash asset goes down by the exact same amount. I didn't borrow money, so no liability change, and the owner didn't invest more, so no equity change.
Correct.
So the left side of the equation went up by, say, $10,000 and down by $10,000. The net change is zero. Therefore, the answer must be C. Retain total assets unchanged.
Spot on again. The answer is C. It is a classic asset swap transaction. You simply exchanged one form of asset, highly liquid cash, for another form of asset, illiquid machinery. The total aggregate value of your assets did not move an inch.
That makes perfect sense when you break it down into the two parts of the transaction.
Yeah.
Okay, last one. Scenario 3. True or false? The materiality of an item depends solely upon the amount of money involved and not upon the size of the business or the nature of the transaction.
What do you think?
I remember our deep dive on this. A $10,000 mistake is immaterial to a huge corporation based on amount alone. But if that $10,000 was an illegal bribe, the nature of it makes it highly material. Therefore, saying it depends solely upon the amount of money is false.
You nailed it. It is false. Materiality is entirely contextual. It relies heavily on both the proportional size relative to the specific business and the qualitative nature of the underlying event. Context is everything.
And with that, we have conquered the theoretical framework of accounting.
We really have.
Let's do a massive sweeping recap of the journey we took today. We started with the chaos of the 5 accountants and realized why the world desperately needed the GAAP's rulebook to ensure communication. We drew the strict boundary line of the entity concept, separating the owner from the business, and realizing that from the business's perspective, the owner's capital is actually a liability, a debt owed back to the founder.
A crucial shift in perspective.
We established the time continuum, assuming, via going concern, that the business will live forever to allow for long-term asset depreciation, but using periodicity to slice that immortal life into 12-month chunks so we can actually measure progress. We rebuilt the core engine of profit, using accrual to record events when they occur regardless of cash, using realization as the bouncer to ensure the sale actually materialized, and using the matching concept to perfectly pair our expenses against the specific revenue they generated, preventing Mohan from artificially tanking his profit by hoarding inventory.
Profit engine.
We deployed the golden shield of conservatism to protect investors, forcing us to recognize all potential losses immediately, leading to the rule of valuing inventory at the lower of cost or market price. We proved the absolute mathematical truth of the dual aspect equation, assets equals equity plus liabilities. We reviewed the GCA fundamental assumptions, and we filtered all this data through qualitative characteristics to ensure it wasn't just accurate, but actually understandable, material, and deeply reflective of economic substance over legal form.
That is an incredibly comprehensive synthesis. If a listener grasps the why behind each of those points you just summarized, they have mastered the foundation of financial accounting.
And a quick reminder for anyone taking a test soon, use our memory trick for the fundamental accounting assumptions. Great CPAs agree. Going concern, consistency, and accrual. GCA. Write it on the top of your test paper the second you sit down.
Great advice.
Now, Professor, we have spent an hour dissecting the most technical, rigid rules of the business world. But you always like to leave us with something a bit more philosophical to chew on. What is your final thought for us today?
My final thought traces back to that profound concept of substance over form. We spend our lives surrounded by paperwork. We think of accounting, contracts, and business in general as just a series of cold, strict legal agreements. We are conditioned to believe that whatever is written on the paper is the reality.
Right.
But this accounting framework demands the exact opposite. It demands that the underlying economic truth must always trump the legal paperwork. If a contract is just a clever illusion designed to hide a completely different economic reality, like our truck lease example, the accountant is ethically bound to strip away the legal form and record the raw truth. And it makes you wonder, if the rigid mathematical world of accounting requires us to look past the paperwork to find the reality, how many other things in the corporate world or even in our daily lives are just illusions of form hiding a completely different substance? How often do we just accept the paperwork we are handed without ever questioning the true reality beneath it?
That is a brilliant lens to look through. The truth is in the substance, not the form. That is definitely something to mull over the next time you sign a contract, analyze a company, or look at a balance sheet. Thank you so much for joining us on this incredibly deep dive into the source material. We hope this has completely transformed how you look at the language of business. Until next time, keep questioning the numbers, look for the substance, and we'll see you on the next deep dive. Imagine this scenario for a second. You are a business owner. Let's say you run a mid-sized logistics company.
Okay, I'm picturing it.
Right. So it's a Tuesday, and you just spent $10,000 fixing this massive, gaping leak in the roof of your main distribution warehouse.
Ouch. That is a big check to write on a Tuesday.
Yeah, it hurts. But, you write the check, the roofers fix it, you move on. Then very next day, Wednesday, you spend another $10,000 buying a brand new, albeit small, delivery van to add to your fleet.
Okay, so another 10 grand out the door.
Exactly. From the perspective of your bank account, these are identical events, right? 10 grand went out the door on Tuesday, 10 grand went out the door on Wednesday. Your cash balance is exactly $20,000 poorer.
Right, the cash is just gone.
But here is where it gets really interesting. Because if you take these two, identical cash receipts to your accountant or your CFO, they are going to treat them like they came from two completely different universes.
Oh, absolutely.
In the financial world, those two $10,000 checks are handled entirely differently. And the question is why? Why does spending the exact same amount of money mean two completely different things on paper?
That is honestly the perfect question to start with. And the answer to that question is really the secret decoder ring for understanding how businesses actually measure their success, their value, their long-term viability.
Right.
It all comes down to the fundamental difference between what we call capital expenditures and revenue expenditures. And getting that distinction right isn't just some academic exercise. It is the absolute foundation of accurate financial reporting.
Exactly. And that is our mission today. Welcome to the deep dive.
Yeah.
Today we are taking a massive stack of foundational accounting rules and extracting the ultimate masterclass on how businesses actually track their money.
Yeah, we're looking at the hidden logic that dictates whether a company is actually thriving or, secretly going bankrupt.
Right. So if you are prepping for a major financial exam, or if you're an entrepreneur trying to understand your own books, or honestly, if you're just an insanely curious person who wants to know how the corporate world measures wealth, this is the bedrock.
It really is.
This is the logic of final accounts.
Yeah.
Getting this right is the key to not being tricked by complex financial scenarios, and more importantly, not making a catastrophic mistake in your own business operations.
It really is a high-stakes topic. I mean, when companies misclassify these expenditures, whether by accident or, and this happens a lot on purpose, it completely distorts their financial reality.
Wait, on purpose? Like fraud?
Oh, yeah. If you treat a routine expense as a long-term asset, you artificially inflate your profits. It's a classic trick.
Wow. Okay, so we're going to break down the theoretical frameworks, the real-world scenarios, and some brilliantly designed trick questions that test whether you truly understand the logic or if you are just trying to memorize a list of rules. We want to build a deep conceptual clarity.
Yeah, so we're not just going to read off a list of definitions. We're going to dissect this.
Exactly. You are going to provide the frameworks, the actual mechanics of the what and the why, and I am going to push back. I'll be throwing out realistic doubts, coming up with analogies, and constantly asking the wait, but why questions on behalf of everyone listening.
I love it. Bring on the pushback.
Because the goal here is true, long-term retention of these concepts. Let's unpack this starting from the very beginning. The engine of accounting and something called the matching principle.
The matching principle, yes.
Before we even define capital versus revenue, We need to understand the ultimate aim of accounting itself. The sources say the core goal is ascertaining and presenting the results of the business for a specific period. What does that actually mean in practice?
Well, in practice, it means that at the end of the year or the quarter or even the month, a business needs to be able to answer one very simple yet incredibly complex question.
Which is,
Did we make money or did we lose money?
right, the ultimate bottom line.
Exactly. And to get an accurate picture of that profit or loss, you have to analyze every single transaction. You have to categorize them. Because going back to your opening example with the roof and the van, not all spending is equal in terms of how it affects your current profitability.
Okay.
You have to figure out if the money you spent belongs in this year's calculation of profit or if it belongs somewhere else entirely.
See, if I just think about this logically, like without any accounting background, I would argue that if I spend cash today, shouldn't it just come out of today's profits?
I hear you. It seems intuitive.
Right. Like if I am running a small operation, let's say a neighborhood lemonade stand, and I spend cash today on lemons, sugar, and cups, and then I also spend cash today on a solid custom-built wooden stand.
Okay, the lemonade stand analogy. Let's
The
do it.
money left my pocket for all of those things today. Why overcomplicate it? Why not just say, I made 50 bucks in sales, I spent 40 bucks on lemons and wood, my profit is 10 bucks.
It is a very fair point, and what you were describing there is essentially cash basis accounting. Cash basis. Okay.
Yeah. Which works fine for a tiny, simple operation like a weekend lemonade stand. But for any meaningful business, cash accounting completely distorts the reality of your performance.
How so?
To understand why we overcomplicate it, we have to look at the matching principle. The matching principle is arguably the most important concept in all of accounting.
Really? The most important.
I'd say so. It states that expenses must be matched against the revenue they helped generate in a specific defined period. This is where the time factor becomes the ultimate judge of how we treat a cost.
The time factor. Okay, break that down for me. How does the passage of time judge my lemons versus my custom wooden stand?
Well, let's look at the lemons and the sugar first. You buy them, you squeeze the lemons, you mix the sugar, you sell the lemonade, and by the end of the day, those ingredients are gone.
Right, they're literally consumed.
Exactly. The economic benefit of that expenditure, the physical ability to make that specific batch of lemonade, expired in the current accounting period.
Okay, that makes sense. Because the benefit expired immediately, that cost is considered a revenue expenditure. It hits your profit and loss account, your P&L, immediately as an expense. You match the cost of the lemons against the revenue you made today.
Right, because I consumed the lemons to make the money today. The cause and effect are contained within the exact same day. That makes total sense.
Precisely. But now look at the wooden stand. You spent money on it today, let's say $100. Are you going to throw that wooden stand in the dumpster tonight?
No, definitely not. I built it well. I'm going to use it tomorrow, next week, all through the summer, maybe for the next 5 years.
Exactly. The economic benefit of buying that stand endures over multiple periods.
Endures, okay.
Yeah, because it generates enduring benefits, it is fundamentally different from the lemons. It is considered a capital expenditure. It does not go straight to your P&L as an expense today.
Wait, why not? I spent the money today.
Think about what would happen if you did. If you deducted the entire cost of the stand today, it would look like your lemonade business was massively unprofitable today.
Oh, I see. Because I took a $100 hit all at once against only 50 bucks of sales.
Exactly. And worse, it would look like you were wildly profitable next year because you'd be using a stand that you essentially pretended was free since you already wrote off the whole cost.
That completely skews the scorecard.
Right. Instead, capital expenditures go to your balance sheet as an asset.
So an asset is basically a resource I'm holding on to, something that holds future value, rather than money I just burned up to keep the lights on today.
That is a great way to conceptualize it. It is an asset. But, and here is the crucial part of the matching principle, it doesn't stay on the balance sheet forever.
It doesn't.
No. Since you are using it up slowly over 5 years to help generate lemonade sales, you take a little piece of that initial cost and you transfer it to the P&L as an expense each year.
Okay, so spreading it out.
Yeah, if it lasts 5 years, maybe you expense $20 a year. That process of systematically allocating the cost over its useful life is called depreciation.
Depreciation. Okay, I've heard that word a million times, but that actually makes it super clear.
So the ultimate takeaway here is this. If a cost benefits expire in the current period, it's revenue and it hits the P&L immediately.
Got it.
But if the benefits endure over multiple periods, it's capital, it goes to the balance sheet, and it is transferred to the P&L slowly over time as the benefit is physically or economically consumed.
So it's all about how long the thing you bought is going to help you make money. Revenue equals a short-term, expired benefit. Capital equals a long-term, enduring benefit. That clarifies the engine of accounting perfectly. We're creating a scorecard that reflects reality.
Yes, and that scorecard requires continuous maintenance. Revenue expenses are generally associated with the physical day-to-day activity of the entity.
Like your lemons.
Exactly. Production, marketing, and sales generate revenue, while the use of goods and services to support those functions causes expenses. It's a continuous, cyclical process. Separating capital from revenue is how we keep the scorecard honest.
Okay, I am firmly with you on the foundational logic. The time factor is the judge. Expired benefit versus enduring benefit.
Right.
But in the real world of corporate finance, I have to imagine the borderline between the two can get incredibly thin and blurry.
Oh, incredibly blurry.
Right, because it's not always as obvious as lemons versus a wooden stand.
Mm.
When a business makes a complex purchase, how do we actually decide?
That brings us to the operational frameworks. Because the real world is messy, accountants have developed 5 basic considerations, 5 golden rules, essentially, to help determine if an expenditure should be classified as capital or revenue.
5 golden rules.
Yeah, and if you want to be exam ready or business ready, you need to understand these 5 rules deeply, not just memorize them. I'll lay them out, and I want you to actively apply them.
I'm ready. Let's build this framework. What is rule number 1?
Rule 1 is the nature of the business.
Nature of the business.
Right. The exact same physical item can be a capital expense for one business and a revenue expense for another business, purely based on what the company does for a living.
Really? The exact same item?
Yep. The classic example is a piece of office furniture, like a large conference table. If a furniture dealer buys that conference table from a manufacturer, they are incurring a revenue expense, because to them, that table is inventory.
Oh, because they're going to turn around and sell it.
Exactly. It's meant for resale. But if a software tech company buys that exact same conference table for its boardroom, they are incurring a capital expense, because to them, it's an asset they will use for years to facilitate meetings.
Let me see if I can map that to another industry. So think about a car dealership.
Okay.
For a car dealership, buying a fleet of new cars is basically like a grocery store buying a pallet of apples. They buy the cars to sell them as quickly as possible. That's inventory, so that is a revenue expenditure.
Spot on.
But for anyone else, say a local plumbing company buying a van to visit clients, that car is a major operational asset that they intend to use for a decade. So for the plumber, it's a capital expenditure. The object is identical, but the nature of the business changes the accounting treatment.
That is a perfect analogy. To a dealer, cars are apples. The nature of the business dictates the nature of the asset. That is rule 1. You always have to ask, what does this company actually do?
Okay, rule 1 is locked in. What's next?
Now, rule 2 is the recurring nature of the expenditure. We look at the frequency or periodicity of the spend.
How often it happens.
Right. If an expense happens frequently and regularly within an accounting year, it is almost certainly an expenditure of a revenue nature. Conversely, a non-recurring expenditure, something infrequent that does not happen often, leans heavily toward being capital.
So things like paying my monthly office lease or running payroll for my employees every 2 weeks, those are highly recurring. They happen like clockwork to keep the business alive. That's revenue.
Exactly. Rent, salaries, utility bills, internet subscriptions, those are your classic revenue expenditures. You are maintaining the day-to-day operations.
Right.
But buying a new factory building or purchasing the patent for a new technology, that happens rarely. It's a major non-recurring event, so it's a capital expenditure. The frequency gives you a massive clue.
Got it. Rule 1, nature of business. Rule 2, recurring nature. What is rule 3?
Rule 3 is the purpose of the expenses. This is where we start looking at the intent behind the spending.
The intent. Okay.
Are you spending money on normal routine maintenance? Or are you spending money to fundamentally increase your productive capacity? Let's use the example of industrial machinery.
Okay. Picture a big factory machine.
Right. If you incur expenses to lubricate the gears, replace a worn-out belt, or do a standard annual tune-up, that is normal maintenance. You are just keeping the machine running the way it was designed to run. Such expenses are revenue in nature.
Just keeping the baseline intact.
Yes. On the other hand, if you incur a massive expenditure for a major overhaul or an upgrade that fundamentally increases the machine's speed or lifespan, that is capital in nature.
That makes intuitive sense. And honestly, it feels like it connects directly to Rule 4. Because if the purpose is an upgrade, then the effect is going to be different, right? What is Rule 4?
They are intimately linked, yes. Rule 4 is the effect on revenue generating capacity. This is perhaps the most critical rule of all.
The most critical. All right, let's hear it.
It asks the ultimate question. Does this spending help generate income now in the current period? Or does it permanently elevate your ability to generate income over multiple future periods? This is the core distinction between enhancement versus maintenance.
Enhancement versus maintenance. I really like that phrasing. That feels like a central pillar we need to emphasize.
It is the ultimate litmus test. Capital expenditure is incurred for the purpose of increasing the capacity of the business, or alternatively, to fundamentally reduce the costs of the business going forward.
So either making more money or permanently spending less.
Exactly. Revenue expenditure is incurred simply to maintain the current earning capacity. If an expenditure helps to generate revenue over more than one accounting period or fundamentally alters the cost structure for the better, you capitalize it.
And if it doesn't?
If you spend money on improvements and the expected future benefits from that asset do not change, meaning it just keeps doing what it always did, you charge it to the profit and loss account as a revenue expense. But if the expected future benefits increase, you add that cost to the book value of the asset on the balance sheet.
Let me test this with the delivery van example again.
Go for it.
If I take the van into the shop for a standard oil change and to replace the windshield wipers, that is pure maintenance. I'm just keeping it running as it always has. My revenue capacity has increased. I can still only make the same number of deliveries. So revenue expense.
Correct.
But what if the van's engine dies? And instead of just fixing it, I completely replace the engine with a brand new, highly efficient hybrid engine that cuts my fuel costs in half for the next 10 years. That is an enhancement. It permanently reduces costs and generates an enduring economic benefit. So capital expense.
Spot on. You are applying the enhancement versus maintenance test perfectly. Now, in the real world, determining the cost of maintenance versus an upgrade is not always simple, especially when a repair involves somewhat better parts than the original simply because technology has advanced.
Yeah, that makes sense. Like you can't even buy the old bad parts anymore.
Right, but asking yourself, does this enhance or maintain, is your best navigational tool. And this leads us to a crucial historical point. The temptation to intentionally misclassify these is huge.
Because if you classify an enhancement as maintenance, you take a big hit to your current profit.
Yeah.
But if you classify maintenance as an enhancement, you get to hide that expense on the balance sheet and your profit looks artificially high.
Exactly. And this isn't just theory. It has caused massive corporate collapses.
Wait, really? Like entirely because of this rule?
Yes. Look at the WorldCom scandal in the early 2000s. It was one of the largest accounting frauds in history, and it all centered around this exact rule.
Oh, wow. What happened?
So WorldCom was paying billions of dollars in routine line costs, essentially the fees they paid to other telecom companies to use their networks. These were classic recurring revenue expenditures required to maintain their day-to-day operations.
Like paying a giant phone bill. So that's Rule 2 and Rule 4 right there. Recurring and maintenance, pure revenue.
Exactly. But management realized that if they expensed them, their profits would plummet and Wall Street would punish their stock.
So what do? Did they pretend these routine fees were capital assets?
That is exactly what they did. They fraudulently reclassified billions of dollars of routine line costs as capital expenditures.
Billions. That's insane.
By doing so, they moved those massive expenses off the P&L and hid them on the balance sheet as assets. This artificially inflated their profits by billions of dollars, making the company look incredibly healthy when it was actually bleeding cash.
Oh my God. Just by changing a label from revenue to capital.
When the fraud was discovered, the company collapsed, wiping out billions in shareholder value. All because they violated Rule 4. They treated maintenance as enhancement.
That is wild. It just goes to show that this isn't just bookkeeping trivia. It's the architectural integrity of a company's financial reporting.
Yeah.
Okay, we have 4 rules down. Nature, recurring, purpose, and effect. What is the final rule?
Rule 5 is materiality. Materiality refers to the relative proportion of the amount involved considered in the context of the specific business.
Materiality.
It is a pragmatic rule. Accounting shouldn't cost more than the value of the information it provides.
Materiality. Does that basically just mean, is it a really big amount of money or a tiny amount of money?
In essence, yes, but the key word is relative. $1,000 is material to a kid running a lemonade stand, but it is entirely immaterial to a trillion-dollar company like Apple.
Ah, okay. context matters.
For a massive multinational corporation, buying a $1,000 office printer might provide enduring benefit for 5 years. Technically, under the matching principle, it's a capital asset.
Right, because it endures.
But the administrative cost of tracking a $1,000 printer on the balance sheet and depreciating it by $200 a year for 5 years is a waste of time. It's immaterial. So they will establish a materiality threshold. Say anything under $5,000 is automatically expensed immediately as revenue, regardless of its useful life.
Ah, so it's a practical shortcut. But for a tiny startup operating out of a garage, a $1,000 laptop might be a huge portion of their available cash. Is highly material to their financial picture, so they would capitalize it.
Exactly. The relative proportion of the amount involved is a vital consideration. So those are the 5 golden rules. The framework is complete.
Okay, as someone who wants to ensure I retain this for the long haul, I need a way to easily recall this list of 5. Let's look at the concepts. Nature, recurring, purpose, effect, materiality. N-R-P-E.
NRPEM.
Yeah, I've used mnemonics for this kind of thing before. How about never rush past every mistake? N for nature, R for recurring, P for purpose, E for effect, M for materiality. Never rush past every mistake. I think that works well because making a mistake on classifying these, as you pointed out with WorldCom, is a massive error.
Never rush past every mistake. That is an excellent retention tool. It anchors the 5 criteria to a practical warning. When you are looking at a transaction, pause and run it through that filter.
Run it through the gauntlet.
Check the nature of the business. Is it a recurring expense? What is the purpose maintenance or upgrade? What is the effect enhancement or just maintaining the status quo? And finally, consider the materiality of the amount. If you run a transaction through that gauntlet, you will almost always arrive at the correct classification.
Awesome. I feel armed with the theory. But knowing the rules and applying the rules are 2 different things. Let's move to section 3 of our discussion, the trick scenarios. Examiners and real-life business situations love to present edge cases that seem to break the rules. I'm going to throw some specific tricky scenarios at you from the source material to see how the frameworks hold up. Are you ready?
I am ready. Let's dissect them.
Scenario 1. Listen carefully to the wording here. Overhaul expenses of secondhand machinery purchased. Now, if I'm applying my logic, my doubt immediately flares up. The key word is overhaul, which is essentially a major repair.
Right.
And it's being performed on an old secondhand machine. We just established under Rule 3 and 4 that repairs to maintain a machine are revenue expenses. So an overhaul on a used machine has to be a revenue expense, right?
Ah, that is the classic trap. It is a very logical deduction, but in this specific context, you fell right into the snare. The answer is no, this is a capital expenditure.
Wait, how is that possible? How can repairing an old used machine be a capital expense? It's not a new asset.
The secret lies in the context of the purchase. You have to look at the timeline. The rule dictates that expenses incurred to put secondhand machinery into working condition to derive endurable long-term advantage must be capitalized.
Working condition.
Here is the logic. When you buy a broken-down secondhand machine, it is not currently generating revenue for you. You cannot use it in its current state. Therefore, the overhaul isn't maintaining its capacity. It is establishing its capacity for you in the very first place.
Yeah. I see the distinction because I just bought it. The baseline capacity for me, the new owner, is 0. I can't even turn it on.
Exactly.
Wow.
Any cost that is necessary to bring an asset to its intended location and ready it for its intended use is considered part of the cost of acquiring that asset. Therefore, the cost of the overhaul is considered part of the capital cost of the machinery itself.
Okay, that makes sense.
Now, if you had already owned that secondhand machine for 5 years, it was running fine, and then it broke down and you overhauled it just to get it back to its normal running state, then it would likely be a revenue expense. But because the overhaul happened immediately upon purchase to make it usable, it is capitalized.
That is a crucial nuance. The initial cost to get the asset ready for its intended use is always capital. Okay, you got me on that one. Let's try scenario 2, the legal fee trap.
Bring it on.
I have 2 situations involving lawyers, and we all know lawyers aren't cheap. Situation A. I pay significant legal fees to draft the contracts and transfer the title to acquire a new piece of commercial property.
Okay, property acquisition.
Situation B. I pay an amount as a lawyer's fee to defend a lawsuit where someone is claiming that my firm's existing factory site actually belongs to them. They both involve paying lawyers for property-related issues. Do we treat them the same?
They are completely different, and this is a brilliant test of Rule 4, enhancement versus maintenance. Let's look at situation A first, legal fees to acquire property.
The drafting of contract.
Right. When you buy a building, the physical structure isn't enough. You must secure the legal right to use it. You cannot own it without paying the lawyer to transfer the deed and ensure the title is clean. Therefore, the legal fee paid to acquire any property is fundamentally part of the cost of that property.
Because it's required for ownership.
Yes, it is an expenditure incurred to possess the ownership right. Without it, the asset isn't yours. Hence, it is a capital expenditure. It gets added to the value of the building on your balance sheet.
That tracks perfectly with the getting the asset ready for use rule we just discussed. The lawyer helped me establish the asset. But what about situation B? I am paying a lawyer to defend my own factory from a lawsuit. I'm fighting for my property. Surely that's capital.
No, situation B is a revenue expenditure.
Wait, really?
And here is the core accounting logic. Legal expenses incurred to defend a suit claiming that the firm's factory site belongs to someone else is considered a maintenance expenditure of the asset.
Maintenance? How is a lawsuit maintenance?
Think about the effect on your capacity. By spending money on this defense lawyer, are you gaining any endurable benefit in the future in addition to what you presently have?
Well, no. I already had the factory.
Is the capacity of the factory increased because you won the lawsuit? No. You are spending money simply to maintain your current status quo. You are protecting what you already have. Maintenance expenditure in relation to an asset, whether physical maintenance like fixing a roof or legal maintenance like defending a title, is a revenue expenditure.
That is fascinating. The exact same service legal advice is classified totally differently based on the effect. Acquiring something new creates a new asset. Protecting something old just maintains reality. That really solidifies the enhancement versus maintenance rule.
And it proves that you cannot rely on lazy heuristics. You can't just memorize legal fees always equal revenue expense. You have to critically examine the purpose and the economic effect of the transaction.
All right, scenario 3. Let's say a company decides to build a massive new cinema complex. During the construction phase, they spend a significant amount of money to construct temporary wooden huts on the job site for the construction workers to live in and store tools. These huts were absolutely necessary for the construction of the cinema.
Okay, necessary temporary huts.
But, crucially, as soon as the cinema was finished, the temporary huts were completely demolished and hauled away as trash. Now, since they are temporary and they were literally destroyed, they offer zero enduring benefit. Therefore, the cost of building those huts has to be a revenue expense. They didn't endure.
Another excellent trap. It sounds incredibly logical, but once again, the answer is capital expenditure.
How is that possible? They were destroyed. There is no asset left. How can you have a capital asset that is sitting in a landfill?
Your focus is too narrow. You are looking at the huts in isolation, but you need to look at the larger project, the cinema. The huts themselves were temporary, yes. But the accounting principle states that the cost of temporary huts constructed, which were necessary for the construction of the cinema house, is actually a part of the construction cost of the cinema house itself. Therefore, such costs are to be capitalized.
Because they were a necessary prerequisite to building the actual asset.
Exactly. The cinema house is the fixed asset that will provide enduring economic benefits for decades. Because the temporary huts were incidental to and strictly necessary for the main construction, their cost doesn't just vanish. It becomes absorbed into the total cost of the cinema.
So they basically become the cinema.
If you couldn't build the cinema without housing the workers, then housing the workers is part of the cost of the cinema.
That is a mind-bending concept.
Okay.
So the financial ghost of those destroyed huts lives on forever on the company's balance sheet, embedded within the value of the cinema building.
That is a poetic way to put it, but yes, it's entirely accurate. Any cost necessary to bring the main asset into existence and ready for its intended use is capitalized.
Okay, let's tackle the last scenario in this section. Scenario 4. The utility deposit. Let's say a business contacts a major local telecom company to install a dedicated fiber optic internet line and telephone system in their new office.
Getting connected.
Right. The telecom company requires a deposit of $8,000 before they will do the work. The business writes a check and deposits the $8,000 with the telecom. Is this cash outflow a capital expenditure or a revenue expenditure?
This is perhaps my favorite trick question because it tests whether you are locked into binary thinking. We've spent all this time debating capital versus revenue. The answer to this scenario is it is neither.
Wait, neither. It's not an expenditure at all, but I literally wrote a check. The cash physically left the company's bank account.
It did leave the bank account, but cash outflow does not automatically equal an expense. A security deposit is not an expenditure. Think about the nature of the transaction. You deposited money with a telecom, you haven't consumed any benefit yet, you haven't used any internet data or made any calls.
Right, I just gave them money.
Nor have you bought a depreciable asset like a server or a router. You have simply given them your money to hold as collateral. You have the right to get that money back eventually, or have it applied to future bills. Therefore, this deposit is treated simply as an asset on the balance sheet.
Oh, I am just swapping one asset for another. I traded cash for a receivable, the right to get my money back from the telecom.
Exactly. You created a liquid asset, which is cash, for a slightly less liquid asset, a deposit receivable. Your net worth hasn't changed. You haven't incurred an expense. This is a vital lesson. Do not fall for the cash out equals expense trap.
That's a huge trap to avoid.
This is why accounting requires critical thinking. You have to trace the economic reality of the transaction, not just the movement of the cash.
My mind is thoroughly expanded. We have meticulously tracked how money leaves the building. But a business is a two-way street. We need to apply this exact same rigor to the money coming in.
We absolutely do.
Let's transition to Section 4. The flip side, capital versus revenue receipts. I imagine we have to classify incoming cash just as strictly as outgoing cash.
Just as strictly. Because a clear distinction between capital and revenue expenditure is necessary to calculate profit accurately, right? Well, in the exact same manner, capital receipts must be distinguished from revenue receipts.
What happens if you get it wrong on the incoming side?
If you get this wrong, you can inadvertently tell the world you had a record-breaking sales year, when in reality, you just sold off half your company's assets to stay afloat.
Oh, wow. That's a terrifying thought. So lay out the core concept for me. What defines a revenue receipt versus a capital receipt?
It comes down to normal, operational business activities. Receipts which are obtained in the course of normal, day-to-day business activities are revenue receipts. These are the lifeblood of the business.
The day-to-day grind.
Right. If you are a retailer, receipts from the sale of goods are revenue. If you are a consultant, fees for your services are revenue. Even routine interest income on your bank balances is typically considered a revenue receipt.
So anything generated by the core engine of the business doing what it's supposed to do.
Yes. On the other hand, receipts which are not revenue in nature, meaning they do not come from your normal day-to-day trading activities, are capital receipts.
Like what?
These are usually related to financing the business or selling off long-term infrastructure. Examples include receipts from the sale of fixed assets like machinery or land, receiving funds from a secured or unsecured bank loan, or receiving capital contributions from owners or shareholders.
Okay, that seems straightforward enough. Normal sales equal revenue receipts. Selling off infrastructure or taking on debt equals capital receipts. Now, the foundational rules point out a critical mechanical distinction regarding how these hit the financial statements.
Yes, the P&L rule.
It states, revenue receipts are credited to the profit and loss account. Capital receipts are not directly credited to the profit and loss account. Why is that distinction so important? What happens if I mess that up?
It is the most vital mechanical rule for preparing final accounts without committing fraud.
Without committing fraud. Okay, you have my attention.
Let's say you receive a revenue receipt. You sell $10,000 worth of merchandise. That entire $10,000 goes straight onto the income side of your P&L, boosting your top-line revenue and ultimately your profit.
Great. More profit is good.
But let's look at a capital receipt scenario. Let's say your company owns a piece of heavy machinery. The machine currently has a book value on your balance sheet of $90,000.
Okay, $90,000 machine on the books.
You decide you don't need it anymore, and you manage to sell it to a competitor for $92,000. You receive $92,000 in cash.
Okay, here is where my instinct trips me up. I just deposited $92,000 in cash in my bank account. If that money doesn't go onto my P&L to boost my income, where does it go? I want my profit to look as high as possible.
It doesn't vanish, but you absolutely cannot put the entire $92,000 into your P&L as income. Think about the economic reality. When you sell a fixed asset for $92,000 that has a book value of $90,000, the total capital receipt is $92,000. But if you put $92,000 as revenue on your P&L, you are lying to your investors.
Because I had to give up a massive asset to get that cash.
Exactly. You surrendered a machine worth $90,000 to get $92,000 in cash. Therefore, only the profit on the sale of the fixed asset is calculated and credited to the profit and loss account.
So just the difference.
Yes, the calculation is simple. Sale proceeds of $92,000 minus the cost or book value of $90,000 equals a net gain or profit of $2,000. Only that $2,000 profit goes to your P&L.
So the remaining $90,000 isn't income at all. It's just the business recovering the value of the asset it already owned.
Precisely. The $90,000 is simply converting a physical asset, the machine, back into a liquid asset, cash. It's a return of your capital. Only the $2,000 is a return on your capital.
Return of versus return on. I like that.
If you artificially inflated your revenue by claiming the whole $92,000 was income, you would be deeply misleading anyone reading your financial statements. That is why capital receipts in their entirety never go directly into the P&L. Only the calculated gain or loss on the transaction does.
That distinction is huge. Return of capital versus return on capital. Let's run through a couple more scenarios regarding receipts just to lock this in. What if a company issues new shares of stock to the public to raise money? And because the company is highly sought after, investors pay a premium above the face value of the shares. Let's say they receive an extra $100,000 as a share premium. Is that premium considered a revenue receipt because it's extra money?
No, it is a capital receipt.
It is. Why?
Issuing shares is not your day-to-day operational business activity. It is a financing activity. It is how you raise the foundational capital to fund the business structure. Therefore, any premium you receive on those shares is inextricably tied to capital generation, not operational revenue generation.
So he doesn't touch the P&L.
Exactly. It does not hit the P&L as profit. It goes straight to the equity section of the balance sheet.
Makes sense. It's owner money, not customer money. What about a fixed deposit at a bank? Let's say a business invested excess cash in a long-term fixed deposit. The deposit matures, and the bank transfers $500,000 to the business. Also, the bank pays an additional $40,000 in accumulated interest. How do we break down this incoming cash?
This is a great example because it combines both types of receipts in a single banking event. You have to unbundle them.
Unbundle them. Okay, let's do it.
The $500,000 received on the maturity of the fixed deposit is simply the recovery of the principal amount you originally invested. It is a return of your capital. Therefore, it is a capital receipt. You are moving cash from a restricted asset, the deposit, back to your main checking account.
But the $40,000.
However, the $40,000 in interest is the money your asset earned for you over time. It is a return on your capital. Therefore, the interest income is a revenue receipt.
So they get split up. The $40,000 goes to the P&L to boost my income for the year, but the $500,000 just rearranges the deck chairs on the balance sheet.
Perfectly stated. Rearranging the deck chairs.
All right, I am feeling very confident about distinguishing pure receipts and pure expenditures. Now it's time to step into the deep end. Section 5, Advanced Mixed Scenarios.
The masterclass level.
Exactly, because in real corporate environments, and definitely on advanced professional exams, you rarely get clean, single-issue transactions. The real world mixes capital and revenue elements into a single complex project, and you have to act like a forensic accountant and untangle them.
This is where true mastery is tested. We are going to look at a comprehensive scenario. Let's call it the cinema construction mix-up.
Okay, I'm ready.
Imagine a company, Good Pictures Ltd., is undertaking a massive project to open a new cinema. They provide their accountant with a list of expenses, and we have to sort them out point by point.
Okay, here's the first messy detail from Good Pictures Ltd. To outfit the lobby, they purchased secondhand furniture for $9,000. But the furniture looked terrible, so they immediately spent $1,000 to have it completely repainted and restored.
Okay, $9,000 purchase, $1,000 restoration.
Finally, to get it set up in the lobby, they used their own internal maintenance workmen to move and install it, and they calculated that the wages paid to those specific workmen for the time spent on installation amounted to $200.
Internal wages of $200.
Yeah.
Got it.
So we have an initial purchase, a restoration repair, and internal employee wages all tied to one event. How do we sort this out?
We rely on Rule 4, getting the asset ready for its intended use. We apply the exact same logic we used for the overhauled secondhand machine earlier. The goal is to determine the true total cost of the furniture asset.
Right.
The initial purchase of $9,000 is clearly capital. The $1,000 for repainting isn't routine maintenance. It's a necessary restoration to bring secondhand goods up to a usable standard for a new business. So that is also capital.
But what about the internal wages? That's the part that really trips me up.
Why is that?
Because if I am thinking critically, Wages paid to your own employees are the textbook definition of a recurring revenue expense. We literally established that under Rule 2. Why wouldn't that $200 just stay in the normal payroll expense account?
It's an excellent pushback, but it ignores the purpose of that specific labor. Yes, general wages are a revenue expense. But in this highly specific instance, those internal wages were directly incurred in bringing a fixed asset into working condition and placing it in its intended location.
I see.
If you had hired an outside moving company to install it for $200, you wouldn't hesitate to capitalize that delivery fee.
Right. Delivery and installation fees are usually added to the cost of the asset.
Exactly. The accounting principle is neutral on whether you use external contractors or internal labor. The purpose of the expenditure dictates its treatment. Therefore, the total cost of the furniture to be capitalized is $10,200.
$9,000 plus the $1,000 plus $200.
Yes. If the company's bookkeeper had lazily debited the $1,000 to a general repairs account and the $200 to a general wages account on the P&L, you, as the expert accountant, would have to pass a journal entry to credit those revenue accounts and move that $1,200 over to the capital furniture account on the balance sheet.
That is brilliant. You cannot let the superficial label of wages blind you to the underlying economic purpose of the work. You have to follow the economic intent. Okay, let's look at the next part of the cinema mix-up. The company incurs a tangle of 3 different fees regarding regulations.
Regulatory fees, always fun.
Right. First, they pay $20,000 in expenses to obtain the initial license from the city to legally run a cinema. Second, during their first few months of operation, they violate a noise ordinance and are fined $1,000 by the city.
Oop.
Third, at the end of the year, they pay a $2,000 renewal fee to keep their license active for the next operating year. 3 payments to the government. Let's tag team this. You take the first one, the $20,000 initial license.
The initial license is relatively straightforward if we apply our frameworks. You cannot legally operate a cinema without that license. It is a fundamental, non-recurring prerequisite to bring the business into existence.
Non-recurring.
Therefore, the cost to obtain the initial right to operate is a capital expenditure. It represents an intangible asset, the legal right to do business.
Okay, that makes sense. Now, what about the $1,000 fine for violating the noise ordinance? If I apply the enhancement versus maintenance test, a fine definitely does not build an asset.
Definitely not.
It certainly doesn't enhance the capacity of the cinema to show movies. It is simply a penalty incurred during the normal, albeit careless, operation of the business. It provides 0 future economic benefit. So the fine must be a revenue expenditure. It's a pure sunk cost that hits the P&L.
Perfect analysis. A penalty never creates an asset. Now, what about the final piece? The $2,000 renewal fee paid for the next year's license.
Well, it's recurring, so it's not capital. It's required to maintain operations, so it's a revenue expenditure.
Yeah.
But wait, the matching principle says we have to match expenses to the period they benefit. This fee was paid this year, but it's for the next year.
You've hit the nail on the head. This introduces the concept of a prepaid expense. It is inherently a revenue expenditure because it's a routine recurring maintenance cost.
But the timing is off.
Exactly. However, because of the time factor, the benefit hasn't been consumed yet. So at the end of the current year, it sits on the balance sheet as a current asset, a prepaid expense. Then, when the next year begins, it is transferred off the balance sheet and onto the P&L as a revenue expense.
Wow. So that one paragraph tested capital expenditures, revenue expenditures, sunk penalties, and the timing mechanics of prepaid assets all at once. That is a fantastic exam question.
It really tests your complete understanding.
Let's look at another advanced scenario from a different industry. The efficiency upgrade versus the expansion. Let's say a transportation company has 2 different scenarios involving their vehicle engines.
Okay, vehicle engines.
In scenario A, they notice an engine is running poorly, so they change the rings and pistons at a cost of $5,000. And as a result, the engine achieves significantly better fuel efficiency than it ever had before.
Better than ever before. Key phrase.
Right. In scenario B, they take a different vehicle and perform a massive complete overhaul of the engine for $25,000, also resulting in significantly better fuel efficiency. My question is, are these treated differently because one is a relatively minor $5,000 part replacement and the other is a massive $25,000 overhaul?
This is a classic trap designed to test whether you are evaluating the underlying economic principle or if you are just being swayed by the size of the dollar amount.
The size definitely sways me.
It does for most people, but remember Rule 4, enhancement versus maintenance. Let's look at the $5,000 rings and pistons. The key phrase in this scenario is that it resulted in significantly better fuel efficiency than it ever had before.
Right, it's an improvement.
Exactly. This means it's not just a repair, it is an improvement. It fundamentally reduces the running costs of the business going forward. Therefore, it is an enhancement and it must be capitalized.
And the $25,000 overhaul.
The exact same logic applies. The massive overhaul was also performed to derive better fuel efficiency, which will reduce future running costs and provide an endurable long-term advantage. Therefore, this expenditure must also be capitalized.
Wow, so they're both capital.
Yes. The critical lesson here is that scale is irrelevant to the classification. Whether you spend $5,000 or $25,000, if the effect is enduring enhancement and cost reduction, they are both classified as capital expenditures.
That is a great lesson. Don't be fooled by the price tag. Look strictly at the economic effect.
Yeah.
Okay, here is one more mixed scenario. Let's call it the cabin renovation.
Let's hear it.
A busy restaurant decides to spend $20,000 renovating its dining area. The area previously had 10 old, large private dining cabins. During the renovation, they tore down the walls and reconfigured the space so that the exact same square footage now contains 13 slightly smaller private dining cabins. How do we classify that $20,000?
Walk me through your thought process based on what we've learned.
Okay, well, if they had just spent $20,000 to put fresh paint and new carpets in the existing 10 cabins, I would classify that as routine maintenance. They're just making it look nice to maintain their current operations. That would be a revenue expense.
I agree with that.
But that's not what they did. They fundamentally reconfigured the space. Because the number of cabins increased from 10 to 13, their future capability to seat multiple different groups of customers simultaneously has fundamentally increased.
Exactly.
Even though the square footage is the exact same, the revenue-generating capacity of that space has been permanently expanded. This is a clear enhancement of capacity. Therefore, the renovation costs must be a capital expenditure.
Outstanding. You have completely internalized the framework. The physical footprint didn't change, but the economic capacity did. You applied the enhancement versus maintenance test perfectly.
All right, I feel like we have run a mental marathon of accounting theory today. But before we wrap up, I want to ensure this is completely locked in for our listeners. We are going to move to Section 6, the final exam walkthrough.
The final exam, let's do it.
We are going to do a rapid-fire testing of everything we've covered. Listeners, I want you to treat this like a real exam. When I read the scenario, pause and try to answer it in your head before the expert breaks it down.
Rapid-fire application. I'm ready.
Question 1. A manufacturing company sends its board of directors on a trip abroad to inspect and purchase a massive new robotic assembly line. The company spends $10,000 on their flights and hotels. Are these travel expenses considered a capital expenditure or a revenue expenditure?
It is a capital expenditure.
Really? Travel.
Now, under normal circumstances, business travel for executives is a classic operational revenue expense. However, you must look at the purpose. This specific trip was exclusively necessary and incidental to the acquisition of a major capital asset.
Ah, getting the asset ready for use.
Yes. Without the trip, they wouldn't have acquired the robotics. Therefore, following the principle of getting the asset ready for its intended use, the travel costs are capitalized and added to the cost of the new machinery.
Question 2. A renewable energy startup is struggling with cash flow. They apply for and receive a $40,000 subsidy grant from the government, specifically designated to help them cover their payroll and utility bills, their working capital. Is this $40,000 a capital receipt or a revenue receipt?
It is a revenue receipt.
Because it's for payroll.
The defining phrase in the scenario is for working capital. Working capital, by definition, is used to fund day-to-day operations. A government grant or subsidy provided specifically to subsidize daily operations or compensate for operating losses is treated as operational income. Therefore, it hits the P&L as a revenue receipt.
Question 3. A corporation decides to downsize its workforce. They offer a voluntary retirement package, and they end up paying out a massive total of $25 million in severance compensation to the workers who chose to leave. Is this $25 million a capital expenditure or a revenue expenditure?
This is a scenario where the sheer size of the number tricks people. $25 million sounds like a capital event, but it is entirely a revenue expenditure.
$25 million hits the P&L.
Yes. We have to go back to the fundamental definition of an asset. An asset must provide a future economic benefit to the enterprise. When you pay employees a severance package to leave the company, you are terminating their employment.
So there's no future benefit.
By definition, they will provide zero future economic benefit to you. You are not creating an asset. You are settling a liability or incurring a massive operational cost to reorganize. Therefore, despite the massive price tag, it is a revenue expense that will take a huge chunk out of the current year's P&L.
That is a painful reality for a company's bottom line, but the logic is unassailable. And now for the final boss of our deep dive, the ultimate math question.
Let's hear it.
I'm going to read a list of expenses relating to a factory building that is currently in use. Listeners, get a mental notepad and keep a running tally. Here are the 4 expenses incurred during the year. First, routine repair costs to fix broken windows and doors, $25,000. Second, expenses to completely whitewash and paint the exterior of the building, $5,000. Third, the cost to build a new physical extension onto the back of the building to house more inventory, $250,000. Fourth, the cost to rip out the old electrical wiring and install a vastly improved high-capacity electrical system to support heavier machinery, $19,000.
Okay, I have the 4 numbers.
The exam question is, what is the total amount to be expensed to the profit and loss account for the year?
Let's break this down systematically, applying our rules line by line. We have to separate the maintenance items from the enhancement items. Let's start with the first item. Repair costs of $25,000 for windows and doors.
Okay, fixing broken windows.
Fixing broken items on an existing building is the definition of maintaining its current condition. It adds no new capacity. Therefore, it is a revenue expense.
Okay, so we put $25,000 into our mental P&L bucket. Next, the whitewash and painting expenses of $5,000.
Whitewashing or painting an existing building is routine, periodic maintenance designed to preserve the structure and appearance. It is not an upgrade, so that is also a revenue expense.
All right, add that to the bucket. Our P&L total is now at $30,000. Next, the cost of the building extension for $250,000.
An extension physically adds square footage to the factory. It fundamentally and permanently increases the physical capacity of the asset to hold inventory or machinery. That is a textbook enhancement, therefore it is a capital expenditure.
So that massive $250,000 goes straight to the balance sheet bucket. It does not hit the P&L as an expense today. Finally, the cost of the improved electrical system for $19,000.
The vital keyword in that description is improved and high capacity. They didn't just fix a broken wire, they ripped out the old system and installed something superior that allows the building to handle heavier machinery than it could before.
An upgrade, basically.
Exactly. This increases the operational capability of the building. It is an enhancement. Therefore, it is a capital expenditure.
Okay, so the $19,000 also goes to the balance sheet. Now, going back to the core question, what is the total amount to be expensed to the P&L? We only have the repairs and the whitewash in the P&L bucket. That's $25,000 plus $5,000. So the final definitive answer is $30,000.
Exactly correct. And this demonstrates exactly how exams and financial audits work. If a student rushed and simply added all 4 numbers together because they all related to the building, they would arrive at $299,000 and completely fail the question.
And completely misstate the profits of the company.
Exactly. You have to evaluate every single line item on its own individual merits, applying the framework of enhancement versus maintenance.
That was intense, but incredibly clarifying. By breaking it down piece by piece, the logic becomes undeniable. We have reached the end of our deep dive. Let's do a quick, punchy recap to solidify everything we've learned today. We've established that the distinction between capital and revenue isn't just bureaucratic red tape. It is the fundamental architectural bedrock of accurate financial reporting. If you get this wrong, your measurement of profit is entirely fictitious.
To summarize the core rules we've discussed, revenue expenditures relate to the short term. They are about routine maintenance, the consumption of resources, and keeping the normal day-to-day business operations running. They hit the profit and loss account immediately because their economic benefit expires quickly.
Right, like the lemons.
Yes. Capital expenditures, on the other hand, relate to the long term. They are about enhancements, upgrades, and acquiring or building new assets. They sit on the balance sheet to build the company's net worth, and their cost is recognized slowly over time through depreciation.
And for all you exam candidates and business owners out there, do not forget the diagnostic framework we developed today. Remember the acronym NRPEM. Never rush past every mistake. Always analyze the nature of the business, the recurring nature of the spend, the purpose of the activity, the ultimate effect on capacity, and the materiality of the amount. And when in doubt, rely on the ultimate sniff test, enhancement versus maintenance. Ask yourself, is this spending just keeping the lights on today, or is it permanently building a brighter, more efficient bulb for the future?
That is the perfect way to encapsulate the entire lesson. Mastering this distinction gives you a superpower in reading financial statements and understanding business health.
But before we let you go, we want to leave you with a final provocative thought to ponder. We have spent the last hour talking heavily about physical, tangible assets. Wooden lemonade stands, cinema huts, delivery vans, secondhand machinery, factory extensions. But the modern business world is changing at breakneck speed, especially when it comes to technology and infrastructure.
It is a massive paradigm shift. So, here's a thought experiment for you to chew on. For decades, if a large company wanted to build a massive IT infrastructure, they had to buy huge, physically expensive computer servers. Purchasing those servers was a classic textbook capital expenditure.
Right. Millions of dollars on hardware.
Exactly. Millions of dollars went onto the balance sheet as assets and were depreciated slowly over 5 or 10 years. But today, in the modern digital economy, businesses are abandoning that model. Instead of buying physical servers, they are migrating to the cloud. They are paying monthly subscription fees to tech giants to use their remote servers.
And because those monthly cloud fees are recurring, and because the benefit expires at the end of the month if you stop paying, those fees are entirely operational. They are pure revenue expenditures.
Exactly. So think about the profound implications of what we've learned today applied to this shift. We are witnessing a massive global transition where trillions of dollars are moving away from capital expenditures on physical hardware and shifting into revenue expenditures on software and cloud subscriptions. How might this massive shift from CapEx to OpEx fundamentally alter how profitable companies look on paper? A company today might be doing the exact same work, utilizing the exact same amount of computing power as they did 10 years ago, but because they swapped capital assets for revenue subscriptions, their entire P&L and balance sheet look completely different.
That is a brilliant and slightly terrifying question to end on. It changes the whole shape of corporate valuation. It means that comparing the financial statements of a tech company from 2010 to a tech company in 2026 requires you to fundamentally adjust your lens. It's something for you to mull over next time you look at a modern company's financials. Thank you for joining us on this incredibly deep dive today. Keep questioning the numbers, keep looking for the underlying economic reality, and we'll see you on the next one.
Until next time.
You know, usually when we talk about a diagnosis, whether it's in medicine or in something as structured as a business, there's this expectation of total precision.
Right, like it's supposed to be completely exact.
Exactly. It's supposed to be like engineering. I mean, you break your arm, the x-ray shows that jagged white line, and the doctor just points at the screen and says, well, there it is.
Yeah, it's completely binary. Like the bone is either broken or it isn't.
Right. It's clean.
Yeah.
And as humans, we really crave that. We want things to be visible, perfectly categorized, and, quantifiable, so we know exactly where we stand.
Oh, absolutely.
But then you step into the world of corporate financial reporting, specifically this landscape of predicting future financial outcomes based on past events, and suddenly that x-ray machine is completely useless.
Yeah, you aren't looking at a clear break anymore.
Not at all. You are looking at a diagnostic landscape that is, well, it's entirely murky. So we are wading into the ultimate murky waters of accounting today for this deep dive.
We really are.
We are looking at contingencies. And if you are navigating this material right now, you probably already know this is one of the trickiest, most nuanced areas of financial reporting to master.
It definitely trips up a lot of people.
For sure. We're talking about contingent assets and contingent liabilities. And the mission for this deep dive is to ensure that you walk away with a crystal clear understanding of what these terms mean, the underlying logic of how to spot them, and perfectly distinguish them from standard liabilities and provisions.
You know, what's fascinating here is that we often think of accounting as just a historical record, like a rigid diary of what happened yesterday.
That the numbers are already locked in.
Exactly. But it's not just that. It is fundamentally about mathematically dealing with the unknown. You are going to be tested heavily on how you handle what might happen tomorrow based on the events of yesterday.
Which is a huge mental leap.
It is. It is about capturing reality when reality itself hasn't fully made up its mind yet.
Which is a massive paradigm shift. I mean, if accounting is supposed to be the ultimate truth of a company's health, how do you mathematically represent a maybe?
That is the million-dollar question.
Right. So here is how we are going to attack this. We are tossing out the basic table of contents approach. We are going to build the architecture of these concepts logically, step by step. We'll stress test the rules, clarify the specific traps that trip people up, and then run a rigorous pressure test on the core principles to guarantee you are totally exam ready.
That is the exact right approach. I mean, we have highly specific source material to work through today, straight from the standard curriculum. And the wording in these definitions is, well, it's incredibly deliberate.
Okay, so let's unpack this, starting with the sunny side of the street, the maybe money coming in, contingent assets.
The good stuff.
Yeah, exactly. Now, the source text gives us a very rigid definition, and I want to put it under the microscope because every single word is essentially a load-bearing wall for this concept.
We really have to take it piece by piece.
So it defines a contingent asset as a possible asset that arises from past events and whose existence will be confirmed only after occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of the enterprise.
That is a mouthful.
It really is.
Yeah.
So let's isolate that first piece. It is a possible asset, not a definite one.
And that distinction is everything. A standard asset is a resource currently controlled by the enterprise, from which future economic benefits are absolutely expected to flow.
Okay, so give me an example of that.
Well, if you own a fleet of delivery trucks, those are assets. You control them, they have actual value. But a contingent asset is hovering purely in the realm of potential.
It's like a ghost asset.
Exactly. It usually arises from unplanned or completely unexpected events that just happen to create the possibility of an inflow of economic benefits. Like money or value might come your way, but you don't actually possess it yet.
Which leads right into the second mandatory component. It has to arise from past events.
Right.
I mean, I can't just wake up, decide I'm going to buy a lottery ticket tomorrow, and put a contingent asset on my balance sheet for the jackpot.
Yeah, no auditor is going to let that slide. You can't account for pure imagination.
Right.
There has to be a tangible origin story anchored in reality. You have to be able to point to a specific historical event that birthed this potential situation. The wheels must already be in motion.
And that historical event sets up the third, and frankly, I think the most complicated part of the definition. Its existence will be confirmed only by the occurrence or non-occurrence of uncertain future events that are not wholly within the control of the enterprise.
That phrasing is key.
Let's really dig into that phrasing. Not wholly within the control.
This is the linchpin. The ultimate outcome is entirely out of your hands. You do not have the final say.
Someone else is calling the shots.
Exactly. Somebody else or some external circumstance is going to dictate whether this phantom value crystallizes into real economic benefit. If your management team could simply push a button and make the money appear, it wouldn't be contingent.
Because it would just be a regular asset at that point.
Right. The contingency exists because you are waiting on a trigger pulled by a third party.
Let's ground this with a real-world example from the source text. It brings up a claim that an enterprise is pursuing through a legal process where the outcome is uncertain.
A classic scenario.
Yeah, so let's say we are a software development company, and we are suing a massive tech giant for stealing our proprietary code. We are the plaintiff. We filed the lawsuit for $10 million. Walk us through how this perfectly maps onto those three pillars.
Okay, it maps perfectly. Let's run the diagnostic on it. First, does it create a possible asset? Yes, if the court rules in your favor, the tech giant has to hand over $10 million in damages.
That's a huge potential payday.
It is, and that is a massive possible inflow of economic benefits. Second, did it arise from a past event?
Well, the theft, right?
Exactly. The alleged theft of the code by the tech giant and your subsequent filing of the lawsuit, those are the historical events that created this scenario.
So we have the potential money, and we have the inciting incident firmly in the past.
Right. Now for the crucial third hurdle. Is the confirmation dependent on an uncertain future event not wholly within your control? Well, look at the mechanics of a lawsuit. Who actually decides if you get that $10 million?
The judge. Or I guess the jury.
Exactly. Not your CEO, not your incredibly confident lead attorney. The judge's final ruling is the uncertain future event.
So it's totally out of our hands.
You can argue your case brilliantly, but the final stroke of the pen is entirely out of your control. Therefore, this pending legal claim fits the exact anatomical definition of a contingent asset.
But let me challenge this from a business perspective. Because if I'm the CEO of this software company and my legal team is telling me we have a slam dunk case, like we have emails proving the theft, we have the smoking gun.
The CEO's dream.
Right, so why wouldn't I want to signal that to the market immediately? If I might win $10 million, putting that on my balance sheet today makes my company look incredibly healthy to investors. Why are the accounting standards forcing me to hide my impending victory?
It's because of a foundational theoretical framework in accounting called prudence.
Prudence, okay.
Yeah, and prudence is essentially the immune system of financial reporting. The principle of prudence dictates that you do not count your chickens before they hatch, but you absolutely must prepare for the worst. The source text is incredibly uncompromising here. It dictates that an enterprise should never recognize a contingent asset in the financial statement.
Never. That is a remarkably absolute rule.
Yeah.
You don't see that word often in financial guidelines.
It has to be absolute, because the alternative is systemic manipulation. The Towers explains that if you were allowed to recognize contingent assets, it might result in the recognition of income that may never be realized.
Which would be a disaster.
Think about the chain reaction if we let CEOs act on their optimism. You inflate your profits with this ghost money from a lawsuit you haven't won yet. You tell your investors you had a record year.
And then the stock price shoots up based on nothing.
Exactly. You might even pay out dividends based on that phantom profit. And then 2 years later, the judge dismisses your case on a technicality.
Oh, wow. You'd have distributed money you never actually possessed. The financial statements would be a total fiction.
Precisely. It would completely destroy the integrity of financial reporting. Prudence demands that we do not recognize revenue or assets until they are virtually guaranteed. We just cannot allow false optimism to masquerade as financial health.
Okay, so we keep it entirely off the balance sheet and off the profit and loss statement. But wait, if I am an investor analyzing this software company, the fact that they were entangled in a $10 million lawsuit is incredibly material information.
Absolutely. It changes the valuation.
Yeah, I need to know about that to value the stock accurately. If it's banned from the main financial statements, where does this information actually live?
It lives in the disclosures, but with a very specific gatekeeper. The text clarifies that a contingent asset is usually disclosed in the report of the approving authority.
Which usually means what?
For a standard corporation, that means the board of directors report. But, and this is a critical threshold for anyone looking at this conceptually, it is only disclosed there if an inflow of economic benefits is probable.
So there's a filter. We aren't just dumping every single frivolous long-shot lawsuit we file into the board's report just to make ourselves look aggressive. It has to pass a probability test.
Exactly. If your lawsuit is a wild shot in the dark with, say, a 5% chance of winning, you don't mention it. It would just be noise.
Right.
But if your legal team assesses that a victory is probable, meaning more likely than not, then it earns a mention in the descriptive text of the board's report. Not as a hard number on the balance sheet, but as a narrative heads up to the investors.
Okay, let's follow this timeline to its logical conclusion. Let's say a year goes by. The trial happens. The judge slams the gavel and issues a ruling entirely in our favor. The tech giant's appeals are exhausted. They're ordered to wire us the $10 million next week. What happens to our contingent asset now?
It undergoes a fundamental metamorphosis. Because contingent assets aren't static, they are assessed continually.
They evolve.
Yeah. The text states that if circumstances change and it becomes virtually certain that an inflow of economic benefits will arise, it graduates. It is no longer a contingent asset.
Because the uncertainty has been totally eliminated.
Exactly. The trigger has been pulled. The maybe has evaporated. The text is very clear. When realization of income is virtually certain, the related asset and the related income are recognized in the financial statements in the period in which the change occurs.
So it finally earns its way onto the balance sheet and the income statement.
It moves from the shadows of the board report directly into the hard numbers of the financials.
I want to synthesize this movement for everyone listening because grasping this life cycle is essential for exams. Think of it like a flight reservation status. Let's use the mnemonic PNR.
I love this one.
Yeah, it's so helpful. So P stands for probable. If the inflow is probable, N stands for note. Note it in the report of the approving authority. And R stands for recognize. If the inflow becomes virtually certain, recognize it fully in the financials.
Perfect.
So probable equals note in report. Virtually certain equals recognize, PNR.
That's a highly effective way to internalize the rule. PNR, it perfectly tracks that escalation of certainty. If you can lock down that progression, you'll easily navigate any scenario involving potential inward cash flows.
But of course, business is a two-way street. I mean, if prudence forces us to be incredibly conservative about phantom money coming in, how does it treat phantom money going out? If contingent assets are the things we hope happen, we need to examine the things we are terrified might happen. Let's pivot to contingent liabilities.
This is where the framework gets incredibly rigorous. And frankly, this is the area where most students and professionals get tangled up.
Why is that?
Because a contingent liability isn't just one singular concept. The source text meticulously splits the definition into two entirely different scenarios. We have to examine them as Definition A and Definition B.
Okay, let's lay the groundwork first. Definition A sounds very much like a mirror image of our asset definition. It states a contingent liability is a possible obligation that arises from past events, and the existence of which will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the enterprise.
Notice the symmetry there. Possible asset becomes possible obligation. The structure of uncertainty remains basically identical.
Now contrast that with Definition B. This one shifts the timeline. It says a contingent liability is a present obligation that arises from past events, but is not recognized because of two specific failures. Either it is not probable that an outflow of resources will be required, or a reliable estimate of the amount cannot be made.
And right there is the core tension. Definition A is a possible obligation. Definition B is a present obligation that basically fails a math test.
A math test, I like that.
We really need to dissect both of these with real scenarios to see how they operate in the wild.
Let's start with Definition A, the possible obligation. The source text provides a fantastic, classic business nightmare scenario to illustrate this. The Mr. X and Mr. Y machine example. Let's build out the narrative for everyone listening.
Let's do it.
Imagine Mr. X runs a manufacturing business selling massive, multi-ton industrial drill presses. He sells one of these massive machines to Mr. Y's company. A week later, Mr. X receives a terrifying legal notice in the mail. The notice states that one of Mr. Y's workers suffered a catastrophic injury while operating the drill press, and Mr. Y is suing Mr. X for 20 lakh in damages, claiming the machine was defective.
It's the exact moment every business owner dreads. The legal threat arrives.
So Mr. X is staring at this demand for 20 lakh. Why does the text classify this specifically under Definition A? Why is this only a possible obligation rather than a present one?
Well, we have to play detective here. Let's look at the past events. The sale of the drill press is a past event. The terrible accident involving the worker is a past event. Receiving the legal notice is a past event. But here's the critical analytical step.
What's that?
Receiving a piece of paper demanding 20 lakh does not legally or mathematically mean Mr. X actually owes 20 lakh.
Because anybody can sue anybody for anything. The claim itself isn't proof of fault.
Precisely. We are missing a massive piece of the puzzle, which is causality. Why did the worker get hurt? Was it because Mr. X's factory installed a faulty safety sensor on the drill press? If an investigation proves that, then yes, Mr. X sold a defective product and is likely liable.
Makes sense, but what's the alternative?
What if Mr. X built the machine perfectly and the accident happened because Mr. Y's worker explicitly bypassed the safety protocols and operated the machine recklessly? In that case, the fault lies entirely with Mr. Y's company.
And right now, holding that letter, Mr. X has absolutely no idea which reality is true.
Exactly. Because the fault is unknown, the obligation itself is unknown. It is merely a possibility. The existence of an actual legal duty to pay that 20 lakh relies entirely on the outcome of an impending investigation or a court case,
Which are uncertain future events that Mr. X cannot control.
Therefore, under Definition A, Mr. X has a contingent liability. The obligation itself is unconfirmed.
Okay, that logic tracks perfectly. We don't know if we did anything wrong, so the obligation is just a ghost right now. Let's flip the script and examine Definition B, the present obligation that fails.
This one is interesting.
The text uses the Mr. AB car test drive example for this. Let's flesh this out. Mr. AB owns a luxury car dealership. A prospective customer comes in, gets the keys to a brand new high-end sports car, and takes it out on the highway for a test drive. While doing 70 miles an hour, a known faulty fuel line in the engine ruptures, and the car bursts into flames.
A total disaster.
Right. The customer miraculously survives, but sues the dealership for 50 lakh for severe emotional distress and physical damages.
If we connect this back to our previous scenario, the contrast is really stark. With the drill press, we didn't know whose fault the accident was. It was a mystery. But look closely at the text for Mr. AB. It explicitly states the fire happened due to malfunctioning of a faulty part. There is no mystery here. Mr. AB's dealership handed a customer a vehicle with a defect, and it exploded on their watch.
The fault is established. It's undeniable.
Right. And because the fault is established, the text notes that Mr. AB acknowledges there is a present obligation. This isn't a maybe we did something wrong situation. The event happened, the defect is undeniable, the legal duty to make this right exists right now. It has crossed the line from a possible obligation to a present obligation.
But wait, if he admits it's a present obligation, why doesn't he just record a 50 lakh liability on his balance sheet today and be done with it? Why is this still called a contingent liability?
Because of the strict criteria required to actually recognize a number on a balance sheet. To put a liability on the books, you need more than just an obligation. You need certainty of outflow, and you need a reliable measurement.
That math test you mentioned earlier.
Exactly. Definition B catches obligations that exist, but fail one of those two tests. In Mr. AB's case, yes, he acknowledges the fiery disaster. But will he actually have to pay 50 lakh out of his own pocket? The customer is demanding 50 lakh, but maybe a judge will look at the case and award only 5 lakh.
Or maybe his insurance steps in.
Exactly. Even more likely, perhaps Mr. AB has a comprehensive corporate insurance policy that covers test drive accidents entirely. If the insurance company pays the settlement, Mr. AB has zero outflow of his own resources.
So even though the obligation is real, the actual economic bleed from his company is uncertain.
Precisely. It fails the recognition criteria because it is not yet probable that an outflow of his specific resources will be required, or because he simply cannot make a reliable estimate of the final penalty until the lawyers and insurance adjusters finish fighting. Because it fails that test, it gets downgraded to a contingent liability.
That is a brilliant structural distinction. So, definition A, we don't even know if we are on the hook, so the obligation is possible. Definition B, we know we are on the hook, we have a present obligation, but we have no idea how much it will cost us, or if our insurance will cover it. So it fails the test to become a fully realized liability.
That is the exact conceptual boundary between the two definitions.
So once an accountant identifies that a situation is indeed a contingent liability, whether through definition A or B, the immediate practical question is, well, what do we do with it? Where does it go?
Right.
This is where the probability spectrum comes in, and this is heavily tested. What is the golden rule for recording a contingent liability?
The golden rule is a negative one. You do not recognize a contingent liability in the balance sheet. I really want to emphasize that heavily. It does not become a recognized number in the primary financial statements.
Because doing so would violate the requirement for reliable measurement and perhaps overstate the company's true liabilities.
Right.
But we can't just pretend it doesn't exist. Where does it live?
The source text requires that a contingent liability be disclosed in the notes to accounts.
Let's demystify that for a second. When people think of financial statements, they usually picture the grid of numbers, the assets, the liabilities, the equity. What are the notes to accounts functionally?
Well, if the balance sheet is the skeleton of the company, the notes to accounts are the medical chart explaining the anomalies. They are pages of detailed text attached to the end of the financial statements.
We'll get a fine print.
Exactly. They explain accounting policies, break down complex line items, and crucially, they provide a space to describe significant risks that don't fit neatly into a single numerical value. So you write a descriptive paragraph in the notes explaining, we are currently facing a 50 lakh lawsuit regarding a test drive accident. We are fighting the valuation of the claim, and the final outcome is pending.
Okay, so it gives investors full transparency about the hovering risk without artificially skewing the hard mathematical ratios of the balance sheet.
It operates perfectly like a warning label for the investors.
But as I'm reading the source text, I see a very pragmatic exception. It says you disclose it in the notes unless the possibility of an outflow of a resource embodying economic benefits is remote. Let's unpack the word remote.
This is a vital sanity check built into the accounting standards. Let's say you operate a regional chain of coffee shops. An individual files a lawsuit against you for $2 billion, claiming that the specific shade of green on your coffee cups caused them severe psychological trauma and ruined their career.
A completely frivolous, legally baseless claim.
Exactly. The chance of a judge actually ruling against you and forcing you to pay $2 billion over a cup color is, in professional judgment, remote. It basically approaches zero.
So what do we do with it?
We completely ignore it.
Really? Just ignore it?
Yeah. If companies were forced to disclose every single absurd, bad faith legal threat they ever received, the notes to accounts would be thousands of pages long. It would bury the actual material risks in an avalanche of nonsense. So the rule is clear. If the possibility of an outflow is remote, you do not even disclose it. It requires no accounting treatment whatsoever.
Okay, so we have a clear baseline. If the risk is remote, we ignore it. If the risk is a possible obligation, we disclose it in the notes to accounts as a contingent liability. But reality is fluid. What happens if a situation escalates? Let's go back to our drill press example. Mr. X thought the lawsuit was just a possibility.
Right.
But 6 months later, during the legal discovery process, Mr. X's lawyers uncover an internal memo from his own factory floor proving that the safety sensors were intentionally installed backwards to save time.
Oh, wow. The smoking gun.
Right. The lawyers come to Mr. X and say, we are absolutely going to lose this case. It is no longer just a possibility. It's highly probable that we will have to pay out a significant settlement. What happens to the accounting treatment?
This triggers an escalation. The source text emphasizes that contingent liabilities must be assessed continually to determine whether an outflow of resources has become probable. If the probability shifts, like if it becomes probable that an outflow of future economic benefits will be required for an item previously dealt with as a contingent liability, it undergoes a graduation.
Just like the contingent asset graduated when it became virtually certain, what does the liability graduate into?
It graduates into a provision. A provision is recognized in the financial statements in the period in which the change in probability occurs.
So it moves from the text to the numbers.
Exactly. It is pulled out of the descriptive notes to accounts and transformed into a hard, recognized liability on the balance sheet. Management must make a reliable estimate of the settlement, say 15 lakh, and take that hit to their financials immediately.
Let's visualize this escalation ladder for the listeners, because tracking the movement of a liability based on probability is the core of this entire topic. Think of a 3-rung ladder.
Okay, I'm picturing it.
Bottom rung, the probability of an outflow is remote. The accounting action. Ignore it. Middle rung, the obligation is possible, or it's a present obligation, but outflow isn't probable yet. The accounting action. Disclose it in the notes to accounts as a contingent liability. Top rung, the outflow becomes probable and can be estimated. The accounting action. Recognize it as a provision on the balance sheet. So, remote means ignore. Possible means notes. Probable means provision.
That is the exact analytical progression a professional auditor uses. You evaluate the evidence, determine the probability rung, and apply the corresponding accounting treatment.
So we've defined the edges of contingencies, but to truly understand a shadow, you have to understand the object casting it. Let's compare these concepts to their standard counterparts. Let's look at a standard liability versus a contingent liability, because to a layman, the word liability just means debt.
And that oversimplification is dangerous in financial reporting. We need to clearly define the baseline of a standard liability to see how a contingency deviates from it. The text defines a standard liability as the present financial obligation of an enterprise, which arises from past events. But here's the differentiator. The settlement of a liability will result in an outflow from the enterprise of resources embodying economic benefits.
So the key word there is will. There is absolute certainty of the outflow.
Yes.
If I take out a 5-year commercial loan from a bank to expand my warehouse, the moment I sign those papers and take the cash, I have a standard liability. It's a present obligation from a past event, and I absolutely will have to pay back the principal plus interest. There is no alternative reality where I don't owe that money.
Exactly. It is a definite, crystallized obligation. The contrast is that a contingent liability entirely lacks that certainty. As the text reiterates, for a contingent liability, either the outflow of resources to settle the obligation is not probable, or the amount cannot be measured with sufficient reliability. It is a liability infected with uncertainty.
The source text provides a specific list of examples of contingent liabilities. These are high-yield scenarios that appear constantly in practice and on exams. I want to walk through these, and rather than just reading the list, I want you to briefly explain the underlying mechanical logic of why each one fits the definition.
Sounds good.
First example, claims against the enterprise not acknowledged as debts.
This aligns perfectly with our lawsuit scenarios. If a vendor sends you an invoice for services, but you dispute the quality of the work and refuse to pay, you don't acknowledge it as a valid debt. Because it's under dispute and a third party like an arbitrator will have to decide the outcome, the obligation is only possible. It's contingent on the dispute resolution.
Second example, guarantees given in respect of third parties.
Right.
Let's contextualize this.
A really common scenario is a parent company and a subsidiary. Let's say your smaller subsidiary needs a line of credit to buy inventory, but their independent balance sheet is weak. The bank asks you, the wealthy parent company, to sign a corporate guarantee. You are promising the bank, if the subsidiary defaults, we will step in and pay the debt.
So at the moment I sign that guarantee, do I owe the bank money?
No, not at all. You haven't borrowed anything. Your obligation is entirely conditional. It only transforms into a real liability if and only if the subsidiary fails to pay in the future. Since you cannot wholly control the financial success of the subsidiary, their potential default is an uncertain future event.
So that fits the definition perfectly.
Therefore, your guarantee is a classic contingent liability. You disclose the risk in the notes, but you don't record the subsidiary's debt on your own balance sheet.
That makes perfect sense. Third example, and this one sounds incredibly technical. Liability in respect of bills discounted. We need to break down the banking mechanics here. What does it mean to discount a bill?
Let's use a tangible transaction. You sell a massive shipment of goods to a customer. Instead of paying cash today, the customer gives you a bill of exchange, essentially a legally binding IOU that says they will pay you $100,000 in 90 days.
Okay, I have an IOU.
But you need cash right now to pay your own workers. So you take this 90-day IOU to your bank. The bank buys it from you today for, say, $98,000. That process is called discounting the bill. You get your cash early, and the bank gets to collect the full $100,000 from the customer in 90 days, keeping the $2,000 difference as their fee.
Sounds like a clean transaction. Where does the liability come in?
It comes in because the bank isn't stupid. When they buy that IOU from you, they usually do it with recourse.
What does that mean?
That means if day 90 arrives and your customer has gone bankrupt and defaults on the IOU, the bank isn't just going to absorb the loss. They're going to come directly back to you and demand the money.
So by discounting the bill, I have essentially co-signed the customer's debt to the bank.
Exactly. You've received the cash, but a shadow obligation remains. You might have to pay the bank back if the customer fails to honor the bill. That uncertainty makes it a contingent liability until the 90 days are up and the bill is successfully cleared by the customer.
That is a brilliant breakdown of a very complex mechanical process. Final example from the text. Statutory liabilities under dispute.
Statutory simply refers to obligations created by laws or government regulations, most commonly taxes or environmental fines. Suppose the Central Tax Authority conducts an audit and claims you underpaid your corporate taxes by $2 million.
That sounds like a nightmare.
It is, but you firmly believe your accounting was perfectly legal, so you file a formal appeal against the tax authority in court. Because the liability is actively being contested and the final ruling is up to a tax judge, it is a contingent liability until the gavel falls.
Which perfectly bridges us into what I consider the masterclass of this entire topic. We've talked about how a contingent liability can escalate into a provision, but distinguishing between a contingent liability and a provision in real-time practice requires incredible precision. Let's formally define a provision based on the text.
The source text defines a provision as any amount written off or retained by way of providing for depreciation, renewal, or diminution in the value of assets, or retained by way of providing for any known liability of which the amount cannot be determined with substantial accuracy.
The first half of that definition regarding depreciation is, it's a bit of a legacy accounting concept. For our purposes regarding liabilities, we need to laser focus on the second half, providing for any known liability of which the amount cannot be determined with substantial accuracy.
That is the core of it. You have a known liability, a present obligation, but the exact mathematical amount requires estimation.
The source text provides a highly structured 4-point comparison table to separate provisions from contingent liabilities. Let's convert that table into a diagnostic checklist. We will call these the 4 pillars of distinction.
Let's do it.
Pillar 1, the nature of the item. How do they fundamentally differ in their nature?
The nature of a provision is that it is a present liability of uncertain amount, which can be measured reliably by using a substantial degree of estimation. It is rooted in the present. The nature of a contingent liability is that it is a possible obligation that may or may not crystallize depending on uncertain future events. Present versus possible.
Pillar 2, recognition. How are they treated structurally in the accounting system?
A provision meets the recognition criteria, meaning it is formally recorded as a number on the balance sheet. A contingent liability inherently fails the recognition criteria, so it is relegated to the notes to accounts.
Pillar 3, the why of recognition. What are the specific criteria that a provision meets that a contingent liability fails?
To recognize a provision, 3 stars must align. First, there is a present obligation from past events. Second, an outflow of resources is probable. Third, a reliable estimate of the amount can be made. A contingent liability fails this test because either the outflow is not probable or a reliable estimate simply cannot be calculated.
And Pillar 4, which is perhaps the most subjective, management estimation. How does the internal judgment of the company dictate the outcome?
If management, after reviewing all evidence, estimates that it is probable that the settlement of an obligation will result in an outflow, they are forced to recognize a provision. However, if management evaluates the same evidence and estimates that it is less likely that an economic outflow will occur, they merely disclose it as a contingent liability.
Probable equals provision. Less likely equals contingent liability. This feels incredibly abstract, so let's run this through the ultimate real-world test using the tech's final complex example. This is the Alpha Ltd excise penalty scenario. Let's build the narrative architecture here.
Okay, set the scene.
Imagine Alpha Ltd is a major manufacturing firm. They receive a visit from the Central Excise Officer, a government regulatory authority. The officer determines that Alpha Ltd violated a complex manufacturing regulation and slaps them with a massive, punitive financial penalty. Alpha Ltd's executive team insists they follow the regulations perfectly, so they initiate a formal legal appeal against the penalty. We now have a fork in the road. We have two parallel realities depending on how management evaluates the situation. Let's explore Scenario A.
In Scenario A, the CEO of Alpha Ltd convenes a war room with their elite legal counsel. They review the historical precedents of similar excise appeals. The lawyers deliver bad news. They say the government rarely loses these appeals, and Alpha Ltd's documentation is weaker than they thought. Management determines that despite their appeal, they're almost certainly going to lose. They estimate that it is probable that the company will eventually have to pay this massive penalty.
Because it is a present obligation stemming from a past event, the alleged violation, and because they have internally deemed the outflow probable, the accounting rules force their hand. They must recognize a provision. They have to record a liability on their balance sheet today, taking a direct hit to their reported financials, anticipating the loss tomorrow.
Exactly. They cannot hide behind the pending appeal. The probability threshold has been crossed. Now, let's reset the board and look at Scenario B.
Same situation, different outcome.
Same initial violation, same appeal process. But in this reality, the legal counsel reviews the case and finds a massive procedural error made by the excise officer. They find 3 recent Supreme Court rulings that directly support Alpha Ltd's defense. The management team looks at the evidence and feels extremely confident. They estimate that the appellate authority will almost certainly rule in their favor. They determine it is less likely that the company will ever have to pay the penalty.
Because the outflow is deemed less likely, it fails the probable test. Therefore, it cannot be recognized as a provision. Instead, they will write up a narrative disclosure of the dispute and place it as a contingent liability in their notes to accounts. Their balance sheet remains untouched by the penalty amount.
That's exactly right.
Now, I have to stop right here and challenge this entirely on behalf of every skeptical listener. This entire system seems to rest on the phrase management estimates. If I'm a CEO and my bonus is tied to the company's stock price, and recognizing a massive provision will tank my stock price, aren't I just fundamentally incentivized to always claim, oh, our lawyers say we are going to win, it's less likely we'll pay, put it in the notes as a contingency? Isn't this just an enormous systemically sanctioned guessing game?
That is the most critical vulnerability in the entire framework of accounting, and it is a completely valid pushback. The tension between prudence and management incentives is real. However, the system is designed to prevent it from being a blind guessing game. Look at the wording and the definition of a provision, measured reliably by using a substantial degree of estimation.
Right. Substantial degree.
That estimation cannot be a CEO flipping a coin. It requires rigorous, documented evidence. If management claims it is less likely they will lose an appeal, they cannot just say that. They must possess formal, written opinions from external legal counsel supporting that probability. And crucially, those internal estimates must survive the scrutiny of independent external auditors.
Ah, so there's a backstop.
If the auditors review the legal files and determine the CEO is being wildly over-optimistic to protect the balance sheet, the auditors will force the company to recognize the provision, or they will issue a qualified audit report, which is a death knell for a public company.
So the auditors essentially act as the immune system against managerial delusion or manipulation. The estimation must be a calculated, legally defensible position, not a wishful thought.
Exactly. It is subjective, yes, but it is a highly regulated subjectivity.
This brings us to our final crucible. We have laid out the theory, we have explored the mechanics, now we need to prove that we can apply it. It is time for the exam simulation. We are going to pressure test these concepts using the exact logic required by the source text quiz section. I'm going to throw these scenarios at you, and I want you to dissect the underlying trap in each one.
I am ready. Let's do this.
Let's start with a true-false pressure test. Scenario 1. You are arguing with a junior accountant, and they state definitively, a contingent liability need not be disclosed in the financial statements. Are they right or wrong, and why?
They are completely wrong, and they are falling into a trap of imprecise language. The trap here is the phrase, need not be disclosed. While it is true that a contingent liability is not recognized as a hard number on the balance sheet, the rules strictly dictate that it must be disclosed in the notes to accounts, unless the probability of an outflow is remote. Stating as a blanket rule that they need not be disclosed is a fundamental failure of the reporting standard.
Boom. Catching the unless remote exception is the key there. Scenario 2. Let's test the boundary line. Someone claims, a provision fails to meet the recognition criteria, which is why it requires estimation.
False again. This is a classic inversion trap. The entire purpose of provision is that it does meet the recognition criteria. Specifically, it represents a probable outflow of resources. The fact that it requires estimation doesn't mean it fails recognition. It just means it's a liability of uncertain amount. It is the contingent liability that fails the recognition criteria. They are testing if you know which concept actually survives the journey to the balance sheet.
Scenario 3. Let's see if you can spot the directional trap here. A claim that an enterprise is pursuing through legal process, where the outcome is uncertain, is a contingent liability.
This is a fantastic trick question. The answer is false, and the entire hinge of the question rests on the word pursuing. If the enterprise is pursuing the claim, they are the plaintiff. They are the ones attacking. That means if they win, money will flow in. Potential inflows are contingent assets. If the text said a claim is being pursued against the enterprise, then it would be a contingent liability. You must always identify the direction of the potential cash flow before categorizing the contingency.
It's all about the vector of the money. Inflow equals asset, outflow equals liability. Scenario 4. Let's test the escalation ladder. When it is probable that the firm will need to pay off the obligation, this gives rise to a contingent liability.
False. This tests your understanding of the probability thresholds. We establish the latter. Possible equals contingent liability. Probable equals provision. If the scenario explicitly states the outflow is probable, it has graduated past a contingency. It must be recognized as a provision. The word probable is the trigger word that changes the accounting treatment entirely.
Scenario 5. The final true-false boundary test. A present financial obligation of an enterprise which arises from a past event is termed as a contingent liability.
False. This is a test of definitions. What they just described, a present obligation from a past event, is the exact word-for-word definition of a standard, vanilla liability. To make it a contingent liability, you must introduce the element of uncertainty. Either the obligation is only possible, or the outflow is not probable, or the amount cannot be reliably estimated. Without that uncertainty, it's just a regular debt.
Flawless deconstruction. Now let's pivot to the multiple choice logic. I will present a conceptual problem based on the text, and you provide the governing principle that solves it. Problem 1. You need to define the fundamental origin of a contingent asset. What is the core characteristic?
The governing principle is that assets revolve around economic benefits expected to flow into the enterprise. Therefore, a contingent asset usually arises from unplanned events that create the possibility of an inflow of economic benefits to the business entity.
Problem 2. You determine that a contingent asset has finally reached the threshold of probable. Where exactly does the accounting standard direct you to put this information?
The principle of prudence blocks it from the balance sheet. Instead, the standard dictates it must be disclosed in the report of the approving authority, which for a standard company is the Board of Directors report.
Problem 3. You are auditing a company and find a present obligation. However, you determine that an outflow of resources to settle it is not probable, or you simply cannot measure the expected payout with sufficient reliability. What category does this fall into?
Because it fails the recognition criteria of probability and reliable measurement, it is categorized as a contingent liability under definition B.
Problem 4. You find a present liability of an uncertain amount, but you determine that it can be measured reliably by using a substantial degree of estimation, and the outflow is probable. What is this called?
Because it meets all the criteria, present liability, reliable estimation, probable outflow, it crosses the threshold and is recognized as a provision.
Final problem. You are preparing the final financial statements. You have a confirmed contingent liability.
Yeah.
What is the ultimate accounting treatment regarding the financial statements themselves?
The ultimate rule is non-recognition. It is disclosed in the notes to accounts, but it is not recognized as a numerical value within the financial statements.
That brings us to the end of our pressure test and to the conclusion of our deep dive into the murky waters of contingencies. Let's synthesize the architecture we've built today. We started by defining contingent assets, the phantom money coming in. We established that they arise from past events, depend on uncertain future triggers out of our control, and because the immune system of prudence demands, we never count unhatched chickens, we never recognize them on the financials until they are virtually certain.
A great summary.
We then explored the dual nature of contingent liabilities, the phantom money going out. They're either possible obligations waiting for causality to be proven, or they are present obligations that fail the test for recognition because the outflow isn't probable or measurable. We learned they live exclusively in the notes to accounts, acting as warning labels, unless the risk is deemed remote, in which case they vanish from the record entirely. And finally, we mapped the boundary between contingent liabilities and provisions. If a present obligation crosses the threshold where an outflow is probable and measurable, it graduates from the notes and lands directly on the balance sheet as a provision.
That captures the entire progression perfectly.
To ensure long-term retention, keep the memory frameworks active. For assets, use the train ticket. PNR, probable, note and report, virtually certain, recognize. For liabilities, visualize the escalation ladder. Remote means ignore. Possible means notes. Probable means provision. And when trying to distinguish a provision from a contingency in a complex scenario, always adopt the alpha LTD appeal mindset. Ask yourself the ultimate subjective question. What does management actually estimate the probability of the outflow to be, and can they back that estimation up with evidence?
This raises an important question, something for you to mull over as you leave this session and look at the real financial world. We spent a lot of time discussing how much of this framework relies on management estimation, on a group of executives deciding the razor-thin line between a remote possibility, a less likely contingency, and a probable provision. In a modern economy where businesses are constantly facing entirely new, unprecedented risks, things like massive, cascading cyber attacks, sudden global supply chain freezes, or overnight regulatory shifts in technology, how much material risk is a company truly hiding in those tiny footnotes simply because they deemed the worst-case scenario less likely? The subjective line between a contingent liability hidden in paragraph text and a recognized provision destroying the balance sheet is where the true art and perhaps the true danger of financial analysis lies.
That is a staggering thought to end on. It brings us right back to the X-ray analogy we started with. We desperately want accounting to be an X-ray, clean, binary, broken or not broken. But when you're dealing with contingencies, you aren't looking at an X-ray. You are looking at a very blurry ultrasound of the future, full of shadows and interpretations, trying to make the best possible educated guess about a reality that hasn't happened yet. Thank you for joining us on this deep dive into the architecture of the unknown. Review your notes, pressure test these concepts against real companies, and the next time you read a headline about a massive corporate lawsuit or a regulatory fine, ask yourself, is that sitting on their balance sheet, or is it hiding in the notes? Keep questioning the mechanics, keep building your framework, and we will see you on the next deep dive.
In the corporate world, there's this really dangerous assumption that a lot of people make about money.
Oh, absolutely.
Yeah, we tend to look at a company's financial statements like the balance sheet, the profit and loss account, and we just view them through this lens of pure mathematics. It feels comforting, right?
Right, because 2 + 2 = 4.
Exactly. You have $100 million in revenue, you spend $50 million, you have $50 million left. It just feels like an unshakable, binary, scientific fact, like you're looking at an X-ray of a business.
It really does feel that way. And, I mean, that assumption is exactly what gets casual investors and, honestly, even some seasoned professionals into a ton of trouble. Because the moment you step away from, like, basic bookkeeping and move into the realm of corporate financial reporting, well, that perfect black and white X-ray machine kind of just shatters.
It shatters completely. And so that is exactly what we are unpacking today.
Welcome to this deep dive, everybody. Today, our mission is to completely demystify accounting policies. We're working from a really fascinating stack of source material today.
We are, yeah.
And we're going to look at how these policies are selected, applied, and occasionally changed, But our goal today isn't just to recite textbook definitions so you can pass an exam. I mean, we want to actually understand the mechanics behind the numbers.
Right, because the sources reveal something that, frankly, is pretty surprising.
Totally. Accounting is actually completely full of choices. It involves these deep judgment calls and a surprisingly robust, like, choose-your-own-adventure element.
Yeah.
And that can totally alter how a company is valued.
That choose-your-own-adventure aspect is really the perfect way to frame it. I mean, the choices a management team makes can literally shift millions of dollars around on paper.
Wow.
Yeah, without a single physical asset ever changing hands. So if you want to understand the true economic narrative of an enterprise, you really have to look past the final numbers. You have to look at the policies.
Exactly. You have to examine the specific policies they use to calculate those numbers. Because if you don't grasp the why and the how behind them, you're basically reading a translated novel without realizing the translator took, massive creative liberties.
I love that analogy. So look, I'm going to be pushing back a bit today. I'm going to act as the proxy for you, the listener. Whether you're an exam candidate trying to master this logic, or just an investor trying to figure out if a company is actually making money or just performing accounting magic.
Sounds good.
I'll raise the doubts, I'll ask the questions everyone is thinking, and you can be our master guide connecting all the dots.
I wouldn't expect anything less. Let's get into it.
Okay, let's start right at the bedrock. What exactly is an accounting policy? Because the source text gives us a very deliberate kind of two-part definition.
It does, yeah.
It says that accounting policies refer to the specific accounting principles and the methods of applying those principles that an enterprise adopts.
Right. And that two-part structure is the absolute key to unlocking everything else we're going to talk about today. You have to separate the principle from the method.
Okay, break that down for us. What's the difference?
Think of an accounting principle as the broad, non-negotiable concept. It's the what.
Okay.
So, for instance, there's a fundamental accounting principle that says a business has to account for the wear and tear on its long-term assets over time. If you buy a fleet of delivery trucks, well, those trucks lose value every single year they're on the road.
Right, obviously.
The principle dictates that you absolutely must record that loss in value, that depreciation. You can't just pretend the trucks are brand new forever.
So the principle is just the rule.
Yeah,
You must record depreciation.
exactly. But then you have the second half of the definition, the methods of applying these principles. This is the how. How mathematically are you going to calculate that wear and tear?
Because there isn't just one way to do it, right?
Precisely. Are you going to use a straight line method where you just assume the truck loses exactly 20% of its value every year for 5 years?
Uh-huh.
Or are you going to use a reducing balance method where you take a massive depreciation hit in the first year? Because, vehicles lose a huge chunk of their value the second you drive them off the lot.
Yeah, that makes sense.
Both of those are perfectly valid, legally acceptable methods of applying that exact same overarching principle.
Okay, so the accounting policy is the specific marriage of those two things. The principle says do this, and the method says here is exactly how we are choosing to do it.
You've got it perfectly.
Yeah.
The policy is that specific combination that is formally adopted by the management.
Okay, but this immediately brings up a massive student doubt for me. Like, if the whole goal of financial reporting is clarity and comparability, so investors know what they're looking at, why isn't there just a single universal list of accounting policies?
I hear that question all the time.
Right. Wouldn't it be infinitely easier if regulators just handed every CEO a manual and said, here is the one and only way to do this. Go.
It would definitely make comparing companies incredibly easy, but it would completely destroy the accuracy of the financial statements.
Wait, really? How?
The source text hits this point really hard. It explicitly states that there is no single list of accounting policies applicable to all enterprises in all circumstances. And the fundamental reason for that is the sheer diversity of the business environment.
Expand on that a bit, because on the surface, I mean, a business is a business. You buy things, you sell things, you make a profit.
Well, let's test that assumption. Imagine you're trying to write a single set of rules for two totally different companies. Company A is a massive steel manufacturing plant.
Okay.
They have blast furnaces that take decades to build, huge stockpiles of iron ore, thousands of factory workers. Now, Company B is a cloud-based software startup. They have zero physical inventory, no heavy machinery, and their team just works out of coffee shops on laptops.
Oh, wow. Yeah, the economic realities there are universes apart.
Exactly. They operate in incredibly diverse and complex environmental situations. So if we force the software company to use the exact same specific accounting methods as the steel plant, the resulting financial statements wouldn't reflect reality at all. It would totally distort their financial picture.
So a one-size-fits-all approach just doesn't work. Management needs the flexibility to, like, tell their own story.
Right. The text uses a great phrase for this. Considerate judgment.
Mhm.
Choosing the right policy requires considerate judgment by management. They have to look at their specific operational reality and pick the methods that best capture the truth of their business.
To make sure this is really locking into place for everyone listening, let's think about this like cooking.
Oh, I like this.
So the overarching principle of cooking poultry is that chicken must be cooked to an internal temperature of 165 degrees so you don't get sick. That is the non-negotiable rule.
A very important rule.
Exactly. But the method of achieving that principle varies wildly depending on your kitchen environment. One chef might have a state-of-the-art oven and slowly roast it.
Right.
Another person might be in a tiny dorm room and just use an air fryer to blast it with heat. The overarching principle, safe food, is identical. But the method they chose, based on the constraints of their specific kitchen, is completely different.
That's a phenomenal analogy.
And the end result, the meal, which in our world is the financial statement, is going to look and taste very different based on those choices.
Exactly. The oven versus the air fryer represents that considerate judgment. And just like those cooks, business managers have to formally declare which cooking method they used.
So investors know what they are eating, basically.
Yes, if you're an investor reading the statements, you need to know exactly how the numbers were prepared.
Okay, so management has this element of choice. They have a menu of methods, but surely it isn't just the Wild West, right? I mean, a CEO can't just invent a new method out of thin air to make their profits look better.
Absolutely not. While choices exist, it is a highly regulated, finite set of choices. And this introduces a really fascinating tension.
What kind of tension?
Well, on one hand, management needs flexibility. On the other hand, regulators want comparability. The source text highlights that the IKAI, the Institute of Chartered Accountants of India, is actively engaged in a constant tug-of-war here.
What's their specific role?
They work with the government, regulatory agencies, and what the text calls progressive managements. And their goal is to actually reduce the number of acceptable policies.
Oh, so they're trying to shrink the menu.
Exactly. They issue guidance notes and accounting standards to narrow it down. So instead of 100 different ways to value inventory, maybe the standards restrict it to just 2 or 3 strictly defined methods. This creates more uniformity while still leaving room for that considerate judgment.
All right, let's move from the theoretical to the practical. If management gets to choose their methods from this guarded menu, where do we actually see these choices being made in real life?
The source material lists several major areas where different policies are frequently encountered. We already touched on providing depreciation, but the two massive ones we need to deep dive into are the valuation of inventories and the valuation of investments.
Let's focus heavily on inventory first, because the text gets incredibly specific here, and honestly, the math is fascinating.
It really is.
First, just to establish a baseline, when we talk about inventory, we're talking about the physical goods a company holds for sale, right?
Correct. Finished goods on a shelf, raw materials waiting to be used, or work in progress on the factory floor.
Okay, so at the end of the year, the company has to look at all that stuff and assign a monetary value to it for the balance sheet. But why is this complicated?
What do you mean?
Well, if I buy a widget for $10, it sits on my shelf. The value is $10. Where is the room for a policy choice?
It sounds straightforward until you introduce the reality of time and inflation. Prices don't stay static.
Okay, true.
Let's build a scenario. Imagine you run a business selling electronic components. In January, you buy a batch of 10,000 components for $10 each.
So I spent $100,000.
Right, but by June, there's a shortage. You restock, buying another 10,000 components, but now they cost $15 each.
Okay, so that batch cost $150,000. I have 20,000 total components, and I spent $250,000.
Exactly. Now, between July and December, you sell 10,000 components to customers for $20 each. So you made $200,000 in revenue.
Great.
Here is the million-dollar accounting question. When you calculate your profit, which costs do you match against that revenue? Did you sell the $10 components from January or the $15 components from June?
Oh. Because they're physically identical. The warehouse guy doesn't care which month it was made.
Exactly. They're indistinguishable. And this is where the policy choice comes in. The text states that for valuing inventories, an enterprise may adopt different methods. Two of the most common are FIFO and the weighted average method. Let's look at FIFO first.
FIFO. First in, first out.
Under FIFO, You assume the very first items you purchased are the first items you sell. Like a grocery store stocking milk, oldest milk sells first.
Okay, so applying FIFO. I sold 10,000 units. FIFO assumes I sold the oldest ones, the $10 ones from January. So my cost is $100,000.
Right. Revenue of $200,000 minus $100,000 cost equals a gross profit of $100,000.
Not bad. And what about the 10,000 units still on my shelf?
Under FIFO, the remaining inventory is assumed to be the most recent batch, the $15 June batch. So your inventory asset on the balance sheet is valued at $150,000.
Okay, clean and logical. But what if management uses their considerate judgment and adopts the weighted average method instead?
Under weighted average, you don't track specific batches. You just calculate the average cost of all units bought during the year.
Let's do the math. $250,000 total spend divided by 20,000 units. That's an average cost of $12.50 per unit.
Correct. Apply that to your sales. You sold 10,000 units at $12.50 each. Your cost is $125,000.
So my revenue is $200,000 minus $125,000. My profit is $75,000.
Let's pause right there. Under FIFO, your profit was $100,000. Under average, it's $75,000. You just experienced a 25% drop in reported profit.
And nothing physically changed. I bought and sold the exact same stuff. But purely because of an accountant's choice, my profit shifted by tens of thousands of dollars.
Yes, and your balance sheet shifted too. The remaining 10,000 units are valued at $12.50, so your inventory asset is $125,000 instead of $150,000. Assets shrank, profits shrank.
This is wild. If I'm a CEO whose bonus depends on profit, I'm absolutely choosing FIFO when prices are rising. It artificially inflates my margins. How is that not manipulation?
That debate has raged for decades. Some say FIFO is better because the balance sheet reflects current costs. Others say average is better because it smooths out volatility. But the key takeaway for exam candidates is recognizing that the selection absolutely impacts financial performance.
So the idea that policy choices don't matter is totally false.
Entirely false. But that's just the method side of inventory. The text also gives us a rigid principle for inventory valuation that you absolutely have to memorize.
Let me pull that rule. It says finished goods are valued at lower of cost or market value, while byproducts are valued at net realizable value. Okay, so lower of cost or market value. Break that down.
This is the bedrock of conservative accounting. It forces you to face economic reality. Let's say under FIFO, those components cost you $15 each. That's your cost.
Right. And I hope to sell them for $20.
But what if a competitor releases a better product and demand craters? Now, the absolute best price you can get on the open market is $10. That's your market value.
Ouch. So I bought them for $15, but they're only worth $10.
Exactly. The rule dictates how you report this at year end. Lower of cost or market value.
Yeah.
Cost is $15, market is $10. You must select the lower one.
So I have to value my inventory at $10 per unit and just take a massive loss immediately. I can't wait and hope the market recovers.
No, you cannot. You can't inflate your assets with false hope. By forcing the lower figure, rules ensure businesses recognize losses immediately. Banks need to know what your inventory is worth today, not 6 months ago.
That makes a lot of sense conceptually. But what about the second part? Byproducts are valued at net realizable value. Why the different treatment? What even is a byproduct?
A byproduct is a secondary product unavoidably generated when making your primary product, like a petroleum refinery. Their main goal is making gasoline.
Right.
But refining crude oil leaves a heavy residue at the bottom. Asphalt. They didn't build a billion-dollar refinery to make asphalt, but they get mountains of it anyway. It's a byproduct.
Okay, so why not use the lower of cost or market rule for the asphalt? Why not just figure out the cost?
Well, try this thought experiment. How would you calculate the true cost of that asphalt?
Well, they bought crude oil, paid for electricity, paid engineers.
Right. Now, how much of that crude oil cost belongs to the premium gasoline and how much belongs to the sludge at the bottom?
Oh, I see the problem. Any attempt to split those joint costs would just be totally arbitrary. You'd be guessing.
Exactly.
Yeah.
It's practically impossible to assign a precise historical cost to a waste product. So regulators say, don't even try. Just value it at its net realizable value.
Which basically means, what can I realistically sell it for minus the cost of delivering it?
Precisely. If someone buys it for $5,000 and transport costs $500, the net realizable value is $4,500. You put it on the books for $4,500.
This logic is beautiful. Finished goods get lower of cost or market because we know the historical cost. Byproducts get net realizable value because calculating their cost is impossible.
You're seeing the matrix now. So let's look at the second major area of choice, valuation of investments.
The text says, Long-term investments are valued at their acquisition cost. Provision for permanent diminution in value must be made wherever necessary.
Right. So imagine a successful company has surplus cash. They buy 10,000 shares of Tech Corp at $100 a share. Total cost is $1 million. And they intend to hold these for 10 years.
Okay.
According to the rule, that investment sits on the balance sheet at that original $1 million cost year after year.
Wait, pushback time. We just said inventory has to be written down if the market drops. Stocks go up and down every day. If Tech Corp drops to $80 a share, my investment is only worth $800,000. Why don't I have to take a loss?
Brilliant question. The answer hinges on the intention behind the asset. Why do you hold inventory?
To sell it tomorrow for cash flow.
Right. It's a short-term, highly liquid asset.
Right.
Market fluctuations matter today. But a long-term investment is different. You intend to hold it through multiple economic cycles.
Because I have zero intention of selling it tomorrow, the fact that the stock market is having a bad week doesn't actually impact my strategy.
Precisely. If companies adjusted long-term investments for every market dip, their profit statements would look like a chaotic roller coaster.
Yeah.
It would drown out their actual operational performance.
Oh.
So we hold them at acquisition cost to ignore that temporary noise.
Okay, I'm with you. But what about the exception? Provision for permanent diminution. What counts as permanent?
Diminution just means reduction. A permanent diminution means the value collapsed, and there is no reasonable expectation it will ever recover.
Like what?
Well, if the stock drops to $80 because of interest rates, that's temporary. Ignore it. But what if TechCore's flagship product gets banned, the CEO is arrested for fraud, and they're facing bankruptcy?
Oh, yeah. Then the stock is crashing to $2 and it's never coming back.
Exactly. In that severe scenario, management has to use considerate judgment and concede this isn't temporary. Then the exception kicks in. You must create a provision, officially record the massive loss, and reduce the asset's value on your balance sheet.
Okay, so synthesizing all this. Choosing FIFO changes profit. Deciding if a stock crash is temporary changes the balance sheet. How do we know we can trust any of this? How do we know a CEO won't just call a crash temporary to save their job?
That is the multi-million-dollar question, and it brings us directly to the core framework, the 3 pillars of selection. This is the compass for navigating these choices.
Listeners, if you're prepping for an exam, pay attention. The text says there are 3 major characteristics that must be considered: prudence, substance over form, and materiality. And the ultimate goal is a true and fair view of the financial state.
Right. True and fair view. That is the ultimate yardstick. Every choice has to serve that goal. So, pillar 1, prudence. How would you translate that?
Prudence means playing it safe, being cautious, not overestimating profits, preparing for losses.
Exactly. It's institutionalized conservatism. You never overestimate profits, and you prepare for losses the second you see them coming.
It's like boarding up your house for a hurricane. You prepare for the storm, even if it might miss you, but you don't celebrate until the sun is actually shining.
That's a perfect visual. You don't record a win until the cash is in hand, but you record a loss when you see the clouds.
Wait, this loops back to the inventory rule, valuing finished goods at the lower of cost or market value.
Let's trace that logic. How does that prove prudence?
Because of the asymmetry. If the market value drops from $15 to $10, I have to recognize the loss immediately. But if it skyrockets to $50, I don't get to claim a $35 profit, right?
Absolutely not. Not until you actually sell it. That asymmetry is the very definition of prudence. It ensures financial statements never paint an artificially rosy picture.
And spoiler alert for the exam, this connection is heavily tested. If a question asks which principle drives the lower of cost or market rule, the answer is prudence.
Exactly. So let's move to pillar 2, substance over form. The text mentions it briefly, but it's staggering.
It sounds cryptic. What does it mean?
It dictates that the economic reality, the substance of a transaction, must take precedence over its legal technicality, its form.
I need a concrete example. How can legal paperwork not be the reality?
Imagine you need a custom industrial stamping press. It costs $5 million. You don't have the cash, so you sign an exclusive 10-year lease agreement with an equipment company.
Okay, I'm leasing it.
The terms say the press lasts exactly 10 years.
Good.
You pay for all maintenance, insurance, bear all the risk, and keep 100% of the profits it generates.
Got it. What is the legal form of this transaction?
The legal form is that you are just a renter. The leasing company owns the title. If an auditor only looked at the form, they'd say, you don't own it, so it doesn't go on your balance sheet as an asset, and you don't record the massive lease liability, just a monthly expense.
But wait, the substance, the economic reality, is that I have total control over this machine for its entire useful life. I take all the risks and get all the rewards. When the 10 years are up, it's just scrap metal. For all practical purposes, I bought the machine on an installment plan.
You hit the nail on the head. And that is why substance over form intervenes. It demands you ignore the legal technicality of being a renter. You must record that $5 million press as an asset and record the lease as a massive liability.
Fascinating. Because if you hid behind the legal form, your balance sheet would be a lie. It wouldn't show the massive asset you control or the huge debt you owe.
Exactly. It prevents lawyers from structuring deals just to keep debts off the books. Accounting cares about what's actually happening in the real world.
Okay, pillar 3, materiality.
This is the common sense filter.
Let me test it. Say I'm the CEO of a $10 billion logistics corporation. During an audit, we find a $50 counting error in our safety vests. Does that ruin the true and fair view?
No, you're protected by materiality. You only focus on information significant enough to influence the economic decisions of users.
So, would a Wall Street analyst change their recommendation over a $50 error on a $10 billion company? Obviously not. It's totally irrelevant.
Therefore, that error is immaterial. But materiality is relative to the size of the enterprise.
What if I'm a tiny family landscaping business, my total profit is $15,000, and I have a $5,000 error valuing my lawnmowers?
Well, in that environment, a $5,000 error is incredibly material. Finding out your profit is a third lower would absolutely change a local bank's decision to give you a loan. Materiality keeps you focused on the numbers that actually move the needle.
Okay, we have the 3 pillars, but I want to pivot to a warning in the text. I call it the footnote fallacy.
Ah, yes, a critical boundary.
The text says, disclosure of the treatment adopted is necessary, but disclosure cannot rectify a wrong or inappropriate treatment. Let's role play. A company has a warehouse of worthless, obsolete smartphones. Market value is 0, but they violate prudence and leave them on the balance sheet at full cost.
A fundamentally broken balance sheet.
Right. But the CEO says, hey, we value transparency. We put a footnote on page 142 saying we didn't write down the inventory. We disclosed it. We're good, right?
Ultimate fallacy. You cannot fix a broken balance sheet with a footnote.
But why? If the info is there, won't the market figure it out?
Think about how information is consumed. Algorithmic trading, busy loan officers.
Yeah.
What are they looking at?
The headline numbers. Total assets, net profit.
Exactly. If management used an inappropriate policy to calculate those top-line numbers, those numbers are deceptive. You cannot publish a lie in massive print on page 1 and claim innocence because you confessed in microscopic font on page 142. The math must be correct in the first place.
I love that. You can't fix a broken window with a sticky note that says window is broken.
Exactly right.
Which brings us to changing the rules. We know businesses have choices. But once they pick a policy, are they locked in forever? Can they just switch from FIFO to average whenever they want?
They aren't locked in forever, but changing is heavily guarded because of consistency. Financial statements are only useful if they can be compared over time.
Right. If the CEO is having a bad year, they just switch policies to magically boost profits.
Exactly. So the source material outlines 3 and only 3 strict conditions for changing a policy.
Condition 1.
Required by statute, the law. If the government passes a new tax law that mandates a new policy, you have to change.
Makes sense. Condition 2.
Required for compliance with an accounting standard. If the ICAI outlaws an aggressive revenue method, you must comply.
Both of those are external forces. What about voluntary changes? Condition 3.
A company can change voluntarily if they can prove it results in a more appropriate presentation of the financial statements.
That sounds like a loophole. More appropriate.
That's where auditors come in. Management has to prove the new policy paints a truer picture. The text gives a great case study, Omega Enterprises.
Yes. The text says, Omega Enterprises revised its accounting policy relating to valuation of inventories to include applicable production overheads, as it believes such change would result in a more appropriate presentation. What were they doing, and why change?
Let's say Omega makes custom bicycles. Under their old policy, the cost of a bike in inventory only included direct materials, titanium tires, and direct labor, the mechanic's wage.
What were they missing?
The applicable production overheads, the massive electricity bill for the factory, depreciation on the building, the supervisor's salary.
Oh, and under the old policy, those were just immediate expenses on the P&L.
Right.
But logically, you can't build the bike without the factory roof and the electricity. Those costs are undeniably tied to the physical asset.
Exactly. Omega realized their old policy mathematically understated the true cost of producing the bikes. So they changed it. They started attaching a fraction of the electricity and supervisor salary to the value of each bike in inventory.
That undeniably paints a truer, more robust picture. It satisfies condition 3. But there's a massive catch, right? The rule of quantification.
The absolute linchpin, the text mandates. Unless the effect of such change is quantified, the financial statements may not help the users.
Why is this so crucial?
Let's run the math on Omega. By taking those massive overhead costs and attaching them to inventory on the balance sheet instead of expensing them immediately, what happens to profit?
Well, expenses go down, so profit shoots through the roof.
Exactly. An investor looks at the headline. Last year, profit was $2 million. This year, under the new policy, it's $3 million.
I'm thinking, wow, they had an incredible year. The business is booming.
But physical sales might be completely flat. That entire $1 million jump could just be the accounting mechanics of moving overhead costs.
That's terrifying. It's a mirage.
And that's why quantification is sacred. Regulators say, fine, change your policy, but you must publicly quantify the exact mathematical effect. Omega had to put a note saying, our reported profit is exactly $1 million higher purely because of this policy change.
Oh, so it gives the investor the key to reverse engineer the illusion. They can see the true operational profit is still just $2 million.
Precisely. It restores comparability.
All right, this is a brilliant framework. Let's do a rapid-fire review using the exact true-false questions from the text to test exam readiness.
Let's do it.
First one. There is a single list of accounting policies which are applicable to all enterprises in all circumstances.
What do you think?
Based on the steel mill versus startup discussion, that's undeniably false. The environments are too diverse for one list.
Spot on. False. Next.
True or false? Selection of accounting policy doesn't impact financial performance and financial position of the business.
The most dangerous misconception.
Right, it's completely false. Our FIFO versus average example proved it massively impacts reported profit and asset value.
Exactly. How about this? A change in accounting policies should be made as and when business like to show result as per their choice.
False. That's anarchy. You can only change based on the 3 strict conditions, statute, standard, or more appropriate presentation.
Correct. What about choosing FIFO or weighted average method for inventory valuation is selection of accounting policy?
True, because the policy is the combination of the principle, valuing inventory, and the specific method chosen, FIFO or average.
Perfect. Last tricky one. Selection of an inappropriate accounting policy decision will overstate the performance and financial position of a business entity every time.
The trap is every time. We established it's false. An inappropriate policy could artificially understate profits if a company was trying to dodge taxes. It just distorts the truth, but not always in one direction.
Flawless logic.
And one multiple choice recap. Zeta Enterprises states that inventories are valued at the lower of cost, or net realizable value. Which principle is followed?
The built-in asymmetry we discussed.
Yes, playing it safe, anticipating losses but not gains. That is the pillar of prudence.
Exactly right.
This has been an incredibly rewarding deep dive. As we wrap up, can you give us the ultimate executive summary?
Absolutely. 4 main takeaways. First, accounting requires profound considerate judgment, combining non-negotiable principles with specific situational methods. Second, choices are ended by 3 pillars. Prudence, play it safe, substance over form, economic reality over paperwork, and materiality, focus on what matters.
Got it.
Third, remember the footnote fallacy. Transparency doesn't fix a fundamentally broken policy. The math must be sound. And finally, consistency is paramount. You can only change policies under strict conditions, and you must quantify the financial impact so investors can see the true performance.
Masterclass summary. And for the exam candidates, here's a mnemonic to remember those 3 pillars. Think PSM, prudence, substance over form, materiality, or please show meaning, because a good policy cuts through the noise and shows the true economic meaning.
Please show meaning. I love that.
We started by saying we want numbers to be a clean binary X-ray, but we found out the financial landscape requires choices, judgments, and a robust framework to prevent manipulation.
It really does. And, it leaves us with a provocative thought. If 2 identical companies can ethically report totally different profits simply by legally choosing different accounting policies, is accounting truly a rigid science, or is it actually a heavily guarded art form?
The art of the balance sheet. That is a potent thought to chew on the next time you see a company announce record profits. Keep questioning the narrative behind the numbers, folks. Thanks for joining us on this deep dive.
Imagine you're looking at a company's balance sheet, right? You're scrolling down, and you see this factory machine valued at exactly $1 million.
Oh, yeah, the classic $1 million asset.
Exactly. And the font is crisp. All the columns line up perfectly. It's got the auditor's signature at the bottom. It looks incredibly official.
It looks like hard science.
Yes, it looks precise, almost like physics or engineering. But here is the secret that most people outside of finance just don't know. That number. It might be a total illusion.
A complete mirage, honestly.
Right. I mean, it could be what the company paid for the machine like a decade ago.
Yeah.
Or it could be what they could pawn it for this afternoon in a fire sale.
Or, and this is the really wild one, it could just be this highly theoretical guess, like a guess about the amount of cash that machine will magically generate over the next 5 years.
Right. And that precision we see on the page, it's essentially just made up. Well, not made up, but
It's constructed. I mean, people assume accounting is this binary diagnostic science. Like, you look at an x-ray and the bone is broken or it isn't, right?
yeah, exactly.
So they look at a balance sheet and think, okay, the asset is worth $1 million or it isn't. But the reality is just far murkier than that.
Which is exactly why treating accounting as a pure measurement discipline gets so incredibly complicated. The number on that page is entirely dependent on a specific set of rules.
Rules, assumptions, time frames, basically whatever the person writing the number decided to apply that day.
So today in this deep dive, we are going to break that illusion completely. We are stripping away the rigid memorization that usually plagues this subject, and we're looking at the actual engine of financial valuation.
We're building a mental framework today.
Yes, a framework so you can look at any financial statement and immediately know the why and the how behind the numbers, not just the what.
Right. We'll decode the philosophy of measurement, uncover the massive flaw in the monetary system that accountants literally just have to live with. Yeah.
And break down those 4 specific valuation principles that basically run the global economy. So, okay, let's unpack this.
Close it. So to even begin putting a number on a page, you first have to ask this surprisingly philosophical question, right? Like, what does it actually mean to measure something?
Oh, man, yeah. Getting real deep right out of the gate.
Well, Professor R.J. Chambers, he established this widely accepted definition for it. He described measurement as the assignment of numbers to objects and events according to rules.
Assignment of numbers to objects and events according to rules. I mean, on the surface, that sounds really obvious, right?
It does. But think about trying to measure a subjective concept without any rules.
Oh, right. Like, if you ask 5 different people to measure how good a movie is, you get total chaos.
Exactly. One person gives it 4 stars, another says, it's an 8 out of 10, someone else just gives it a thumbs up.
Yeah, there's no standardization there at all. The numbers mean absolutely nothing because the rules aren't shared between those people.
Precisely. And the type of numbers we use matters immensely here. In everyday life, and even in fields like economics, people frequently rely on ordinal numbers.
Ordinal, okay, so
Like-
that denotes position
Right.
in a sequence.
Right. First, second, third. They establish rank. So if an economist is measuring consumer utility, satisfaction, they might observe that a person prefers buying a laptop first
A smartphone second.
and a tablet third. It just tells us the hierarchy of preference.
But ordinal numbers are basically utterly useless for a balance sheet, aren't they?
Totally useless.
Because a ranking doesn't tell me the distance between the items. Like, the consumer might prefer the laptop to the smartphone by a massive margin, but maybe they prefer the smartphone to the tablet by only a tiny hair.
Exactly. An ordinal ranking of 1, 2, and 3 just completely hides the actual gap in value.
Which is why accounting demands cardinal numbers.
Cardinal number, yes. They denote quantity, like how many? 1, 2, 3, 4. It forces actual quantification.
So we don't just say, the factory is our first most valuable asset and the delivery truck is the second. We assign a cardinal monetary surrogate.
Right. The factory represents 2 million units of currency, and the truck represents 50,000 units. The entire discipline of accounting is chained to that cardinal quantification.
Okay, so knowing we need cardinal numbers still leaves us needing a methodology, right?
No.
Whenever I'm analyzing a valuation model, I run it through this mental filter. I have to make sure the measurement is structurally sound. I use the acronym ISE.
ISE. I like that.
Yeah, I think of it as I see everything. Identify, select, evaluate. If a financial model is missing even one of those 3 elements, The whole measurement just collapses.
It really does. And breaking down that framework reveals the real structural pressure points of accounting. Let's start with the I.
The identification of objects and events to be measured.
Right. You have to clearly define the perimeter of what you're observing. In accounting, the objects and events are basically economic information.
Which means what, practically?
It encompasses past transactions, present states of affairs, and predicted future events.
Okay, wait, let me challenge that definition of events for a second. If I'm running a local bakery and I buy a new industrial oven, that is clearly an event, right? I have a receipt. I can identify it.
Sure, that's a straightforward transaction.
But what if my master baker, like the person who holds all the secret recipes in their head, suddenly quits?
Oh, that's a huge blow.
Right. That is a massive economic event for my business. My future revenue is in serious jeopardy. But I can't easily assign a cardinal number to the departure of an employee.
No, you can't. And that limitation is a very well-known boundary of the discipline. Accounting really struggles to measure qualitative human capital, despite its, profound economic impact.
It just doesn't fit neatly on the spreadsheet.
Exactly. The identification phase restricts us primarily to events that can be reliably linked to financial transactions or contractual obligations.
Which feels a bit narrow sometimes.
It is. Furthermore, the identification of future events like predictions of what that oven will produce or the revenue the bakery will generate, that really pushes the boundaries of strict measurement.
Because you can't measure something that hasn't happened yet.
Exactly. Predictions aren't measured, they're estimated. They're based on logic and probability. Yet, they are fundamentally necessary because the end users of financial statements, like banks or investors, they mostly care about future cash flows, right? Not just historical trivia.
Yeah, they want to know if they're going to get their money back tomorrow. Not what you did yesterday. Okay, so once we've identified the event, say, buying that industrial oven, we move to the S in our filter. Selection of the standard or scale.
The standard or scale, yeah.
Like if a carpenter is measuring a piece of wood, the scale is a tape measure using inches or centimeters. The scale for accounting is just money, right? It's a universal yardstick.
It is. The money measurement concept is basically the bedrock of the entire system.
But what about other details, like the number of ovens or employees?
Right, quantitative information, the physical number of ovens purchased or the head count of the bakery staff that's often provided in supplementary notes. But the primary scale through which all economic events are synthesized and communicated, that's currency.
Okay, which brings us to the E in the framework, and frankly, what I think is the most fragile part of the entire global financial system.
The evaluation of the dimension.
Yes, evaluation of the measurement scale. Basically, we have to evaluate our ruler, and the moment you evaluate money as a ruler, you realize it is fundamentally defective.
It really is.
Money is a wobbly ruler.
A wobbly ruler, that's the perfect way to put it. Think about the carpenter's tape measure again. It's stable. A centimeter in Tokyo is a centimeter in London, right?
If physics doesn't change.
Exactly. A centimeter today is the exact same length it will be 50 years from now. The physical dimension is absolute. But money lacks both geographical universality and temporal stability.
And that lack of geographic universality is just a massive headache for international business. Let's look at a supply chain scenario for a second.
Sure.
Imagine a local manufacturer in India, right? They sign a contract to buy specialized raw materials from a supplier in the United States.
Okay, pretty common.
Right. And the deal is structured as a short-term liability. The Indian manufacturer agrees to pay $5,000 upon delivery. On the day the contract is signed, let's say the exchange rate is exactly 50 rupees to $1.
So the manufacturer records a liability of 250,000 rupees.
Exactly. The transaction is locked in.
Yeah.
The physical quantity of the raw material hasn't changed. The $5,000 obligation hasn't changed. But let's say 3 months later, when the payment is actually due, macroeconomic forces shift the exchange rate.
As they always do.
Right. And now $1 equals 55 rupees.
Oh, wow. So the manufacturer's liability just ballooned to 275,000 rupees.
Exactly. They didn't borrow more money. The supplier didn't ship more material. The underlying economic reality of the transaction remained completely static.
But the measurement on the balance sheet grew by 25,000 rupees purely because the measuring stick warped in transit.
It's crazy when you really think about it.
It is. And, the problem of exchange rates is difficult, but the temporal instability of a single currency, I'm talking about inflation, is far more insidious.
Right, because that affects everyone even if you never cross a border.
Exactly. This is the core issue with the evaluation of dimension. The purchasing power of money changes constantly due to shifting input and output prices. The amount of money required to buy a specific basket of identical goods varies dramatically depending on the date of purchase.
And to see what happens when the ruler completely shatters, we only have to look at extreme historical examples, right? Like Weimar Germany in 1923 or Zimbabwe in 2008.
Right, hyperinflation, where rates hit billions of percent per month.
At that point, traditional accounting just breaks down completely. A company could sell a single loaf of bread and record revenue that was technically higher than their entire corporate earnings from the previous decade.
Yeah, the cardinal numbers go into the trillions, but the actual economic value is just evaporating.
It's wild. But while hyperinflation is an extreme case, standard, everyday inflation creates a pervasive distortion that can easily fool an untrained observer.
It creates what we call the illusion of growth.
Let's walk through a visceral example of this illusion, because understanding this dynamic is just non-negotiable for true financial literacy. Let's look at a boutique custom furniture builder.
Okay, let's lay out the numbers.
So in year one, this builder completes and sells 5,000 handcrafted wooden chairs. They sell them for a total top-line revenue of $500,000.
Got it. 5,000 shares, 500,000 revenue.
Right, and the cost of the timber, the labor, and the workshop rent to produce those 5,000 chairs comes to $400,000.
So revenue of 500,000 minus costs of 400,000 leaves a gross profit of 100,000.
Exactly, a solid, successful year one. But then in year two, macroeconomic inflation hits the timber supply chain and the broader economy. Prices just surge.
So the builder has to raise their prices.
They have to. But the higher prices cool off demand slightly. So in year two, they only managed to build and sell 4,500 chairs.
That's a drop in volume.
Yes, but due to their higher price tags, their total top-line revenue comes in at $540,000.
Ah, okay. And what about their costs?
Well, their costs to produce those 4,500 chairs, keeping in mind more expensive timber and rent, come out to $450,000.
So let's do the math there. Revenue of 540,000 minus costs of 450,000. That leaves a gross profit of 90,000.
And here's the trap. If an amateur investor or, a distracted bank manager just glances at the income statement, their eyes are drawn to the biggest cardinal number, top-line revenue.
Of course. They see year one at 500,000 and year two at 540,000.
Right, that's an 8% increase in sales revenue. They start popping champagne, assuming the furniture business is expanding and capturing more market share.
But the underlying physical reality tells a completely different story. A story of contraction, not expansion.
Exactly. The actual volume of production, the physical number of chairs leaving the workshop, dropped from 5,000 down to 4,500.
That is a 10% decline in operational output.
And the gross profit confirms the bleed. It dropped from 100,000 down to 90,000. A true 10% decline in the money the business actually gets to keep.
So that 8% top-line growth was a complete phantom.
A total phantom. It was just an artifact of the wobbly ruler expanding due to inflation, masking the operational shrinkage of the company.
This is the definitive proof that accounting cannot be classified as an exact, pure measurement discipline. It relies on a scale that lacks a constant dimension. The numbers are always subject to environmental distortion.
But here's the thing. If the ruler is this inherently flawed, and the numbers are subject to this phantom inflation growth, why do we trust the system at all?
That's a fair question.
Right, like if I'm auditing a company and I know their unit of measurement is functionally warping year over year, why isn't the entire practice considered just a chaotic guessing game?
Because the discipline has evolved an immune system.
An immune system.
Yeah. To prevent the wobbly ruler from causing total systemic collapse, the accounting profession enforces a rigid structure of foundational theorems. We commonly call these fundamental accounting assumptions.
Okay.
And unless these assumptions are rigidly adhered to, we can't even progress to the basic mechanics of bookkeeping.
And those assumptions are going kernel, concern, consistency, and accrual rate.
Exactly. They act as the stabilizing gyroscopes for the wobbly ruler.
So how do they stabilize it? Walk me through that.
Well, the going concern assumption dictates that we assume the business will continue operating indefinitely. We aren't valuing that factory oven you mentioned earlier based on a desperate liquidation sale tomorrow because we assume the bakery will still be baking bread next year.
That makes sense. We assume it's a living entity, not a dying one.
Right. Then there's consistency. This demands that whatever rules management chooses to apply, they must apply them the same way year after year.
Because if you change your ruler every single reporting period, comparison becomes impossible.
Exactly. And finally, accrual. This ensures we record the economic reality of an event when it actually happens, not just when the cash happens to clear the bank account.
So the existence of those rules really highlights that accounting is a massive architectural subsystem. It involves recording, classifying, summarizing, and communicating. The actual measurement part is just one gear in a very complex machine driven by policies and estimates.
Which forces a very practical dilemma, honestly, because even acknowledging the philosophical flaws of money and the necessity of these assumptions, an accountant still has a legal obligation to write a cardinal number on the balance sheet for every asset and liability.
Yeah, you can't just leave it blank and say it's too wobbly.
Exactly, you have to write a number down.
So how do you decide what number to write down? If the measurement is flawed, how do you value reality?
This brings us to the operational core of financial reporting, the 4 valuation principles.
Okay, here we go. Whenever I analyze an asset's listed value, I always filter it through the acronym HCRP.
HCRP, let's hear it.
It stands for historical cost, current cost, realizable value, and present value. I use the memory trick. How can reality pay? To remember them.
How can reality pay? That's clever. Let's dissect the mechanics of each principle then, beginning with the bedrock of traditional bookkeeping, historical cost.
I think of historical cost as the receipt. It is grounded entirely in the past. It does not care about inflation. It does not care about market trends. It only cares about what actually transpired on the day the asset was acquired.
Perfectly said. Under historical cost, an asset is recorded at the amount of cash or cash equivalent paid at the time of its acquisition.
And it's super popular, right?
Very. It's favored heavily by traditional systems because it is highly objective. You can physically point to the invoice. The auditor can verify the exact outflow of capital.
Let's ground this in a tangible corporate scenario for the listener. Imagine a logistics company buys a heavy-duty freight truck. The sticker price of the truck is $700,000.
Okay, $700,000.
But to get the truck legally ready for commercial hauling, they have to pay an additional $100,000 for, specialized cargo modifications and regulatory licensing fees before it can drive a single mile.
A very common real-world situation. And a common point of confusion for students is whether those secondary costs are expensed immediately or added to the valuation of the asset.
So what's the rule? Do we include the installation and modifications?
Under the historical cost principle, the valuation includes the total cost necessary to bring the asset to its intended working condition.
So we add them.
Yes. Therefore, the acquisition price of $700,000 plus the modification costs of $100,000 dictates that the historical cost of the truck is definitively $800,000.
Okay, so the asset side is locked at $800,000. How does the receipt method handle the liability side? Suppose the logistics company funded that truck by taking a $500,000 loan from a commercial bank at a 10% annual interest rate.
Liabilities are recorded at the amount of proceeds actually received in exchange for the obligation.
Proceeds actually received.
Right. So the company legally owes the bank the principal plus all that future interest, but the actual proceeds that hit their bank account on day one was just the $500,000. So the historical cost of the liability is recorded as $500,000.
Makes sense. But there is an interesting edge case with liabilities under historical cost, specifically regarding obligations where there is no initial inflow of proceeds, like income tax.
Yes. Income tax is a primary example of an operational liability. Under the historical cost framework, in specific circumstances like taxation, a liability is recorded at the amount of cash or cash equivalents expected to be paid to satisfy the obligation in the normal course of business.
Because you don't receive proceeds from the government to generate a tax bill.
Right. You generate revenue, which triggers a statutory obligation, so the liability is recorded based on the current tax rates applied to your taxable income.
Got it. So historical cost provides a comforting level of certainty, but it completely ignores the passage of time. Like if a company bought prime commercial real estate in downtown Manhattan in 1975 for $1 million, the historical cost model keeps that asset on the books at $1 million for decades.
Completely ignoring the fact that the property is now worth, what, $50 million?
Exactly. And that glaring blind spot regarding economic reality is why alternative measurement bases have to exist.
Which moves us to the C in our HCRP filter, current cost.
I call this one the time machine. It essentially asks a hypothetical question. If our entire logistics fleet was vaporized by a meteor tonight, what size check would we have to write tomorrow morning to replace it?
That's a vivid way to put it, but accurate. Current cost shifts the temporal focus from the past to the present. Assets are carried at the amount of cash or cash equivalents that would have to be paid if the same or an equivalent asset was acquired currently.
Okay, so let's go back to our truck. The logistics company bought their freight truck back in 2011 for a historical cost of $800,000. 11 years pass. It is now 2022. They look at the current commercial vehicle market.
And prices have gone up.
Way up. To buy a brand new equivalent heavy-duty freight truck today with the same modifications, the price tag has surged to $2,500,000 due to inflation and supply chain shortages.
So under current costs, the valuation of the asset is updated to $2,500,000.
It jumps from $800K to $2.5 million.
Yes. The theory is sound, but in practice, current cost requires intense managerial judgment. Finding an equivalent asset is often nearly impossible.
Yeah, especially with technology.
Exactly. If a tech company is using specialized server architecture from 5 years ago, the manufacturer likely doesn't even make those parts anymore. Determining the current cost requires pricing out modern equivalents and adjusting for technological advancements.
Which injects a heavy dose of subjectivity into the valuation. It's not an exact science anymore.
Not at all. And if the asset side is tricky, the liability side of current cost is equally aggressive.
How so? Let's return to our $500,000 commercial loan taken out in 2011. How does the current cost principle revalue a past obligation?
Under current cost, liabilities are carried at the undiscounted amount of cash or cash equivalents that would be required to settle the obligation currently.
To settle it right now.
Right. Let's assume the original loan agreement included a 1% prepayment penalty if the borrower decides to clear the debt early.
Okay, 1% of the $500,000 principal is $5,000.
Therefore, if the logistics company wanted to erase that liability from the universe today, they would have to write a check for $505,000. That is the current cost of the liability.
Fascinating. So, historical cost looks backward at what we actually paid. Current cost looks sideways at what we would have to pay to replace it.
Yeah.
Now we move to the R, realizable value. I think of this as the garage sale.
The garage sale. Okay, I see where you're going.
It shifts the perspective entirely from buying an asset to selling it.
Right. Realizable value dictates that assets are carried at the amount of cash or cash equivalents that could currently be obtained by selling the asset.
So if the logistics company decides to pivot their business model and sell off their aging 2011 freight truck today on the secondary market, they do some research and determine they could get $2 million for it. That $2 million becomes the realizable value.
Exactly. But there is a massive caveat attached to this principle, and this is crucial for exams. It prevents companies from artificially deflating their balance sheets during a crisis. The valuation assumes an orderly disposal.
An orderly disposal, meaning what exactly?
It assumes the company has sufficient time to market the asset to find a willing and informed buyer in a normal market environment.
So not a fire sale.
Exactly. If a company is facing imminent bankruptcy and is forced into a haphazard or distressed fire sale, like liquidating a $2 million truck for $500,000 in cash overnight just to make payroll, that distressed price does not represent the true realizable value of the asset under normal accounting principles.
Got it. And on the liability side, realizable value is commonly referred to as settlement value.
Right. Correct. The settlement value is the undiscounted amount of cash expected to be paid to satisfy the liabilities in the normal course of business. For the commercial loan, if the company plans to just pay it off according to the normal schedule without triggering prepayment penalties, the settlement value of the principal remains $500,000.
In the real world, though, where do we see realizable value actually utilized? Because you don't usually see companies marking up their factories to what they could sell them for every quarter.
No, you don't. It is predominantly used in the valuation of inventory. There is a universal, very conservative accounting convention. Inventory is always measured at the lower of its historical cost or its net realizable value.
Oh, lower of cost or market. Okay, give me an example of that.
Sure. If a clothing retailer spends $50 manufacturing a winter coat, the historical cost is $50. But if a mild winter causes demand to crash and they can only sell that coat for $30 in an orderly clearance sale, they must write down the value of their inventory to the $30 realizable value.
So they're forced to recognize the economic loss before the cash transaction even occurs.
Exactly. It's a fundamental principle of prudence.
Prudence, right. Okay, that brings us to the final and most structurally complex valuation principle, the P in HCRP present value. I refer to this as the reverse interest account.
Reverse interest. I like that.
Yeah, because we are no longer looking at the asset as a physical object to be bought or sold. We are looking at the asset entirely as a vehicle for generating future cash.
Present value really is the beating heart of modern corporate finance. Under this base, an asset is carried at the present discounted value of the future net cash inflows that the item is expected to generate in the normal course of business.
And liabilities.
Liabilities are carried at the present discounted value of future net cash outflows required to settle them.
Okay, to understand the mechanism of present value, we really have to unpack the concept of discounting. Because why do we intentionally shrink the value of future money? Let me pose the classic economic dilemma to you.
All right, lay it on me.
If I offer you $100,000 in cash today, or the exact same sum of $100,000 in cash exactly 10 years from now, which do you take?
I take the money today. Any rational economic actor takes the money today.
Right, but the physical currency might be identical. So why is the economic utility vastly different?
It's because of the time value of money.
And what forces drive that time value? Like, why is waiting a sacrifice?
There are three primary forces. First, opportunity cost. If I take the $100,000 real estate, a new business, and generate a return over the next 10 years.
So if you wait, you forfeit a decade of compound growth.
Exactly. Second, inflation. As we discussed with the wobbly ruler, the purchasing power of that $100,000 will almost certainly be lower in a decade. It will buy fewer goods.
Your 100 grand in 10 years might only buy what 60 grand buys today.
Right. And third, risk. The future is inherently uncertain. The entity promising me the money in 10 years might go bankrupt. Taking the money today eliminates the risk of default.
So, because waiting involves sacrificing opportunity, suffering inflation, and absorbing risk, a rational investor demands compensation. If you want me to wait 10 years, you have to offer me a premium. Maybe $150,000 instead of $100,000.
Precisely. Therefore, to equate future money to present money, we must deflate or discount the future cash flows by a specific interest rate that represents those three forces.
Okay, let's apply this mechanism back to the logistics company's 2011 freight truck. Let's say it is currently January 1st, 2022. The company conducts an operational analysis and determines the truck can reliably haul freight for exactly 10 more years.
Okay, 10-year remaining lifespan.
Right. Based on current freight rates, minus fuel and maintenance, they project the truck will generate a net cash inflow of $100,000 every single year for the next decade.
So over 10 years, that truck will physically deposit $1 million in raw cash into the company's bank account.
$1 million. But we can't value the truck at $1 million today because that cash is trapped in the future.
Right. We must discount each future payment back to the present day. Assume management determines the appropriate discount rate reflecting their cost of capital, and the risk of the logistics market is 20% per annum.
20%, okay.
We have to treat this stream of cash flows as an annuity. We don't need to get bogged down in the algebra, but the mechanism is crucial.
Yeah. Let's just look at the high-level math.
So the $100,000 they receive at the end of year one is only slightly delayed. Discounting it back 1 year at 20% means the present value of that first payment is roughly $83,333.
Okay, so it shrank a bit. But as we move further into the future, the discounting effect compounds, right?
It compounds and severely degrades the present value. The $100,000 payment expected in year 5, when discounted back 5 years at 20%, is only worth about $40,188 today.
Wow. More than half of its value is gone.
And that final $100,000 payment they expect to receive in year 10, they have to wait a full decade for that cash, absorbing 10 years of opportunity cost and inflation risk. Today, the present value of that distant year 10 payment is a minuscule $16,150.
Wait, really? Just $16,000?
Just over $16,000, yeah.
That is wild. So when you sum the present value of all 10 of those discounted cash inflows, what's the total?
The total comes to $419,246.
So despite the fact that the truck will eventually yield $1 million in raw cash over the decade, the economic value of that asset sitting on the tarmac today is mathematically quantified as just $419,246.
Exactly. And the reverse interest account works identically for liabilities.
Okay, so applying this to our commercial loan.
Right. The logistics company has a commercial loan that requires annual interest payments of $90,000 plus the repayment of the $500,000 principal at maturity. If you project all those future cash outflows and discount them back to today at the same 20% rate, the present value of the liability calculates out to $470,094.
Okay, let's just pause and look at the entire HCRP spectrum for this single truck because it really reveals the true subjectivity of measurement.
Go for it. Let's compare them.
Historical cost was $800,000. Current cost was $2,500,000. Realizable value was $2 million, and present value is $419,246.
4 distinct, Legally defensible, mathematically accurate numbers describing the exact same physical asset.
Which completely proves the opening point of this deep dive. $1 million asset on a balance sheet is an illusion until you read the footnotes and uncover which specific measurement-based management decided to use.
Exactly. And modern accounting frameworks generally utilize a hybrid approach.
Oh, they mix and match.
All the time.
Hmm.
They might use historical costs for the land the warehouse sits on, realizable value for the spare parts inventory, and present value for long-term equipment leases.
It's a mosaic. Okay, so up until this point, we have primarily discussed measuring events with somewhat defined parameters, right? A truck you bought, a loan you signed, an inventory you hold.
Things that have some concrete anchor.
Right. But the final layer of financial measurement involves quantifying pure uncertainty. We are entering the realm of accounting estimates.
The art of educated guessing.
Yeah, because you can use a historical receipt to measure the cost of a desk, but you cannot use a receipt to measure whether a client is actually going to pay their invoice next month.
You can't. Business operations are continuously shattered by inherent uncertainties. Not every financial transaction resolves neatly within a single accounting period.
But management still has to put numbers on the page regarding these unresolved items, right? To provide a faithful representation of the company's financial health.
Exactly. This necessitates accounting estimates. Estimates are required when items cannot be measured with absolute precision. Management basically has to exercise logic, rely on historical data, and use the latest available information to synthesize a cardinal number.
The source material highlights 4 highly testable, real-world operational scenarios where accounting estimates are not just optional, but mandatory. Let's run through them. The first involves the amortization of intangible assets, specifically patents.
Right. Let's contextualize this for the listener. Say a technology firm spends $1,000,000 developing a revolutionary new software algorithm and successfully patents it.
So they have an asset worth $1 million, but software doesn't last forever.
No, it doesn't. Intangible assets don't suffer physical wear and tear like a freight truck, but they suffer from technological obsolescence.
Someone builds a better algorithm.
Right. So management must estimate the useful life of the patent. How many years will this algorithm generate revenue before a competitor invents something better?
So if they estimate a useful life of 10 years, they amortize or expense 100,000 of that cost every year.
Exactly. But that 10-year time frame is a pure estimate. A disruptive AI could render their algorithm worthless in 3 years, or it could remain the industry standard for 20. It's an educated guess.
Okay, the second scenario involves long-term construction contracts. Imagine an engineering conglomerate tasked with building a multi-billion-dollar suspension bridge. The project is contracted to take 6 years.
Right, and they can't wait 6 years to recognize any revenue. Their investors would panic.
Of course. So to solve this, they use the percentage of completion method. They recognize revenue annually based on the estimated progress of the bridge.
But estimating progress isn't just about counting steel beams. Management must make provisions for unseen contingencies.
Like what?
Potential labor strikes, severe weather delays, supply chain failures for specialized cables. Quantifying the financial impact of events that have not yet occurred requires intense estimation.
And when those estimates inevitably misalign with reality.
It results in excess or short provisions that must be actively managed in future reporting periods.
All right, the third scenario feels a bit counterintuitive at first. Taxes. I mean, most people view taxes as an unyielding mathematical formula dictated by the government.
You'd think so, but while statutory tax rates are fixed, corporate taxation is highly interpretational.
Give me an example.
Okay, a corporation might claim a massive deduction for research and development expenses based on their interpretation of the tax code.
Yeah.
However, they know the National Tax Authority frequently audits and disputes those specific R&D classifications.
Ah, so they know a fight is coming.
Exactly. The company cannot assume their interpretation will survive an audit perfectly. They must estimate the probability of the tax authority rejecting the deduction and create a provision, a liability for the additional taxes and penalties they estimate they will eventually have to pay to settle the dispute.
Wow, so they are actively estimating their own future legal losses.
Exactly.
Okay, the fourth scenario is a classic operational pivot. Equipment obsolescence. Let's look at a manufacturing firm. We'll call them Company XY Ltd. They purchase a specialized packaging machine for $1 million in. Based on past experience, the chief engineer estimates the machine will function efficiently for 10 years.
So they establish a depreciation schedule based on that 10-year estimate.
Right, but let's say 3 years pass. They have depreciated a portion of the asset. Then a massive technological shift occurs in the industry. A new, fully automated packaging standard is introduced globally.
Yeah.
XYLTD's machine is no longer state-of-the-art. The chief engineer reevaluates the equipment and informs management that due to this obsolescence, the machine will only be viable for 3 more years, effectively reducing its total lifespan from 10 years down to 6.
The underlying circumstances upon which the original estimate was based have fundamentally changed due to the arrival of new information.
Which brings us to the absolute most critical regulatory mechanism regarding estimates, and a frequent trap for anyone studying for exams.
Pay attention to this part, folks.
When an estimate proves to be incorrect due to new information, how is the accounting system corrected? The intuitive, almost moral instinct is to rewrite history, right? Like, if we told investors the machine would last 10 years and we were wrong, shouldn't we go back, open up the financial statements for the last 3 years, correct the depreciation schedules, and issue restated accurate historical documents?
Absolutely not. The governing rule is absolute. A change in an accounting estimate does not have a retrospective effect.
We do not rewrite history.
Never. The logic behind this prohibition is market stability. Think about it. If companies were allowed or forced to constantly restate historical financial statements every time a future estimate shifted,
And capital markets would descend into chaos.
total chaos. Investors could never trust a reported earnings figure if it was subject to endless historical revision.
So if the effect isn't retrospective, how do we actually handle the math?
The adjustment is strictly prospective. It applies only to the current period and future periods.
So for XYLTD,
You take the remaining undepreciated book value of the packaging machine as it stands today, and you simply spread that remaining cost over the newly estimated 3-year remaining lifespan. You look forward, you absorb the new reality into your current operations, and you never alter the past.
prospective, not retrospective. That distinction is basically the linchpin of accounting estimates. It forces companies to live with their historical judgments while adapting their future trajectories.
Perfectly summarized.
All right, we have deconstructed the entire architecture of financial measurement today. Let's pull all these threads together to really solidify the mental framework for you.
Let's do the recap.
First, we explored the philosophy of measurement. We require cardinal numbers, not just ordinal rankings, to quantify economic reality. We established the ISE framework, identify the economic event, select the monetary scale, and crucially, evaluate the dimension of that scale.
And evaluating the scale revealed the great flaw of finance. Money is a wobbly ruler.
The wobbly ruler. It lacks geographic universality due to fluctuating exchange rates, and it lacks temporal stability due to inflation. This wobbly ruler frequently creates dangerous phantoms, like that illusion of growth we talked about, where inflating prices mask operational decline.
Right. And third, to prevent the wobbly ruler from destroying the system, the profession relies on fundamental assumptions, going concern, consistency, and accrual.
The immune system.
Exactly, acting as the stabilizing forces for a discipline that is essentially a vast subsystem of policies, not a pure science.
Fourth, we broke down how to actually deploy the wobbly ruler using the HCRP valuation principles: historical costs, the backward-looking receipt; current cost, the hypothetical replacement check; realizable value, the orderly market liquidation; and present value, the reverse interest account, discounting future cash flows to account for opportunity cost and risk.
And finally, we tackled accounting estimates. We acknowledged that uncertainty requires management to make educated guesses regarding patents, construction contingencies, tax disputes, and asset lifespans.
And what's the golden rule of estimates?
Permanence of the past. Changes are strictly prospective. We adapt to the future. We never rewrite history.
Understanding the interactions between these concepts, it really elevates your perspective entirely. You stop viewing a balance sheet as a rigid, infallible document. You start viewing it as a complex narrative, written in a specific dialect of valuation rules, heavily influenced by management's estimation of a completely unpredictable future.
That's the real takeaway here. And we always want to leave you with a conceptual challenge, a way to test these traditional frameworks against the bleeding edge of the real world.
What's the challenge for today?
Consider the entire premise of the wobbly ruler. We spent this discussion analyzing how standard fiat currency warps slowly over time due to macroeconomic inflation, and how accounting struggles to compensate for that relatively gradual distortion. But observe the rising integration of decentralized digital currencies and highly volatile crypto assets into corporate treasuries.
Oh, wow. Assets that don't just experience 5% annual inflation, but can experience 30% swings in purchasing power over a single weekend.
Exactly the stress test I'm pointing to. What happens to the discipline of accounting when the measurement scale doesn't just wobble, but vibrates violently minute by minute?
Yeah, how do you apply the historical cost principle when the denomination of the contract changes value radically between the moment the invoice is signed and the moment the blockchain transaction settles?
It's a huge question. If the world transitions toward hyper-volatile, decentralized measurement scales, will our current framework of assumptions hold, or will the profession be forced to invent a completely new fifth valuation principle just to prevent the balance sheet from shattering entirely?
It's a fundamental question of whether the architecture of traditional finance can survive the physics of decentralized money. The ruler is shaking, and the rules might have to change.
Definitely something to ponder.
Keep that question in mind the next time you see a seemingly perfect, precise number on a financial report. Look past the font, look past the auditor's signature, and ask yourself what rules they use to conjure that number out of thin air. Thanks for joining us on this deep dive. We'll catch you on the next one. Imagine sitting down to play a, high-stakes game of Monopoly.
I love Monopoly.
Right, but halfway through the game, the banker just decides that his $500 bills are actually worth double,
Wait, just out of nowhere?
completely out of nowhere. And then another player decides, well, I don't need to declare the properties I own. I'm just going to keep these cards hidden under the table.
That sounds like a terrible game.
It gets worse. A third player decides they're only going to pay rent when they, personally feel their cash flow is strong enough to support it. So what happens to the game?
I mean, the game breaks down immediately. There's no way to play that.
Exactly. You can't figure out who's winning. You definitely can't trust the bank. And the entire system just collapses into total chaos. And, well, welcome to the global economy without accounting standards.
Yeah, it would be an unplayable game. And honestly, that is not an exaggeration at all. Oh, absolutely. If every single business could just invent their own rules for how to report their income or, their debts and the value of their assets, the financial gears of the entire world would grind to a dead halt.
Because no one would know what the numbers actually mean.
Right. Capital markets rely entirely on trust and, well, comparability. If you remove the rules, you completely remove the trust.
So welcome to this deep dive. Today we are taking a masterclass level journey into the architecture of those rules accounting standards.
Yes, specifically anchoring this in Unit 7 of your curriculum, but, we are going to look way beyond just the textbook definitions.
Because if you're studying for your professional boards, you absolutely need this material to pass. That's a given. But even if you are just, putting a portion of your paycheck into an index fund on your phone.
Right, or if you're just trying to understand why a massive corporation suddenly went bankrupt overnight.
Exactly. You are relying on these frameworks to protect your money.
Yeah.
So our mission today is profound conceptual clarity. We want to understand the why and the how behind the financial language of the world.
I really love that concept of a language. That's the perfect starting point, actually.
How so?
Well, accounting isn't just about crunching numbers in a vacuum. It really is the language of business. I mean, its entire underlying purpose is to communicate the economic reality of an enterprise to the outside world.
So communicating to investors, creditors, employees, the government, everyone.
Exactly. And they do this by publishing financial statements. But if that communication process isn't strictly regulated, you open the door to a very, very dangerous scenario where those statements become misleading.
Okay, misleading how?
Well, the source material uses a really specific critical word here. It says financial statements can become tendentious.
Tendentious. Okay, so they're legally lying, basically.
Pretty much.
Like they're following the math, maybe, but they're manipulating the narrative to express a biased or unfair point of view.
That is the perfect way to phrase it. It's not necessarily that a company is, printing counterfeit money in the basement.
Right.
It's that they are structuring their financial story to hide their flaws. They're painting this beautiful, rosy picture of their corporate health when, in reality, the ship is actively taking on water.
That reminds me of those massive corporate scandals in the early 2000s.
Oh, absolutely. Enron, WorldCom, all of those.
Yeah, where these incredibly complex companies use loopholes to just keep massive debts completely off their main balance sheets.
Right. The numbers mathematically added up on the page, but the picture was entirely tendentious. It was a completely distorted view of the business.
So to prevent that, to ensure transparency and consistency.
And comparability, adequacy, and reliability.
Mhm.
We need standardized accounting principles. We need a shared rule book.
Okay, so if I'm looking at a textbook definition, what actually constitutes an accounting standard? Is it like a law passed by the government?
It's a distinct mechanism. They are written policy documents.
Written by who, though?
They are issued by an expert accounting body or by the government or sometimes another recognized regulatory body. And it's important to note, they don't cover every single little thing a business does.
Okay, so what do they cover?
They cover specific aspects of accounting transactions and events. And specifically, they dictate 4 critical actions regarding these transactions: recognition, measurement, presentation, and disclosure.
Okay, recognition, measurement, presentation, and disclosure. Those 4 words feel like the absolute bedrock of this entire framework.
They are everything.
We were definitely going to spend a lot of time pulling those apart in a minute. But I want to stay at the 10,000-foot view for just a second longer.
Sure.
What is the overarching philosophical objective here? Why do these standard-setting bodies dedicate thousands of hours to writing these documents?
Well, on paper, the stated objective is to promote the dissemination of timely and useful financial information, making sure investors aren't just flying blind. But if you look at the core philosophy, the central engine driving accounting standards, it all comes down to one crucial objective, which is harmonization.
Harmonization.
Yeah.
Like a choir, bringing everything into tune.
Yes, exactly. The harmonization of accounting policies and practices across vastly different business entities.
Okay.
The goal is to basically survey all the diverse, varying accounting practices that people use, evaluate them, and then standardize them into a single cohesive melody.
See, here's where I want to push back a little bit,
Yeah.
because this brings up a memory for me.
Oh, let's hear it.
When I was a kid, I ran a lemonade stand in my neighborhood.
Oh.
And at the end of the day, I counted the cash in my little cigar box, declared myself a brilliant entrepreneur, and considered it all pure profit.
I'm guessing you forgot about overhead.
I completely ignored the fact that my parents had bought the lemons, the sugar, the cups, everything. I was doing simple math, right? Cash in, cash out.
Right.
So if accounting is ultimately just math, why are there diverse practices in the first place? Why does a system based on simple numbers need to be harmonized?
Well, your lemonade stand is actually a brilliant example of why simple cash in, cash out math fails completely in the real world.
Hey, I made like $12.
I'm sure you did.
Yeah.
But you are using what we call cash basis accounting. It completely ignores the economic reality of the liabilities you incurred. In your case, your massive debt to your parents for the raw materials.
Okay, fair point.
Business is just exponentially more complex than a cigar box of cash. It involves a massive amount of estimates, subjective valuations, and long-term judgments.
Give me a scenario where a business has to make a subjective judgment that could actually lead to these diverse practices.
Okay, let's look at a heavy manufacturing company. Let's say they buy a massive industrial robotic assembly line.
Sounds expensive.
It is. Let's say it costs them $10 million today. Now, the engineers estimate this machinery will last for exactly 10 years before it breaks down or becomes totally obsolete.
Okay, so a $10 million capital expenditure that lasts a decade.
Right. Now, as the accountant, how do you record that cost on their profit and loss statement?
I mean, they spent $10 million this year, so I'd put it down as a $10 million expense right now.
But if you do that, if you record a $10 million expense this year, their profits for this year are going to look catastrophically bad, like terrible.
Yeah, that makes sense.
But then for the next 9 years, their profits will look artificially amazing because they are generating all this revenue using a machine that looks like it cost them absolutely nothing during those specific years.
Oh, wow. Yeah, that isn't an accurate picture of their ongoing operations at all.
Exactly. So accountants use a concept called depreciation. They spread the cost of that machine over its 10-year useful life.
So instead of $10 million right now, they take a $1 million expense every single year for 10 years.
Yes, that makes logical sense, right?
Hmm.
That is called straight-line depreciation.
Straight line. Got it.
But, and here is where the diverse practices come in. What if the company's management argues, wait, this robot is going to be running 24/7 in its first 3 years when the technology is cutting edge, but by year 8, we will barely use it.
Okay.
They might choose what's called an accelerated depreciation method.
So taking a bigger hit early on.
Exactly. They might take a $3 million expense in year 1 and only a tiny fraction of $1 million in year 10.
And both of those methods are mathematically sound.
Completely mathematically sound. Both are totally logical interpretations of the economic reality.
But wait, If Company A uses straight-line depreciation and Company B, which is right across the street building the exact same products, uses accelerated depreciation,
Yes.
their bottom-line profit numbers at the end of the year are going to look totally different, even if their actual real-world business performance was identical.
That is the root of the problem. That is exactly why we have diverse practices, and you see this everywhere in finance.
Where else does this pop up?
You see it in how companies value the unsold inventory sitting in their warehouses. Do they value the oldest items first or the newest? You see it in how software companies recognize the revenue from a 12-month subscription.
So there are multiple highly logical ways to interpret the exact same economic event.
Yes. And without standardizing those diverse policies, an investor could look at the financial statements of Company A and Company B, try to decide which stock to buy, and have absolutely no way to make an apples-to-apples comparison.
It's like trying to compare the speed of two cars. But one speedometer is in miles per hour, the other is in kilometers per hour, and neither one of them is labeled.
Exactly. Which leads us directly to the two main goals of harmonization.
Okay, what's goal number one?
The first goal is to eliminate the non-comparability of financial statements. By removing those arbitrary variations, you drastically improve the reliability of those statements.
Makes sense. If you can't compare them, you definitely can't rely on them.
Right. And the second main goal is to provide a universal set of standard accounting policies, valuation norms, and disclosure requirements.
Like giving everyone the same dictionary.
Exactly. It's about ensuring every single company is using the same dictionary and the same grammar rules. When they write the story of their fiscal year, the readers, meaning the investors, need to know exactly what those words mean.
Okay, so we really understand the philosophical why now. We need to eliminate the chaos. We need to harmonize the language of business. Now, let's get into the mechanical how.
Let's do it.
Earlier, you mentioned 4 specific actions that these standard policy documents dictate. It was recognition, measurement, presentation, and disclosure.
Yes. These are the 4 pillars of accounting standards. If you are an exam candidate listening to this, understanding these 4 concepts is completely non-negotiable.
Because they show up everywhere.
They form the foundational architecture of how every single standard operates in the real world.
Okay, I want to try a memory trick for this because I know our listeners love mnemonics.
Go for it.
So RMPD. How about real men paint doors?
Real men paint doors. Okay, I like it. Very memorable.
Or if you want something more office appropriate, read my PDF document.
Read my PDF document is perfect for an accounting exam. Recognition, measurement, presentation, disclosure.
Awesome. So I want to view these 4 pillars not just as separate ideas, but as a chronological timeline, like the life cycle of a single business transaction.
I like that approach.
The transaction happens, and it has to pass through these 4 checkpoints before it reaches the investor's eyes. Let's start with checkpoint 1. Recognition. In the accounting language, what are we actually doing when we recognize something?
Recognition deals fundamentally with the timing of an economic event. It answers the critical question, when do we officially record an event or a transaction in the financial statements?
Okay, but again, that sounds deceptively simple. If I buy a coffee, the transaction happens when I hand the barista my credit card, right? Why does a business need a complex rule book to figure out when something happens?
Because in corporate finance, a single transaction often stretches out over months or even years. Let's use a modern example to really ground this.
Okay, what kind of business?
Let's imagine a cloud software company. They sell this highly customized data management platform to a massive hospital network.
Big money.
Very big money. The hospital signs a 3-year, $3 million contract on January 1st, and they wire the entire $3 million in cash to the software company on that very same day.
Whoa. Okay, so the software company has $3 million sitting in their bank account on January 1st. I'm assuming the temptation is to, call the CEO, pock the champagne, and report a massive $3 million revenue spike for the first quarter.
Oh, the temptation is huge, especially if executive bonuses are tied to quarterly revenue targets.
Right.
But you have to ask, have they actually earned that revenue yet? They have the cash, yes, but they owe the hospital 3 years of continuous software access, daily server maintenance, technical support.
And if their servers just completely crash in year 2, they might have to refund a bunch of that money.
Exactly. So the cash moved, but the obligation hasn't been completely fulfilled.
I see.
This is where the accounting standard for revenue recognition steps in. It will dictate that the software company absolutely cannot recognize the entire $3 million on January 1st.
So what do?
It might require them to recognize the revenue proportionally over the life of the contract. So say $1 million per year, or even a specific amount month by month as the service is actually delivered.
Wow, that completely changes the profile of the company.
It really does.
Because without that rule, a failing company could just go out, sign a bunch of aggressive long-term deals, collect the cash up front, look wildly profitable on paper for one quarter, and then totally collapse the next year when they actually have to, deliver the services.
And sadly, that has happened countless times in corporate history. Recognition standards eliminate that guesswork and that manipulation.
So they force honesty about timing.
Yes. They ensure that every software company, every construction firm building a 5-year bridge project, every single subscription box service recognizes their revenue and their expenses at the exact same standardized point in the economic cycle.
All right, so checkpoint 1 is recognition, knowing exactly when the transaction earns the right to enter the financial statement.
Correct.
So checkpoint 2 in our life cycle is measurement. Once we know when to record it, we have to decide what value to assign it, right?
Spot on. Measurement is the process of assigning a precise numerical value to these transactions, assets, and liabilities. At what monetary value do we record them on the balance sheet?
Okay, but again, playing the skeptic here, shouldn't the value just be whatever you paid for it? Like if I buy a delivery truck for $50,000, the measurement is $50,000. Boom, done.
And for a brand new delivery truck, yes, it often is exactly that simple. But look at an asset that's a bit more volatile.
Like what?
Let's talk about real estate.
Okay.
Suppose your company purchased a plot of land on the outskirts of a city 30 years ago, and you bought it for $100,000.
30 years ago, $100,000. Got it.
The plan was to eventually build a distribution center there, but over those 30 years, the city just exploded in size. That land is now situated right in the middle of a massive commercial development zone. Yeah. Real estate developers are offering you $10 million for that exact same plot of land today.
That is a phenomenal return on investment.
It is. But as the chief financial officer, you have a huge dilemma. You are preparing your balance sheet for the end of the year. How do you measure the value of that land asset?
Oh, I see the problem.
Right. Do you record it at its historical cost, the $100,000 you originally paid for it 3 decades ago, or do you record it at its fair market value, the $10 million it is demonstrably worth right now?
Well, if I'm trying to secure a massive loan from a bank to expand my business, I want my balance sheet to look as strong as humanly possible. I am definitely arguing for the $10 million fair market value. It makes my company look infinitely more solvent.
Sure, that's what management would want. But if you measure it at $10 million, you are essentially claiming a massive $9.9 million profit on paper that you haven't actually realized yet.
Because I haven't actually sold the land.
Exactly. What if the real estate market completely crashes next month? Then that $10 million vanishes. This is why standardizing measurement is so incredibly critical.
Because without a strict rule, management will simply toggle between historical cost and fair market value based on whatever narrative benefits them in that specific quarter.
Exactly. So an accounting standard will step in and mandate the specific measuring stick.
So it'll say something like, for land, you must do this.
Right. It might say, for this specific classification of investment property, you must use historical costs, period. Or conversely, it might say, for this type of actively traded financial derivative, you must constantly adjust the measurement to fair market value.
It forces consistency.
Yes. And it's not just assets. Measurement applies to liabilities as well. Think about pension obligations. How do you measure the value of the pensions you owe to your employees 20 years from now?
Oh, wow, yeah. That's a lot of guessing.
You have to use incredibly complex discount rates and actuarial assumptions. The standard ensures everyone is using the exact same mathematical framework to arrive at those liability numbers.
Okay, this is making total sense. So we know when it enters the books through recognition, and we know exactly what the number is through measurement. Checkpoint 3 is presentation. So I have my data. Now I need to figure out where it goes.
Exactly. Presentation dictates how these finalized numbers are formatted, categorized, and structured within the financial statements themselves.
So it's about the layout.
It is entirely about clarity and user comprehension. The goal is to present the information in a manner that is meaningful, logical, and instantly understandable to the reader.
So think of it kind of like a grocery store. If a supermarket buys 10,000 items, they don't just dump them in a massive pile in the center of the store and tell the customers, all right, start digging.
That would be a nightmare.
Right, they categorize them. Dairy goes in the refrigerated section in the back. Produce goes in the bins at the front. Canned goods are sorted by type in the aisles.
That is a very apt analogy. A financial statement is no different. You cannot hand a potential investor a raw data dump of 5 million individual ledger entries.
They would just throw it in the trash.
Exactly. The presentation standard dictates the aisles and the shelves. It tells you exactly how to categorize your numbers.
Give me a real-world example of where a presentation choice could radically alter an investor's perception of a company.
The categorization of debt is a classic example here. Let's say your company took out a $50 million loan to build a new factory.
Okay, $50 million in debt.
The presentation standard will dictate whether you must classify that loan as a current liability or a non-current liability.
And the distinction there is just the timeline, right?
Yes. A current liability means you are legally obligated to pay that debt back within the next 12 months. A non-current or long-term liability means the payment isn't due for years.
Oh, wow. That distinction is literally life or death for an investor.
Absolutely. Think about it. If I look at your balance sheet and see you only have $10 million in cash, but your presentation shows a $50 million current liability.
I know you're facing an immediate liquidity crisis. You're going to default.
Yeah,
You owe $50 million this year and only have 10.
precisely. I'd sell your stock immediately. But if that exact same $50 million is presented as a non-current liability that's due in 10 years,
And I might not panic at all. You have a whole decade to generate the cash to pay it off.
which is exactly why companies in financial distress will often try to creatively restructure their contracts, just so they can present short-term debt as long-term debt. They want to hide the immediate danger.
Sneaky. So proper presentation standards prevent that.
They do. They ensure that the reader can quickly, accurately, and confidently assess the liquidity, solvency, and operational health of the enterprise without having to reverse engineer all the math.
Okay, that brings us to the fourth and final checkpoint in the transaction lifecycle. Disclosure. Now, if presentation is about organizing the numbers on the main pages of the financial statements, disclosure feels like it goes beyond the math entirely.
It does. It goes way beyond. Disclosure is about the narrative context. It encompasses all the footnotes, the supplementary schedules, and the explanatory paragraphs that are attached to the financial statements.
So it's all the fine print at the end.
Yes. The source material emphasizes that disclosures must enable the public, stakeholders, and potential investors to get a true insight into what the numbers are reflecting. The ultimate goal is to facilitate prudent and informed business decisions.
So it's the story behind the spreadsheet. If the numbers are the what, the disclosures are the why and the what if.
That's the right way to put it.
What is a scenario where the main numbers are perfectly accurate, but a lack of disclosure would make the statements entirely misleading?
Contingent liabilities are the most glaring example of this. Let's imagine your pharmaceutical company is currently facing a massive class action lawsuit regarding the side effects of one of your legacy drugs.
Okay, never a good thing.
No. And let's say the plaintiffs are suing for $2 billion. The trial is ongoing right now and no verdict has been reached.
So because there is no verdict, and you honestly don't know if you will actually lose, the event hasn't fully finalized. Which means, based on our earlier rules recognition, you might not strictly recognize or measure a $2 billion loss on your balance sheet today.
Exactly. The strict math of your balance sheet might show a perfectly healthy, highly profitable pharmaceutical company.
But if I am an investor thinking about buying the stock, or a bank considering extending a line of credit, the fact that a $2 billion wrecking ball might swing through the company next year is arguably the most important piece of information in the world.
It is the only thing that matters.
Right. If I buy the stock today and find out about the lawsuit the next day, I am going to feel completely defrauded.
Yeah.
Even if the balance sheet math was technically correct.
And that is exactly where the disclosure standard is paramount. It will mandate that even if you don't record the $2 billion as an immediate loss in the presentation, you absolutely must include a highly detailed note in the financial statements.
Spilling all the details.
You must explain the nature of the lawsuit, the legal opinions on the likelihood of a loss, and the potential financial impact.
It brings the off-balance sheet risks out of the shadows.
Yes. And it's not just lawsuits. Disclosures cover an immense amount of ground. Remember earlier when we talked about a company changing its depreciation method?
From straight line to accelerated.
Right. If they do that, they must disclose that change and explicitly explain the financial impact so investors know exactly why the profit suddenly dropped.
So you can't just quietly change the rules on the math.
No. They also mandate the disclosure of related party transactions.
Wait, related party transactions? Like
Yeah.
doing business with your own family.
Precisely. If the CEO of a publicly traded company directs all of the company's supply chain contracts to a private logistics firm owned entirely by his brother, that creates a massive conflict of interest.
Wow, yeah. The map on the balance sheet might look totally fine. The prices might even be fair.
But the investors have a fundamental right to know that corporate funds are flowing directly to a related party. Disclosures force that information into the light.
Let's do a rapid recap of the 4 pillars, the life cycle of a transaction,
Yeah.
because this is just the beating heart of the framework. And let's remember our mnemonic. Read my PDF document.
Perfect. Let's recap.
1, recognition, the timing.
Mm.
When does the transaction earn the right to be recorded?
Right.
2, measurement, the value. What specific numerical value do we assign to it based on standardized rules?
Correct.
3, presentation, the categorization. How
Yeah.
do we organize those numbers so the reader can actually understand the company's health? And 4, disclosure, the context. What vital narrative information must we provide to ensure the numbers aren't misleading?
If you can internalize that life cycle, you understand exactly how accounting standards operate as the grammatical rules of the business language.
Okay, so if this architecture, recognition, measurement, presentation, and disclosure is so robust, doesn't mean the system is perfect,
Whoa.
because we know the goals. Eliminate chaos, harmonize practices, and force transparency. It sounds like an infallible, bulletproof system. But any system created by humans to govern humans has flaws, right?
Absolutely.
Let's transition into evaluating the double-edged sword of accounting standards. Let's look at the pros and the cons.
The source material explicitly outlines both the benefits and the limitations, and evaluating them objectively is crucial, especially for an exam setting.
Let's solidify the benefits first.
Yeah.
We've woven them through our discussion, but let's formalize them. Benefit number 1.
Standardization of alternative accounting treatments. We explored this deeply with the depreciation and inventory examples. By mandating a standard, you drastically reduce or entirely eliminate the confusing variations in how similar economic events are treated by different companies.
Right, getting everyone on the same page. Benefit number 2 flows directly from that first one.
Yes, comparability of financial statements. This is the ultimate payoff. When every entity adopts and applies the same standards, it ensures uniformity, comparability, and a qualitative improvement in the preparation of financial statements.
It unlocks the ability for an analyst to line up the financials of, say, 3 competing telecom companies
Yeah.
and accurately diagnose which one is actually the most efficient operator.
Exactly. And benefit number 3 centers on the context we just discussed.
Disclosures.
Requirements for additional disclosures. Standards mandate a level of transparency that goes far beyond what is merely required by baseline corporate law.
Because the basic legal statute might only require a company to file its taxes and state its net profit, right?
Exactly. The accounting standards step in and demand the disclosure of contingent liabilities, segment reporting, related party transactions. It empowers the investor.
Okay, those are undeniable benefits. Standardization, comparability, and deep disclosure. So where does the sword cut the other way? If I'm an exam candidate, I need to understand the limitations just as thoroughly. What is the first major limitation of this system?
The first limitation is characterized in the text as difficulties in making choice between different treatments.
Wait, I have to stop you there.
Yeah.
Because that sounds like a total contradiction.
How so?
We just spent 20 minutes establishing that the entire point of a standard is to eliminate choices so that everything's harmonized. How can making a choice be a limitation? Doesn't that mean the standard setting process is failing?
It's not a failure of the process. It's a reflection of the messy reality of the global economy. It is a limitation from the perspective of the standard setters and the businesses themselves. Let me illustrate. The business landscape is incredibly diverse. You have massive multinational investment banks dealing in hyper-complex derivatives, right?
Right.
And then you have mid-sized agricultural cooperatives dealing in perishable crops.
Completely different universes of commerce.
Exactly.
Yeah.
Now imagine a standard-setting body trying to write one single rigid rule for how to measure the value of an asset that applies perfectly to both the investment bank and the farming co-op.
Oh, wow. Yeah.
When you force one standardized treatment onto vastly diverse business models, it can become incredibly rigid. It can sometimes fail to accurately capture the unique economic reality of a specific, unusual business.
Ah, I see. It's the downside of a one-size-fits-all approach.
Exactly.
It's like, okay, imagine a national health mandate declaring that every single person, regardless of their age, weight, or medical history, must consume exactly 2,000 calories a day.
I like this.
It standardizes the diet, which makes it easy to measure for the government, but it might severely undernourish a professional athlete while overfeeding a sedentary office worker.
That is a phenomenal analogy. In the pursuit of uniformity, the standard might force a square peg into a round hole. The process of making that single choice, of picking the quote-unquote best treatment while knowing it will disadvantage or misrepresent certain niche industries, is a profound difficulty. It's a recognized limitation of the framework.
That makes perfect sense. The rigidity is the price we pay for comparability.
Exactly.
But there is a second limitation listed, and from what I understand, this is an absolute massive trap for students on exams.
It is the most frequently tested limitation, and it trips up students constantly because it feels counterintuitive.
What is it?
The limitation is called restricted scope, and the golden rule you must commit to memory is this. Accounting standards cannot override the statute. They cannot override the law of the land.
Let's unpack this hierarchy. When we say the statute, we mean the actual laws passed by the government legislature, the parliament, Congress, whatever it is in that country.
Yes. The accounting standards are required to be framed strictly within the ambit of prevailing statutes. If there is ever a direct, irreconcilable conflict between what a prevailing government law says a company must do and what the accounting standard says a company should do to ensure good financial reporting,
The law wins.
the law wins every single time.
Let's build a corporate analogy to drive this home. Let's say the accounting standards are like the employee handbook created by the Human Resources Department of a large corporation.
Okay.
The HR department creates a rule that says, to ensure maximum productivity, every salaried employee must work 60 hours a week without overtime pay. That's their standard for the company.
Terrible standard, but okay.
Right. But the federal government has a labor law, a
Oh.
statute, that dictates anyone working over 40 hours absolutely must be paid time and a half.
In that scenario, the HR department's rule cannot override the federal labor law. It doesn't matter if the HR rule makes the company more productive or if every other company in the industry is doing it. The scope of the HR department's power is restricted by the prevailing federal law. The law always wins.
This is such a critical point for exam readiness. If you are sitting in a testing center and you see a scenario that asks, can an accounting standard override a local tax statute if doing so provides a much more transparent and accurate picture to the investors? The answer is always unequivocally no.
No, restricted scope. The standard-setting bodies do not possess legislative power.
They exist to harmonize the financial language within the boundaries of the law, not to rewrite the law itself.
Precisely.
Okay, this discussion of restricted scope and power naturally begs a massive question.
Which is?
Who exactly are these standard-setting bodies? If they aren't the government passing laws, who is actually writing these rules?
That is a great question.
Do they just magically appear from a smoky back room full of elite accountants making decisions for the rest of us? We need to trace the origin story here. How does a standard actually get made?
To understand the mechanics, we will focus on the formulation process in India, as detailed extensively in the source material. It is a rigorous, deeply consultative process.
Okay.
It begins with the premier accounting body in the country, the Institute of Chartered Accountants of India, universally known as the ICAI.
The ICAI, they're the apex body.
Yes. Recognizing the need for harmonization back in 1977, the ICAI took upon itself the leadership role by constituting a specialized dedicated body called the Accounting Standards Board, or the ASB.
So the ICAI is the parent organization,
Yep.
and they gave birth to the ASB to handle this specific task of writing standards.
Correct. But the ICAI understood that if these standards were going to be accepted by the entire economy, the process couldn't just be accountants talking to other accountants in an echo chamber.
But that never works well.
Exactly. They designed the standard-setting procedure of the ASB to be immensely transparent and broadly consultative. The composition of the ASB really reflects this.
Who actually gets a seat at the table when the ASB meets?
It includes representatives from the major national industry bodies. The text specifically highlights Assocham, CPUI, and FIS CPUI.
For our listeners who might not be immersed in the Indian corporate ecosystem, what are those organizations?
They are essentially massive chambers of commerce. ASSOCHAM is the Associated Chambers of Commerce and Industry of India. CFI is the Confederation of Indian Industry. And FASUCI is the Federation of Indian Chambers of Commerce and Industry.
Okay, so they represent the collective voice of thousands of businesses, from manufacturing to tech to agriculture.
Yes. So the actual businesses that have to implement these rules get a direct voice in creating them. That is vital for practical application.
It definitely is. Who else is there?
The ASB also includes regulators, academicians from universities, and representatives from various government departments. It's a true cross-section of the entire economic ecosystem.
Wow, so it's a very diverse group.
Now, there is a fundamental governance rule regarding the relationship between the ICI and the ASB, and examiners love to test this.
Ooh. Okay, let's hear it.
Although the ASB is a body constituted by the Council of the ICII, the ASB operates with distinct independence in the actual formulation of the standards.
What does that independence look like in practice? Like, how does it actually play out?
It means the Council of the ICII, the overarching governing body, is not empowered to unilaterally make any modifications to the draft accounting standards formulated by the ASB.
Really?
Yes. If the council wants to change something, they are mandated to consult with the ASB first.
Wow. So the parent organization creates the committee, but then grants them real, actual autonomy? The parent can't just cross out the committee's final homework without engaging in a dialogue about it.
Exactly. It protects the integrity of the consultative process. It prevents top-down dictation.
So how does that consultative process actually work, like step by step?
The source material outlines a rigorous 6-step journey from an initial idea to a finalized binding standard.
Let's build this sequence step by step. And let's imagine a hypothetical scenario to ground it, so it's not just theory.
Okay, I like that.
Let's say the business world is suddenly obsessed with trading carbon credits. Companies are buying and selling the right to emit carbon, and it's just total chaos on the balance sheets. Nobody knows how to account for them. How does the ASB step in? Step 1.
Step 1 is the identification of broad areas by the ASB for the formulation of an accounting standard. The ASB constantly surveys the economic landscape. They recognize the chaos surrounding carbon credits and formally identify it as an area requiring harmonization.
Okay, the target is locked. Step 2.
Step 2 is the constitution of a study group by the ASB. The board doesn't write it themselves. They assemble a specialized team of experts, in this case, maybe environmental economists and specific industry accountants, to consider the project and prepare a preliminary draft.
What actually goes into that preliminary draft? I'm assuming our 4 pillars, RMPD, make an appearance.
Absolutely. Read My PDF document is back. The preliminary draft will define the objective and scope of the standard. It will provide strict definitions for what exactly constitutes a carbon credit. And crucially, it will lay out the proposed recognition and measurement principles, as well as the presentation and disclosure requirements.
So the study group basically writes the very first draft to the rulebook. Up to step 3.
Step 3 is the preparation of the draft and its circulation. The ASB takes that preliminary draft and holds meetings with representatives of specified outside bodies.
So those industry chambers we talked about, like CII and FICCI and government regulators.
Exactly. They circulate it to ascertain their views.
They are essentially stress testing the draft behind closed doors. They go to the heavy manufacturing industry and say, hey, if we force you to measure carbon credits this way, does it bankrupt your operations?
That's exactly what they do. They gather that initial feedback, they debate the implications, and they modify the draft. Which leads directly to step 4, and this introduces one of the most important terms in standard setting, the exposure draft.
The exposure draft. Why is that specific term so heavily emphasized? I feel like I see it everywhere in this curriculum.
Because it marks the critical transition from private consultation to public accountability. Step 4 is the finalization of the exposure draft, or ED, of the proposed standard, and its formal issuance inviting public comments.
Ah, I see. So it's no longer just the massive industry bodies who get a say. It is exposed to the entire public.
Yes. Any independent auditor, any small business owner, any retail investor can download the exposure draft, read the proposed rules for carbon credits, and submit their critique.
The exposure draft is basically the ASB saying, this is our near final proposal. We believe this is the best way to harmonize this area. Speak now or forever hold your peace.
It is the ultimate transparency mechanism.
So the public spends a few months ripping the draft apart or praising it and submitting their comments. Then what? Step 5.
Step 5 is the rigorous consideration of the comments received on the exposure draft. The ASB reviews all that public feedback. Perhaps a tiny tech startup points out a flaw in the measurement principle that no one else saw.
Right.
The ASB modifies the draft to address these valid concerns. Once they are fully satisfied that the standard is robust and practical, they finalize the draft accounting standard and submit it to the Council of the ICAI.
Which brings us back to the parent organization, the final step, step 6.
Step 6 is the consideration of the final draft by the Council of the ICAI. The Council reviews the entire package for final approval and issuance.
And, linking back to our earlier point on independence, if the Council feels modifications are necessary at this late stage, they must consult with the ASB before making them.
You've got it. Once approved, the accounting standard is officially published and becomes part of the binding language of business.
That is a phenomenal democratic process. Let's recap that 6-step sequence really quickly, because examiners love asking students to order these steps logically.
Good idea.
1. Identify the area of chaos.
Constitute a study group to write a preliminary draft.
Circulate the draft and ascertain views from major outside bodies.
Finalize and issue the exposure draft for wide public comment.
Consider the public comments, modify, and finalize the draft.
The ICI Council considers the final draft, consults the ASB if needed, and officially issues it.
Beautiful. If you can visualize that journey from identification all the way to issuance, you have absolutely mastered the formulation process.
Now, everything we just discussed with the ICII and the ASB is highly localized to India. But, business isn't local anymore. It hasn't been for decades.
No, it's a global web.
We operate in a massively interconnected global web. An institutional investor sitting in an office in New York or London might be evaluating the financial statements of a rapidly growing tech firm based in Mumbai. How do India's domestic standards interact with the rest of the world? Do we just ignore international practices?
Ignoring the world would be economic suicide. The ASB does not operate in a vacuum. The source material emphasizes that as part of their formulation process, the ASB explicitly considers international financial reporting standards.
Okay, another acronym.
Yes, they are known globally as IFRSs.
Okay, acronym check. We know that ASB is the Accounting Standards Board in India. What is the body that issues these international IFRSs?
That is the International Accounting Standards Board, or the IASB, and they are based in London. They are essentially the global equivalent of the ASB.
So the Indian ASB keeps a close eye on what the international IASB is doing.
It's a lot more than just keeping an eye on them. There was a monumental strategic shift in the Indian regulatory landscape regarding this.
Really? When?
The text points out that in 2006, the ICAI initiated a formal, concerted process of moving towards these international financial reporting standards.
2006. Why make that massive shift right then? What was the driving force?
The driving force was the globalization of capital. The explicit goal was to enhance the global acceptability and transparency of the financial information communicated by Indian corporates.
Makes sense.
Think about it. If a rapidly expanding Indian infrastructure company wants to raise billions of dollars from international pension funds to build highways, those foreign investors need to be able to read and trust the company's financial statements.
If the Indian company hands them a balance sheet governed by a totally unique set of domestic accounting rules that the foreign investor has literally never seen,
the investor won't put their money in. The risk of the unknown is just too high.
it's like trying to negotiate a highly complex global trade deal, but every country refuses to use translators and insists on speaking their own regional dialect. The deal just falls apart.
Precisely. To attract foreign direct investment, you have to speak a common, globally recognized financial language. Moving towards IFRS provided that global passport.
But wait, we just spent a long time discussing the limitation of restricted scope. We established that accounting standards cannot override the local laws of a country. The international standards written in London might directly conflict with the domestic tax laws or corporate statutes written in New Delhi. How did India solve that conflict? Did they just copy and paste the IFRS rulebook?
You have hit the exact crux of the issue.
No.
No, they could not just copy and paste, precisely because of restricted scope. The move towards IFRS, which was subsequently accepted by the government of India, was not a blind adoption. It was a process of convergence.
Convergence. They adapted rather than adopted.
Yes. The ASB integrated the core principles of the international standards, but they were legally mandated to do so in the light of the applicable laws, customs, usages, and specific business environment within India.
So they took the global framework and tailored it to fit the domestic legal reality.
Exactly.
And what was the result of that tailoring process? What do we call this customized rulebook?
This framing process led to the creation of a new, distinct set of standards known as Indian accounting standards, universally referred to as IND-AS.
IND-AS. Okay, so it's basically the DNA of the international IFRS, modified to survive and function within the specific legal ecosystem of India.
That is a brilliant way to conceptualize it. IND-AS provides the global comparability that international investors demand, while strictly respecting the domestic legal framework that Indian corporations must operate within.
I noticed the source material provides a long list of specific standards like AS-24 for discontinuing operations or AS-26 for intangible assets, along with the full list of IND-AS.
It does, yes.
Yeah.
But it explicitly notes that the detailed provisions of those specific standards do not form part of the syllabus for this introductory unit. They are provided just for general awareness.
So for the listener preparing for an exam, don't panic and try to memorize the intricacies of AS-26 today. The key takeaway for this unit is understanding the process of moving towards IFRS to create IND-AS and the fundamental reason why it was done.
Which is to achieve global acceptability and transparency in a borderless economy.
Exactly.
Master the why and the how of the framework first. The specific rules of each individual standard will come later in your studies.
All right, we have covered an immense amount of conceptual ground here.
You really have.
We started with the chaos of the broken monopoly game, explored the overarching objective of harmonization, broke down the transaction lifecycle of RMPD, debated the rigidity and restricted scope of the rules, walked through the six-step ASB formulation process, and explored the global convergence into IND-AS.
It's a lot to take in.
It is. Now, it is time to consolidate this knowledge. It is time for the interactive exam review.
Oh, this is my favorite part. This is where we ensure you aren't just passively listening, but actually integrating the concepts. We want to expose the common traps examiners use to test your true understanding.
Okay, I am going to step into the shoes of a highly stressed student staring down a complex multiple choice exam. I am going to throw scenario-based questions at you, drawn directly from the concepts in the source material, and I want you to give me the definitive, expert breakdown of why an answer is right or wrong. Are you ready?
I'm so ready. Let's dissect them.
Question 1. True or false? If an accounting standard formulated by the ASB presents a significantly more transparent and accurate method for reporting revenue than a decades-old government statute, the standard can override the statute to ensure better financial reporting for investors.
False. Absolute, unequivocal false. This is the ultimate test of the restricted scope limitation we talked about.
It's a trap.
A huge trap. It does not matter how outdated the law is or how brilliant and transparent the accounting standard is. The statute always wins. Standards must be framed within the ambit of prevailing statutes.
Examiners will always try to trick you by adding phrases like, to ensure better financial reporting, to make breaking the law sound like the morally correct accounting choice.
Exactly. Do not fall for it.
Phenomenal breakdown. The law is the ceiling. All right, question 2. True or false? Because the overarching goal of accounting standards is harmonization, the difficulties in making choice between different treatments is actually considered one of the major benefits of the system, as it forces companies to streamline their operations.
False. Again, this is a complete misinterpretation of the text.
Really? Because it sounds kind of plausible.
That's why it's a good trap. The source explicitly lists difficulties in making choice as a limitation. Standardizing alternative treatments is the benefit. But the process of making that choice, of forcing a massive tech firm and a local farm to use the same rigid rule, creates immense difficulty and friction.
Well, one-size-fits-all problem.
Yes, it is a recognized flaw in the approach, not a benefit.
Okay, here is a question designed to test memory of the formulation bodies. Question 3. True or false? The specialized body created by the ICI to formulate these rules, the ASB, stands for Accounting Standardization Benchmarking.
False. It stands simply for the Accounting Standards Board.
See, that is a classic, somewhat frustrating exam trick.
They will throw highly professional-sounding buzzwords at you. Benchmarking, standardization, systemization, just to confuse your memory under pressure. Trust your foundation. It is the Accounting Standards Board.
Trust the foundation. Love it. Question 4. True or false? Because accounting standards are created through a rigorous, 6-step democratic process involving industry experts and public exposure drafts, the final standards possess 0 operational limitations.
False. We just spent a significant amount of time discussing 2 major limitations. First, the restricted scope, their ability to override the law. Second, the rigidity and difficulty in making choices for diverse business models.
The system is great, but it isn't perfect.
Exactly. The standards are a phenomenally powerful tool, but acknowledging that they are not perfect and understanding why they aren't perfect is the hallmark of true conceptual mastery.
Let's do one focused on the benefits. True or false? The requirements for additional disclosures mandated by accounting standards are ultimately a limitation because they create burdensome paperwork that slows down corporate efficiency.
False. Do not apply operational logic to an accounting theory question.
Oh, that's a great tip.
The source material explicitly lists requirements for additional disclosures as a core benefit. Why? Because the entire philosophical purpose of standards is to provide timely, useful, and transparent financial information to stakeholders.
So even if it takes more time for the accountants to write the footnotes.
Forcing companies to disclose contingent liabilities or related party transactions going beyond what basic law requires massively increases transparency. It protects the investor. Therefore, it is a benefit to the ecosystem, regardless of the paperwork involved.
Excellent. Let's do one final multiple choice question, drawn directly from the specifics of the text. Who issues accounting standards for non-corporate entities in India? Is it A, the central government of India, B, the state governments, or C, the Institute of Chartered Accountants of India?
The correct answer is C, the Institute of Chartered Accountants of India, or the ICI.
Not the government.
No. While the government might officially adopt or notify standards for large corporate entities under the Companies Act, the ICAI remains the premier accounting body that takes the leadership role in issuing these standards for non-corporate entities.
Fantastic. If you, the listener, could anticipate those answers and follow the underlying logic, you are in spectacular shape for your exam and, more importantly, for understanding the real world of finance.
You really are.
Let's do a rapid chapter recap to lock the doors on everything we've built today. We started by identifying the core mission, the absolute necessity of standards to eliminate the tendentious reporting and chaos of diverse accounting practices. The overarching philosophical objective is harmonization.
And we achieve that harmonization to eliminate non-comparability, which directly improves the reliability of the financial statements while providing a universal set of policies for everyone to follow.
To execute that harmonization, the standards tackle the life cycle of a transaction through four main pillars. Remember our chronological flow, RMPD, or Read My PDF document.
When does the event officially enter the books?
At what numerical value do we record it?
How do we categorize and format it on the balance sheet so it's meaningful?
What extra narrative context must we provide to prevent the numbers from being misleading?
We then evaluated the reality of the system, the double-edged sword. The benefits are clear. Standardization of treatments, comparability across industries, and vital additional disclosures.
But the limitations are equally real. The rigidity of choosing a single treatment for diverse businesses and the golden rule of restricted scope standards can never override the prevailing statute.
We traced the rigorous origin story of a standard. The parent ICAI formed the ASB, an independent body with representatives from industry giants like CII and FICCI. They identify a problem area, a study group drafts the rules, they consult privately, they issue an exposure draft for public scrutiny, they modify the draft based on that feedback, and finally the ICI Council officially issues it.
And lastly, we zoomed out to the global picture. We discussed the pivotal 2006 shift towards international IFRS to ensure Indian companies had the global acceptability required to attract foreign capital, resulting in the localized, law-compliant Indian version known as IND-AS.
It is a brilliant, highly logical system.
We have journeyed from the utter chaos of a broken board game to a highly structured, globally integrated language of commerce.
And if we connect all of this back to the bigger picture, I want to leave you with a final thought to ponder long after this deep dive ends.
It's here.
We talked about how the ASB is constantly identifying new broad areas that require formulation. The business environment is not static, it is evolving at lightning speed.
That's true.
Think about the rise of massive technology companies whose primary assets aren't factories or delivery trucks, but user data and algorithms. Think about the explosion of cryptocurrency, decentralized finance, and digital tokens. Think about how you measure the brand value of a viral meme that drives millions in sales.
Right. Those are entirely unprecedented types of economic transactions and assets that simply did not exist 20 years ago.
Exactly. So the profound question is, how will the language of business need to adapt its vocabulary next? How do you reliably recognize, measure, present, and disclose the fair market value of a proprietary artificial intelligence model.
Wow, that's a wild thought.
The rulebook of accounting standards is never truly finished. It is a living document, constantly being written and rewritten to capture the ever-changing reality of human economics.
That is a fascinating perspective. The board game is constantly getting new, invisible pieces, and the rule makers have to stay awake to keep the game fair. Thank you for joining us on this deep dive. Whether you are walking into an exam room or analyzing a stock portfolio, keep questioning the why behind the rules and keep mastering this ever-evolving language. Until next time.